Everybody, welcome. Good to see you all. Welcome to the Bitcoin for Corporations Symposium here at Bitcoin MENA. My name is George McHale. I will be your host today. I'm the Managing Director of Bitcoin for Corporations. Bitcoin for Corporations, for those of you who don't know, is an initiative between BTC Inc. and Strategy. Our mission is to accelerate corporate Bitcoin adoption, and events like this are made possible by our members, which should be displayed up there in between sessions. It's going to be a fun day. We're gonna be here in the enterprise stage for 7 hours all day talking about corporate adoption. We have 6 different continents represented. This is very much a global movement, and there's a lot happening. If you're paying attention to all of the news, there's a lot coming at us, and we are excited to dive into all the topics impacting our industry. A couple quick housekeeping items. So this again is the enterprise stage. And the Enterprise Hall. So we are taking over this entire area all day today. Lunch is going to be served here at about 12:15. It'll be about half an hour. At 11 o'clock, we have a built-in 2-hour block that's just focused on investors. That's going to be sponsored by UTXO and Bitwise. So make sure you share that. My microphone keeps cutting in and out, just so we know. That's going to be a problem today. So we're gonna try to address that. And then 2:15, we have a fireside chat between Michael Saylor and Simon Gerovich. So you will not want to miss that. I think that is all my housekeeping items. So without further ado, we are going to get right into the agenda with our first panel, talking about the roadmap for untapped markets. So I'm going to introduce our panel. Go ahead and come on up here. This panel is hosted by Mason Ford from Mel Hughes. So please give it up for our first panel.
Good morning, everyone. How are we doing? First off, I want to say thank you to Bitcoin Corporations for having us and welcoming us at the symposium. My name is Mason Ford. I'm the Director of Bitcoin Strategy at Mel Hughes. Mel Hughes was the first public company in Brazil and Latin America to adopt a corporate Bitcoin strategy. And I'm also a founding member of True North, the leading Bitcoin investment grade podcast, which was recently acquired by Strive. But that's enough for me for now. I'll be speaking at a panel later today. This first session, the roadmap to adoption in untapped markets, is a discussion about exactly that, untapped markets, lesser known and smaller known markets. And today we have 3 guests from Korea, the UK, and India. And as I'm meeting them for the first time, I'm going to let them introduce themselves. So, SK, will you start us off and give us a brief intro about yourself, your company, and what does an untapped market mean in your context?
Yes. I'm SG, the co-founder and COO of another company from Korea. So we are building the digital asset, digital investment service there by AI and on-chain data analytics. In Korea, we have the largest user base, except the 3 exchanges in Korea. So we are also ready to launch Lightning payment and Bitcoin-backed loans, and similar to service like the US in Strike. So our goal is to become the Bitcoin bank in Korea. So I previously helped build one of the Korea's Bitcoin treasury companies. So recently, I have been working with the founder of a Korea-listed company to plan their new Bitcoin treasury business. So Korea was expected to approve Bitcoin ETFs and allow public companies buy and hold Bitcoin on the exchange by the end of this year. But the timeline has been delayed. So even so, Korea is still very crypto-friendly and ranks number 3 in global crypto trading volume. But we are preparing for the Bitcoin, emerging in there.
Thank you. Huey?
Hi, my name is Huey, and I'm CEO of the London Bitcoin Company. We're a Bitcoin miner and a Bitcoin treasury company listed on the London Stock Exchange. We've been listed there for 2 years, and we were founded 3 years ago. A bit of background on myself. Ever since I graduated almost a decade ago now, I've been in the crypto scene in some way or another. And I think, as is often the case, when you're young and kind of new to the corporate world, you go to explore the wider industry. And I think, like a lot of people who are in crypto for a long time, I found myself back in Bitcoin, where it feels the most real and it feels the most relevant, and it feels like it's probably the only currency which has a real future in the crypto ecosystem. Thanks.
Hi, I'm Siddharth Bharwani. I am part of JetKing, which is India's first Bitcoin treasury company. The business, as a business, is about 40 years old. We are traditionally into IT education, and we pivoted into becoming a Bitcoin treasury company same time last year at this stage, at this platform. So it's been an exciting journey for the last 1 year. In India, I think Bitcoin is just being born, and the opportunities around Bitcoin and the asset ecosystem itself is huge. So excited to talk here today.
So can you tell us what are some pain points that Bitcoin is actually solving in your country, and where is adoption today versus where it could be in the future?
Interesting. So for India, it's like I mentioned, it's just being born, right? So crypto as an industry is been rapidly evolving in India, but regulations have been super slow to understand how to treat blockchain or Bitcoin in regulating the asset class. Today, while we have a lot of exchanges who have come forth, there's not too many businesses that are evolving around the asset itself. So I think potentially there is so much to do with this asset class, which is to do with education, which is to do with adoption, which is to do with building out the ecosystem. For example, there's only one custody solution, which is an India-based custody solution. So it's just a matter of time that the regulations unfold. But to that extent, it should just be done as rapidly as the ecosystem evolves.
I think for the UK, most people have heard of Bitcoin in the UK, but only about 10 to 20% actually own Bitcoin. It's mostly the difference between the UK and probably more emerging markets is Bitcoin's primarily like a speculative asset in the UK. People have the luxury of having spare capital to invest, and they use things like Bitcoin to deploy that capital. But we're very tightly regulated. I would say still more than 99% of monetary transactions in the UK go through traditional payment rails or fintech apps or whatever. We have quite a hostile regulatory body in the FCA that aren't too friendly towards Bitcoin right now. But there's a lot of lobbying going on at the moment that hopefully is going to change that in some form or another. And there's definitely an emergence of companies like mine, which are on the stock market, building treasuries and trying to kind of spread the word of Bitcoin throughout the investment community, and especially the regulated investment community. So hopefully for the first time in a decade, we're going to see some real regulatory clarity around Bitcoin in the UK.
So yeah, I think our goal is hyper-Bitcoinization. So, and to achieve that, we believe adoption is needed not only at the individual level, but also at the national, institutional, and corporate levels. So if you look at the El Salvador, for example, Bitcoin adoption was able to grow so quickly because the current country encouraged Bitcoin education and holding at the national level. But in Korea right now, interest in stable coins is very high there. So Bitcoin has always been treated as the lower priority in Korea. So many altcoins have received more attention, and Korea is also the country that produced Dogon and the Terra and Luna incident in there. So we expected the positive regulation around the Bitcoin ETFs and corporate Bitcoin holdings will open up next year. So Korea also tend to read cultural trends, so Bitcoin become part of the culture here. So we believe it could have a very strong global influence there. Yeah.
Yeah, the common theme there of the regulatory landscape. What is the biggest headwind, and what would create the biggest tailwind from a regulatory standpoint in your country?
So I think it cuts across multiple layers, right? So I think an asset like this needs to be moved at the parliament level. And when it's moved at the parliament level, everyone else kind of follows. So for example, the Security Exchange Board of India, the RBI, Bombay Stock Exchange, all of these regulators and quasi-regulators are just making a very reactive policy around it instead of being proactive. So I think a proactive approach across a digital asset like this is super important. And that's what brings the tailwind. The headwinds bring the tailwind, right? So ultimately, you get clarity in regulation. Ultimately, you get that crystal clear environment to operate in. I think as soon as there's clarity, there's transparency in how you look at this asset, things move in the right direction.
I think in the UK, we have such a long-standing kind of credible finance industry that we've often pushed back against innovation because we want to maintain what we have in the UK right now. And that goes for the regulator and a lot of the people who make policy decisions in the UK. So the biggest headwind is definitely the UK's more recent lack of openness to innovation and change. I think the tailwind is just increasing adoption and increasing popularity. The more that the word is spread of Bitcoin throughout the UK, the more people are adopting it, the more people who are buying it or having companies that use it as a means of corporate treasury is definitely going to be the biggest tailwind to get there to be some regulatory change in the UK, at a government level and at a financial level.
So yeah, we expected that positive regulation around Bitcoin ETFs and corporate Bitcoin holdings will open up next year in Korea. So in Korea, Bitcoin is still in the early stage of becoming a store of value. But it's an essential asset in there. So that's why it's so important that more companies around the world are starting to hold Bitcoin, and networks like Bitcoin for Corporations. So where companies stand together and move with alignment, play a critical role. So there is a real strength in unity, I think.
When you were speaking to investors and you're pitching your company, when you're talking about your country, why should somebody invest in your company, specifically in your country as well?
I mean, to start with, India is a high tax regime, and Bitcoin, for example, is taxed at almost 33% if you buy Bitcoin directly. While you're issuing equity for a listed company, your taxation over 1 year is about 12.5%. So there's a beautiful 18% arbitrage for retail adoption. I think because of lack of clarity in terms of regulation, institutions can also be holding a lot of the equity of a Bitcoin treasury company instead of holding it directly. If they trust the management, if they trust the governance of the company, what they end up doing is holding more stock of the company than holding Bitcoin directly. So just having clarity of how to operate or hold Bitcoin as an asset and custody it correctly as well as the retail arbitrage of taxation, that becomes the two main pillars to go after in India at least.
I think for us, it's a very simple pitch that we do around London and the UK, is that we're the only company on the London Stock Exchange that provides any exposure to Bitcoin as an asset class. There's no ETFs in the UK. There's no other formal tracker fund in the UK. So the way that we set out, to plan things and speak to investors is that we're either going to be good tracking exposure to Bitcoin in an LSE company, which is very tightly regulated, or we can act as a high beta to Bitcoin, and we can outperform if we act well as management and we manage to buy and get exposure in the right ways. So, we're always worried about competition coming onto the stock exchange, but nothing's managed to do it yet. So really, the way we stand out is being the only one there, and I think that's how we'll grow. When there's more institutional openness to adoption in the UK, I think they'll see our company as the home for their capital to get exposure within their fund or whatever it is.
So I think this is a time for the Bitcoin Treasury 2.0. So there have been cases where a listed company keeps its core business running less as is, so hold Bitcoin to create upside. But there have also been cases where acquires a struggling listed company and turns it into a Bitcoin holding vehicle. But looking at recent trends, there are more pro-margin companies seems to be moving toward that creates upside in their existing business too. So Prenetics in Hong Kong feels like an example for this. So and beyond just hold Bitcoin, Strategy and Metaplanet start adding BTC-related financial product like STRC and STRE, plus Bitcoin-backed lending and payment and remittance. In other words, this is a Bitcoin bank, I think. So model is emerging like 21 Capital. So personally, I think that Bitcoin treasury companies that grow well in this way can become Bitcoin banks in each country. So that's the kind of future I'm aiming for as well. Yeah.
The main objective of Bitcoin Treasury Company is to increase the amount of Bitcoin per share. What strategies are you using to achieve that objective, and how might that change in the future?
Sure. So when we took off maybe about a year ago, we had an incident where we were given the approvals to move forward, and then the regulators took a kind of U-turn, which we are handling right now. But what we decided was, so we are not able to issue fresh equity and raise capital. So what we decided was to is increase and improve our cash flows from our operating business, which is the education business, and potentially the free cash gets allocated into Bitcoin. Regardless of that, we have been buying Bitcoin every day. So we buy. So whatever excess cash flows is left aside for that day, we go ahead and buy Bitcoin. I think a Bitcoin treasury company also would need some kind of a Bitcoin operation business. So to say that evolving your business in such a way where you can tap into the Bitcoin ecosystem or the Bitcoin economy. So looking at businesses that generate active cash flow, you tap into those and potentially keep buying Bitcoin.
Yeah, just echoing the same thing. The main thing is to have a good operating business, which you can then passively accumulate Bitcoin. Our operating business is Bitcoin mining, which is still profitable at these levels. So that gives us this kind of passive accumulation phase that we go through there. And then additional to that, we do the traditional forms of issuing shares in order to buy more Bitcoin when the market demand is there. But I think primarily the focus, throughout next year and throughout the future, I think for all Bitcoin treasury companies is not just taking advantage of the ability to dilute your cap table, but also generating revenue verticals in various different forms to allow you to pick up Bitcoin without having to suffer your investors' dilution.
My opinion is the same. So recently, Korea's M2 money price increased by 22% over the past 3 years. So while the US dollar supply rose by only 2% over the same period, this means the Korea won has been weakening in relative terms. So I think that Bitcoin treasury companies that grow well in this way, I think we can become the Bitcoin banks in each countries. So that's the kind of future, I think. Yeah.
What Bitcoin environment are you expecting in the next year or two, and how does that shape your strategy, if at all?
So I know for a fact that there's a lot of experiments going on the blockchain for the government, right? So for example, they're testing out their own CBDCs to see what they can do on top of the blockchain. There's been a fair amount of tokenization and real world asset conversations. So what that indicates is the fact that there is an openness to adopt this technology. And so the reason I use Bitcoin and blockchain interchangeably is because they understand Bitcoin better than when you speak blockchain. And I think potentially we were the first company to establish the Bitcoin Treasury Reserve. Behind us, there was about 45, 50 companies that applied to the exchanges. None of them got the approvals. But what it does show is the pattern that people are willing to adopt different modes in these exchanges. So I think it's just a matter of time. As soon as there's regulatory clarity, India is a young country, and things will just open up.
I think just generally, more utility on Bitcoin is the most important thing. Let it be seen less as a speculative asset and more as something we can use. In London, there's a huge increase in Bitcoin venture capital. Recently, there was the first Bitcoin accelerator that opened up in Covent Garden in London. So I think, the next 2 years, we will see this real adoption curve, like I say, not just with speculation, but with actual utility and use case. And I think that's the most important thing for not only the prosperity of Bitcoin, but, the survival of it as an asset class long into the future.
So, yeah. I run the Bit Saving service in Korea. So this is the AI and on-chain data driving Bitcoin DCA service there. So we help people see Bitcoin as something to save and hold for the long term. So this is very important to Bitcoin DCA, Bitcoin saving, and Bitcoin payment, and Bitcoin buy and hold. So Bitcoin is the very core asset for the people. So I think this is the we can call it this is the hyper Bitcoinization. So you are aiming for that.
We have 2 minutes left. Each of you, maybe in 30 seconds, any last words that you want to leave the crowd with?
Sure. So one of the key focuses that we have internally is to have a hyper education program across India, right? And when I say hyper education, what we're trying to build is an active learning environment around Bitcoin. And what that eventually does is explain to a lot of people what Bitcoin as a technology is, because like I mentioned earlier, that Bitcoin is just being born in India. I think that's at the retail end, and just corporate awareness. I think a lot of times people get stuck up with the pricing of Bitcoin when the price is moving up and down, and that's generally the conversation. But if you get in deeper into the ecosystem and why Bitcoin, like India there's so much opportunity for the unbanked, for example. There's so much opportunity for people who understand the forex is very, very expensive in India compared to the dollar. So I think just making people understand, awareness and education is the primary focus that we have, and the idea was to keep scaling that up.
I think for me, if I wasn't doing what I'm currently doing, I would definitely be trying to help push Bitcoin in emerging markets. They have a deep utility demand in emerging markets and low kind of formal adoption. So I think the most important thing and the most obvious use case is for these countries that have perhaps unstable currencies and they need another form of exchange. So it's something that we've looked at deeply with the London Bitcoin Company, but right now we're focused on what we're doing, but I think that's where the real strength and the real movement's going to happen in Bitcoin first and foremost.
So I personally entered this space in 2017 and have seen many cycles of rise and drops. And I believe Bitcoins are shaped over time. So in today's macro environment, people naturally look for money they can trust. So money that's stronger and more honest, and that's what Bitcoin is.
Can we give a round of applause to our panel, please?
All right, how about one more round of applause for our panel? Thank you, gentlemen. Appreciate that conversation. We are going to keep things rolling. We're going to try to get back on time because we started a little bit late, and that is my commitment to you. We are going to be on time. We're going to be punctual. I don't know if you noticed our times are a little bit unique on the agenda. That is intentional. So here to introduce our next panel, we have Jeff Walton from Strive talking about Bitcoin-backed financing for corporations. So please help me welcome the next panel.
Hello? All right, we're on. Okay, we're back. Hello, everybody. Thanks for being here. And I've got a very unique panel here today. I've got Russ Jacobson at Mood Inc., Wyatt O'Rourke at Basilic Inc., and Hunter Albright at Salt. And we're here talking about Bitcoinization and finance and lending products and how these are evolving. So I just want to set the stage here a little bit, right? There are now hundreds of companies that are adding Bitcoin to their balance sheet, and you can see Bitcoin as a productive asset. So the big question is, how can I start to utilize the productivity of Bitcoin, and can I do this in different ways? So I think we've got three, and including mine, four unique perspectives of how we view this. So I'm just going to pass it around for quick intros, and we'll just talk about how you guys are seeing the lending market and how you're seeing the options of utilizing your productive capital of Bitcoin. So, pass it to you.
Yeah, it's great to be here this morning. I'm Hunter Albright, Chief Revenue Officer of Salt Lending. Salt Lending was the original Bitcoin lender, started in 2016, and have been working with mining companies and businesses since then to really help them understand how to take advantage of the value that they build in Bitcoin on their balance sheet. And looking forward to the conversation today.
I'm Wyatt O'Rourke. I'm the founder of Basilic Financial. We're a Bitcoin-focused wealth management firm. I'm the author of the Bitcoinization of finance and doing a lot more work in the digital credit space.
Russ Jacobson, Moon Inc. is a Hong Kong-based listco. We actually run an operating business that's in the telecom space, but just as really of this year, have started building out Bitcoin products and stacking Bitcoin on our balance sheet.
Okay, so where we're at here, the terms that have historically been available for lending on Bitcoin have been incredibly draconian. They're very challenging. There's a lot of risk associated with them, margin calls, et cetera. So this landscape is evolving pretty drastically. So at our company, Strive, we've issued a perpetual preferred equity where we remove the margin call risk and we're able to take on Bitcoin as permanent capital and pay out dividends into perpetuity. So that's how we've started to view monetizing the productivity of our Bitcoin. But Hunter, I'm going to pass it over to you to talk about what Salt's doing. Like what's available? You have a new product called Salt Shield that I think is really interesting. If you mind walking through that?
Yeah, I'd be happy to. I mean, I guess to set some context, so, one of the things we really work with business on is getting liquidity out of the value of the Bitcoin they have on their balance sheet. And one of the things that they're most afraid of is losing their Bitcoin and having those assets go away and not being able to maintain exposure. And one of the things Salt has learned in terms of having lived through multiple bear and bull cycles is how to help provide protection to the borrowers. So the first innovation Salt had was something called stabilization, where we converted the assets into stablecoin if there was market volatility to allow people to buy back in, but really safeguard their assets. And what that led to was really us coming up with a product called Salt Shield. And essentially, Salt Shield allows you to get rid of margin calls and not have a risk of liquidation while you're enrolled in the program. And we were talking about a little bit beforehand. Essentially, we lend you the Bitcoin to ensure your Bitcoin stays your Bitcoin and you're able to manage the loan on the term. So essentially giving you a little breathing room to continue to make payments, have access to the capital, but not risk losing the assets.
Is there a scale limit to that? Like, can a company theoretically, borrow $100 million and then get protection on that?
We haven't hit a scale limit yet.
Okay, great. Okay, Wyatt, I'm going to pass it over to you. We've chatted a little bit. You've got the wealth management business, and you're working on some things behind the scenes. What are you seeing? Like, what are clients asking for? Are people seeing the productivity of Bitcoin? Is that in the conversation?
Yeah, absolutely. We have a lot of client interest when it comes to borrowing against their Bitcoin, and we really kind of frame this in the context of Bitcoin acquisition and utilization strategy. So how do we make our Bitcoin work for us? How can we acquire more Bitcoin? And obviously, a lot of our clients don't want to sell their Bitcoin, so we leverage existing loan services and originators like Salt to find good terms and do that. And it's a lot of education process, and we have to work with clients to understand their term limits, their interest rate payments, how interest gets paid back, how their Bitcoin is custodied. We work very closely with different partners to make sure our clients' Bitcoin is secured properly. And then also when it comes to interest rates and making sure we have additional Bitcoin available to top off and not loaning against or borrowing against our entire stack in case of market downturns and we need to top off that loan. So I'm really excited about this industry. It's one of the most bullish subsects of Bitcoin financial services that I see. I see a tremendous amount of professionalism coming out of new players or existing players in the space. I think we've really kind of been burned by hypothecation of the past and learned our lessons. So I think the industry is growing and moving in a great direction.
Great. Russ, I'll pass it over to you just to give an example of what you're seeing in your jurisdiction, how you're viewing the options that are available for your company to manage your Bitcoin treasury.
Yeah, so we have a stack of about 42 Bitcoin so far and continue to stack. And at this point, that Bitcoin is parked, right? We aren't looking to leverage that or to get yield off of that. We've looked at a number of options. There are obviously, players in the more crypto space, the Galaxy Digitals of the world, that have a number of different products that you can borrow against, a stack of Bitcoin. Even, advanced products like zero-cost products, where you have a call or loan, basically a put-call spread that costs you nothing to borrow against. Obviously comes with its own risks, where you may then have capped your upside. But we are looking at things like that, and I think, from what I can tell with most of the Bitcoin treasury companies globally, I'm not seeing a lot of that. I'm not seeing a lot of the treasury companies looking to generate a yield off of their Bitcoin, right? So, just talking, with Hunter earlier, I understood that they're giving a 4% yield, for example, if you're able to lend Bitcoin to their platform. So, I think as this whole space evolves, and I heard it in the last talk that we're kind of in the inning 2 of Bitcoin treasury companies. I think we're going to see a lot more of this, where corporates are looking to take advantage of their stack of Bitcoin, which is obviously an incredible asset. And so, I think I'll leave it there. I think there's some other things that we can also dig into in terms of how to look at using derivatives as well.
Yeah. So you've got these large publicly traded companies that have some of the biggest stacks of Bitcoin, and I think one of the biggest challenges as these publicly traded companies is if you lose the Bitcoin, you have pie on your face. Your public equity gets hammered and smashed, and that may be a sentiment crusher for the long term, and that makes the equation is really challenging. Like Hunter, I think you were saying, it makes it almost like a family office. You're incredibly risk averse. You can't lose the Bitcoin, so you have to be incredibly conscious of risk and risk management and how you are managing the risk. So, one of the questions and focus points that I have is, what is risk? Like, what is digital risk? And in my mind, it's really managing the volatility over a specific time horizon, which is what we're all doing inherently. And so maybe, Hunter, I'll pass it back to you. And how is your company viewing risk and capital, and how the conversations go when you are talking to external capital about taking on the other side of the transaction?
Yeah, I think the concept of risk is really starting to change, and I would put it into 3 buckets. One is going to be the risk due to the volatility of the market, which would trigger the margin calls, trigger liquidation, and how can you protect people? So, products like Salt Shield and stabilization help do that. We are excited by that. There's more capital providers wanting to come into the market. That is allowing us to offer longer term loans. We introduced 3 and 5 year loan terms recently, and that length of time with a Bitcoin-backed loan provides a lot of resiliency. It allows, especially paired with Salt Shield, allows people time to recover. It allows people time to manage their loan without sort of the short time frame that exists. And so I think there's new and innovative products that are coming to the market to help companies tap into the value that they've accumulated in the assets on their balance sheet, which I think, to what Wyatt was saying, is really one of the new things that's coming to the market with Bitcoin, as Bitcoin being part of a treasury strategy, a proactive treasury strategy that I don't think has necessarily existed in as many businesses historically.
Yeah, and I think you also made a good point earlier, is that this opportunity shifts in marketplaces too, right? That you're seeing this could be incredibly valuable for a small to medium enterprise that maybe has 1 or 2 Bitcoin on their balance sheet, and they're looking to unlock liquidity in a difficult time for their business if they want to continue operating into the future. So there's a significant opportunity for different market sectors.
It does. It really, the way people want to tap into the value, whether it's operational cost resiliency in terms of making payroll or strategic investment, both of which, as you accumulate Bitcoin, you're diversifying away from a fiat currency and creating more flexibility with your balance sheet.
Makes what we're doing here incredibly more valuable, right? The more people that we talk about putting Bitcoin on your balance sheet, even if you're a small, medium enterprise, it can be really valuable. You get access to different types of instruments that can give you access to liquidity. So, Wyatt, I'm curious. I know you're talking with a lot of capital providers, a wealth manager, and I know you're working on some things in the background. How are these conversations going with different capital providers when you're talking about lending products? Like in my mind, that side of the equation is incredibly difficult. Like trying to go get somebody to take the dollar side of this trade is a difficult transaction. So can you provide some perspective and light on that?
Yeah, well, it's a really interesting point, Jeff, because one of the things I like most about Bitcoin collateralized loans is it's really an old structure that is being applied to something new. It's like over collateralized loans used to be the standard, and then our monetary system got so prolificated by fiat, then you just have credit cards, a proliferation of credit cards are just unsecured debt. So we're really applying and taking like this old structure and applying it to Bitcoin. And it's very hard to find an LTV, 50% LTV, like anywhere in the market. As far as I'm concerned, like that really only exists in Bitcoin. And so it provides a very attractive risk-adjusted return profile. And I really kind of phrase this in the terms of diversifying within Bitcoin, so we can take like a loan and then derive an interest rate off of it. And I think we're kind of playing in a new emerging market, which exists for a finite period of time between Bitcoin's store of value to medium exchange currency maturation cycle, and it's this fiat return on Bitcoin exposure. And so if you can take a loan and generate interest and pay that out in dollars, you're able to kind of financially engineer Bitcoin to target a certain return profile that is very appealing to a lot of different fixed income investors. And so I'm really excited. Debt is obviously core financial infrastructure, and the fact that Bitcoin is getting integrated into debt markets, I think, is a very bullish thing.
Yeah, for me, the hardest part of that concept, right, is you got to go convince a capital provider to basically underwrite Bitcoin. Right, so you got to go convince them to underwrite Bitcoin, and then if you actually convince them to do all the work and underwrite the Bitcoin, the logical answer sometimes is, I should just buy the Bitcoin. I should just not take on this fiat risk. So it's an interesting market dynamic, a push-pull, operating a fiat instrument in a fiat world and then backed by Bitcoin. So it's tricky. It's a tricky market. And Russ, I'll pass it over to you. I think you've been exploring and considering derivatives transactions. I know we get launched them all the time. There are people coming to tell us like, hey, do this product, and 99.9% of the time it's no. But can you shed some light into what you're seeing and what's, I guess, maybe the most appealing in the market from what you've seen?
Yeah, and I think you nailed it when you said, you don't want to be in a position where you're selling your Bitcoin. So for us, what that means on the derivatives front is put selling, right? It is the most obvious strategy, I think, for any person or firm that is interested in getting hit on lower level priced Bitcoin. Meanwhile, if you're selling out of the money puts, you're generating a new revenue stream. So Metaplanet obviously pioneered this in the Asian markets and has, I believe the huge majority, significant majority of their revenues comes from a put selling strategy. And so we are just kicking off that process at Moon Inc. as well, where we are looking to sell kind of ladder structures where you're selling, let's say, a near the money put, and then an out of the money put, and then a deep out of the money put. And so what this does is it obviously can generate fairly significant on an annualized basis revenue stream. And most of the time you're not getting exercised or assigned the actual Bitcoin, but when you do get assigned the Bitcoin, it's obviously at a lower price point than if you would have gone and bought in the spot market when you structured that derivative. So for us, this strategy makes sense. We have an operating business, but we're also very keen on building up Bitcoin-centric revenue streams. And so we have a new Bitcoin product that we've launched, and this will be just yet another revenue stream that's a Bitcoin-centric revenue stream that kind of moves us away or diversifies us away from our telecoms business. So I actually think a lot of the Bitcoin treasury companies should be looking at this. The short put strategy to me is a really easy way to generate what we would call almost like free income, and when you do get exercised, you're long Bitcoin. So the only obvious opportunity cost is that you didn't buy the Bitcoin, and if Bitcoin takes off and goes to the moon, then you own less. So, but outside of that, I think in markets like this where there's a lot of chop, we've been sideways and quite volatile for some time now. It's a very, very good marketplace because of the high implied vols that are in the marketplace to capitalize on a strategy like that.
Yeah, the derivatives market's really interesting. I mean, it's the Bitcoin derivatives market is about $100 billion of average daily trading volume, so it's nearly double the size of the Bitcoin daily trading volume. So the opportunities are boundless, and it's getting even larger with IBIT options that it gives you more access to different instruments. And that concept, especially for an operating business that's bringing in significant cash flow, that concept of selling cash secured puts starts to become really appealing. If you're going to buy the Bitcoin anyway, you can kind of increase that revenue and amplify that potential exposure. But one of the biggest drawbacks of, let's say, covered call selling, if you're a publicly traded company and you're looking to sell covered calls on your Bitcoin, that is a volatility dampening exercise. So if the purpose of your common equity is to provide amplified Bitcoin exposure, that starts to become less attractive. And another interesting development, I think, on the horizon here in this lending space is the adoption from banks, large, big institutional banks. Once large institutional banks are able to they can custody Bitcoin now, but once they start entering the scene, these larger corporations with larger Bitcoin balances, if they park Bitcoin there, they may be able to access letters of credit. And right now, if you were to use Bitcoin as collateral in the traditional financial market, it's very challenging, very difficult. You've got to get somebody that may not know anything about Bitcoin to take the other side of the transaction, and they don't want to take on that risk. But when you have this LOC product, effectively the bank is providing a mask for your Bitcoin in the traditional financial market. So to me, this is a large unlock on the horizon, is banks issuing letters of credit backed by Bitcoin that they hold. That way you're able to operate in the traditional markets of posting collateral that the traditional market doesn't know that there's Bitcoin behind it. So we've got about 2 minutes and 50 seconds left here. Let's maybe just pass it around for final thoughts. Anything else you want to chat through?
Yeah, a couple of things just to touch on. I mean, going back to the conversation about where's the risk, for us, when we think about Bitcoin on the balance sheet, right, it's leverage without debt. Companies are accumulating value in Bitcoin and other assets on the balance sheet, and then being able to tap into that really is providing really valuable use cases, whether it's meeting monthly operational expenses or then choosing to invest in capital investment. So it's allowing them to put the capital to work in multiple ways without having to sell the underlying asset. And we've been going around talking to companies globally, and we think that's going to be a real unlock for small and medium-sized businesses to make them more resilient and more sustainable.
Yeah. Excellent. What?
Yeah, two things. So on the fiat side of things, one of the things that I think is very cool and unique when it comes to Bitcoin-backed lending is when these services and originators assign an interest rate to a Bitcoin-backed loan, they're essentially pricing in the volatility of that Bitcoin. And so I think ultimately, over enough period of time, as more competition comes into the space, the interest rate on Bitcoin-backed loans will become the new risk-free rate. I think that will be a more true market-driven signal. And then on the Bitcoin-backed lending side, earning yield on your Bitcoin is almost like one of the oldest scams in the book. And so when you're evaluating these type of opportunities and businesses looking to lend out their Bitcoin, I think it's very important we understand these market dynamics. And in order to generate real yield on Bitcoin, the entire transaction needs to be fully denominated in Bitcoin. You need to lend out your Bitcoin. You need to get paid back in Bitcoin. When you make out that loan, you need to have confidence that you will be able to get paid back in Bitcoin. And that whole thing only works if it's fully denominated in Bitcoin.
Russ?
Yeah, I mean, I think it'll differ from company to company, just because if you're running an operating business versus, let's say, some of these more financial engineering type structures that are really just building on Bitcoin, the operating business also has needs. So as you continually to stack Bitcoin and you eat into what is effectively your treasury, we have built this mantra, in Bitcoin and in corporations as well, that like you do not sell your Bitcoin. And what that means is that you've effectively carved out a piece of your treasury to never be touched. And so it can never be brought back into the business for, let's say, acquisitions, expansions. And so one of the things that we're working on at Moon Inc. is actually almost having like two pools. One is our never touch Bitcoin treasury. And that's what we would have on bitcointreasuries.net, for example. But because we also have Bitcoin-related products that even require us to use the Bitcoin that we're picking out of the market, then we have a separate sort of an operating piece of Bitcoin on our balance sheet. And so I think as long as you're perfectly transparent with the market and with your investors on that strategy, there's no reason why you can't have a fungible piece of Bitcoin on your balance sheet that's used for business purposes. It could be used for derivative purposes. It could be used for loan purposes. And that piece of Bitcoin is more...
State market or the other things in the market is incredibly attractive. And I personally believe that risk is mispriced globally across the equity market and the bond market. And I think that these instruments will become more and more attractive and institutionally adopted when they recognize how much money that they can make in this industry relative to other things. So thank you everybody for listening. Appreciate the time. We'll see you later. How are we feeling out there? Good? It's okay to, thank you. It's okay to respond. Good. All right, we are going to keep things rolling here. By the way, the price of Bitcoin is moving, 91.5, so that's exciting. That's why we're all here. To transition over to our next segment, we have UTXO and Bitwise. They are presenting Investor Day. So they're going to take over this stage for the next couple of hours. And here to take over MC responsibilities, please give it up for UTXO Management's Head of Capital Formation, Lauren Asmus.
Good morning, everybody. So today we're going to talk a little bit about the investment landscape for Bitcoin. And to do that, I'm going to bring up my colleague Shanti, if you want to come join me. Shanti, who leads institutional partnerships at Bitwise. Really excited for the content we're going to have over the next several hours. So I thought for the first few minutes, we'll give a little background on what to expect over the next few hours, and then also a little background on our firm. So maybe Shanti, I'll head it over to you, and you can introduce yourself and talk a little bit about Bitwise.
Thank you, Lauren. Can you guys hear me? I just want to make sure. Great. My name is Shanti. I am VP of Institutional Partnerships at Bitwise Asset Management. Very excited to be here today. Such a beautiful place to be, coming from New York City. It's absolutely freezing. I am sitting on our institutional partnerships team where we connect with family offices and institutions looking to understand the crypto asset class. And Bitwise is a global crypto asset manager. We manage over $15 billion in client assets today across ETFs, SMAs, hedge fund strategies, and institutional grade staking solutions. We are very excited. It's been a monumental year for Bitcoin, and we have seen the adoption from institutional investors into our ETPs, and that space just continues to grow. With the sovereign allocations, with hedge funds coming into the space, with endowments and foundations, we're very excited to see where the industry takes us in 2026 and beyond. And most importantly, we're here to connect. We want to meet with you all and grow lasting relationships. And we're excited to continue to have conversations and see where the conference takes us. So thank you.
Yep, no thanks, Shanti. And same here on the UTXO side. We're very, very excited to be here. And so for a quick background, UTXO Management, we're the asset management arm, or sister company, you should say, of BTC Inc. So the group that runs this conference, Bitcoin Magazine. We run a hedge fund, discretionary event-driven hedge fund focused solely on the Bitcoin ecosystem. And so today you're going to hear from our CIO, you're going to hear from portfolio companies, you're going to hear from investors and allocators on how they think about Bitcoin as a capital asset and as an investment asset. And so without further ado, I think we can get right into the content. And so our first panel is going to be about opportunities within Bitcoin and just how to think about it at a very large scale. And so I'd like to welcome to the stage, well, actually, we'll wait a few minutes. I think we're waiting for one more panel, so I'll keep talking about perhaps more about UTXO, and Shanti, if you want to add anything more about Bitwise, about what you're focused on. I think from the UTXO perspective, we've been very big into the Bitcoin treasury company space. So that's a lot of what you'll hear today is some of these CEOs, Bitcoin strategists talking about where the opportunity is. And actually, I just got the word that we have everybody here. So let's go ahead and get this party started. And so I'd like to introduce to the stage our moderator, who's head of institutional partnerships at Bitwise, Brian Raimondi, Duke Waldrop, who is an analyst at UTXO, Hong Kim, who is the co-founder and CTO at Bitwise, and Katie Stockton, who's the founder and managing partner at Fairlead Strategies. Please give it up for our panelists. Thank you.
Thanks, Lauren. Appreciate it. Hello, everyone. I guess we'll do this standing because it would be weird if two of us sat and two of us stood. Everyone, please join. And we have 4 mics. Please go on and grab your mics. I'm Brian Raimondi. I'm the head of institutional partnerships at Bitwise. I could not give a better introduction than my colleague Shanti just gave, and that's enough on Bitwise for now. What we're here to talk about, what we're all thinking about, is Bitcoin as a generational investment. Of course, if we're all here, we believe that Bitcoin is a generational investment, but at Bitwise, we speak to professional investors all day, be it private banks, hedge funds, sovereign wealth funds, family offices, endowments, foundations. The list continues to grow. And we find that all of these investors think about the asset and the token and the technology a little bit differently. So we'll talk about some of those nuances today. And our panelists here have our esteemed group of panelists here. And here are the 4 chairs. Everyone feel free to take a seat. All have very different vantage points on the industry, on the asset. So we'll get into those quickly. Handing it over to Hong to give an introduction of himself, our co-founder and CTO.
Hello, great to see everyone. Co-founder and CTO at Bitwise. Started the company with my co-founder Hunter about 8-9 years ago, and we've been building a global asset manager in this space for that time. We manage about $15 billion in client assets across ETPs and hedge fund solutions and staking solutions and about 40 different products. And we're primarily in the US and Europe and increasingly trying to explore other markets as well.
Awesome. Thanks, Hong.
Hello, everyone. My name is Duke Waldrop, and I work for UTXO. I've been in the Bitcoin space for about 6.5 years now. As Lauren mentioned, UTXO is the asset management arm of BTC Inc., and we invest in Bitcoin financial solutions across the entire ecosystem.
Thank you. Hi, everyone. I'm Katie Stockton. My firm is called Fairlead Strategies. We're based in Connecticut, and we do technical analysis research, and we've been publishing on cryptocurrencies, Bitcoin, Ether, and others since about 2019. We manage an ETF called the Fairlead Tactical Sector ETF. That's a U.S. equity ETF. TACK is the ticker for that. And I'm also a CNBC U.S. contributor.
Thanks, Katie. I wasn't sure on our prep call how I knew Katie. I thought we'd met already, and then I realized she's, I think, on a weekly basis featured on CNBC running through these technicals. So very excited to have Katie here today.
Glad to be here.
Yeah. Okay, so let's start sort of at the top. Bitcoin as a generational investment opportunity is something that can get tossed around like hyperbole, I think. But again, if we're here, we all believe that is the case. So maybe we can break it down sort of from a practical standpoint, instead of just saying it is because it is. I'm curious from these investors, builders, how they think about Bitcoin as a generational investment opportunity, less tactically, more as a sort of structurally durable asset. So would love to hear from each of you on that. I think Katie has a slide we'll pull up. In the meantime, maybe Hong will kick it off for us. Oh, is this?
Yeah. Okay.
Yeah.
Great. From a technical standpoint, Bitcoin. I think we often talk about Bitcoin as an asset and a technology, but sometimes it's worth thinking about Bitcoin as really an invention. And I think that sometimes convinces people that there is something materially different in Bitcoin. And the main way to think about it as an invention is that before Bitcoin, computers did not have assets that were native to the environment. So we can pass over a dollar bill or money or gold, but we really did not have a way to pass over actual assets inside of a computer or over the internet. And Bitcoin represents the invention of that becoming possible. And it's worth thinking about that in those terms because that really is something structurally different. And we're just seeing how that has played out for the past 15 plus years. And I think that the ramifications of computers having actually native assets is just beginning.
Love that.
Yeah, I think for me, Bitcoin, the huge wake-up call was 2020 COVID, as I imagine a lot of people in this room kind of got introduced to it. The Fed printing $3.2 trillion in the span of 2 years. There's definitely going to be some byproducts of that. Effectively, 40% of the M2 money supply was, in 2 years. So for me, that was kind of one of the main points where I looked back and was like, okay, all this hard work that I'm putting in to earn US dollars is getting devalued overnight by someone that can just turn on a printer and print as much as they want. So yeah, I think that was kind of one of my main wake-up calls in 2020 was just really experiencing the devaluing of our own dollar. And it's something that my kids will have to really bear the byproducts of.
Yeah, so the way I look at Bitcoin is as a new asset class and as an investment opportunity that is generational by all means. I think the early stages, there wasn't the best understanding necessarily, and I can't say I'm the one that has the best understanding, but I do understand it as an investment and as an asset class. It is a trending instrument just like all assets, and here's my chart. So this is the way I look at the world. This is a Bitcoin monthly chart, and you can see over time that it has stair-stepped higher. And that's important because that shows the potential. It also shows the volatility. You can see that the stairs can be quite steep, And yet that's opportunity in and of itself, right? So we can look at the asset class from a momentum perspective, looking at it from a risk management perspective, because while it's a nice idea to buy and hold indefinitely, some people can't afford the drawdowns that Bitcoin has, and of course some of the altcoins as well. So we're there to help people navigate through these trends and through the inevitable short-term swings within that context. So we see it as a generational investment opportunity and new asset class.
Wonderful. Thank you, Katie. And thank you for putting up this fantastic slide. So we've established Bitcoin as a generational opportunity. Now we need to think about how it's practically applied to portfolios, specifically by institutions. I will say, having sat in this role for 5 years and going to endless crypto and Bitcoin conferences, there was this, the institutions are coming sort of mantra that was thrown around like, for lack of a better term, hopium for years. And that all seemed to change in January 2024 when the Bitcoin ETFs became available for private banks, for financial advisors, for my parents who aren't comfortable with anything other than a 1940 Act ETF to allocate in their portfolios, whether it be a retirement portfolio, an institutional allocation, et cetera. So now that we've sort of seen this incredible step up in institutional adoption from sovereigns, from private banks, from the wirehouses, from hedge funds, I'm curious to hear from these panelists where the next leg of adoption might take place. And what that could look like. Specifically, are we still in the early adoption phase of Bitcoin, or is this sort of a mid to late stage cycle for that mainstream adoption? Katie, why don't you take this one?
Yeah, I would say we're still early innings. It feels like an emerging trend, and I'm talking about a secular trend, not a cyclical one. So I'm really excited about the upside from here. We don't really have a way to get an upside objective necessarily from the way that the trend sets up at this time. But I think we see the trend, we see the uptrend, and what we've also seen is the liquidity, sort of the global liquidity behind cryptocurrencies, especially Bitcoin, makes it a very viable asset class for everyone from the biggest institutions down to the smallest retail investor. So I look at it from almost a liquidity perspective. And when I evaluate the charts and the trading, to me, it acts very much like another currency. So, you can look at it in the same way that you would look at the dollar, you'd look at crude oil prices. So we feel that the chart is very, reliable because it is so liquid and it is global. And in that way, the support and resistance levels are very reliable on the chart, and that helps us manage risk. So we think it's a great asset class for everyone, and that more and more in terms of the adoption, we've already seen very good trends there as well. And I always said that once we have that institutional adoption, I think that's where the liquidity gets even better. So I think we're almost already there already there, but I think it's only going to get better.
It is indeed still early, is what we're saying.
Yeah, I'll add on to that a little bit. Just for reference, 2024, BlackRock, as we all know, launched their ETF, and within 2 years, they've already got $60 billion worth of assets under management. And their gold ETF took 19 years to get to $33 billion worth of assets under management. So we're definitely no longer in the speculative asset world. It's becoming institutionalized, and the rails are being laid. But kind of echoing Katie's point, it's just more of a capital inflow that we haven't seen at a scale that is definitely out there, and it's going to come, but we're still very early.
100%. I can also add a few stats just internally. From Bitwise, we've seen a number of large unlocks just in the past 3 weeks. So all of the US wirehouses, so Morgan, UBS, Wells, et cetera, have now approved some sort of Bitcoin or Bitcoin adjacent exposure for all of their clients. So these are financial advisors that are able to now solicit Bitcoin ETFs to their high net worth clients. This is over 13 trillion in assets collectively across these four firms. So very exciting. Of course, we continue to see sovereign adoption, principally right here in the UAE, where we've seen on the 13F disclosures that some of the sovereign wealth funds here have made considerable allocations, small relative to their overall pie, but large when it comes to just the institutional adoption that we need to see to continue to drive what we think will be a generational investment. So would just add that. All right, so we've established that there is this institutional adoption happening. We've established it's still early. I think it's important to think about why these investors are making these allocations. So maybe I'll turn back to the panel. Do you view Bitcoin more as, call it like a macro store of value hedge? That's of course been the dominating narrative recently. Or is it more of a venture asymmetric technology bet? Is it something else, something new, novel entirely? Maybe back to Katie for this one.
You know, as a hedge, it's a pretty dicey hedge, at least the way I think about things. So I think the volatility is such that as much as folks can treat it as a store of value, it's a very volatile one. So in that sense, it's not a traditional hedge like you might think of gold for one. So I do feel like it's more opportunistic in the way that we're recommending it, but we're big believers in having a small piece of a portfolio dedicated to cryptocurrency investments. We also think that it's very important to be tactical, so not necessarily the long-term buy and hold, but to try to take advantage of the volatility and treat it as an opportunistic investment. Ideally, something that you can hold indefinitely, but we all know that, again, that momentum shifts are pretty real. In fact, you saw on the chart that there is a downside momentum shift that I think will probably make it a little bit harder to benefit from the secular uptrend, meaning that this kind of cyclical down move is something that could stay with Bitcoin some time. So I think we have to be somewhat tactical, treat it opportunistically for now, and ideally it becomes something that is a bit less volatile and becomes that store of value.
Thank you. All right, so we've talked about adoption. We've talked about why we're underwriting Bitcoin as an asset class. We'd be irresponsible to not talk about risks, of which, of course, there are always risks with anything in life, including Bitcoin. Hong, maybe this is an interesting one for you. How would you think about being the operator and founder of a large business that's made it through multiple cycles, looking out 5-10 years over the next cycle, 2 or 3, what do you think is the biggest risk to Bitcoin, be it quantum, competition with, dare I say the Q word, competition with other chains, regulatory, anything else?
Yeah, absolutely. So Bitwise does a survey of financial advisors in the US every year, and we've been doing that for this 6 or 7 years in a row. And the top risk that advisors had repeatedly said was the most concerning risk for them was the same for all those years. And number one was always regulatory risk. So at least for investors, what was top of mind every year since Bitwise has started was regulatory risk. And I think it's worth really recognizing that probably last year and this year is really when we turned the corner on that. It's still probably what people still think of in top of mind for traditional investors and professional investors. But we're no longer the point where we're talking about whether this is illegal or drug money or it's going to be banned by governments tomorrow. So I think that part of the risk has been meaningfully de-risked, and it's worth celebrating that the risk that was the top risk for investors' minds have really made a big progress on. I think that's probably why new risks that were further out in the risk curve is becoming more top of mind for investors. And quantum is something that a lot of investors are thinking about these days. But I will say it is at the point where the technical community, the core devs or developers or cryptographers in the community are starting to think of it as a risk that we should be thinking about in a 5, 10, 15-year term, not something that we're turning around and say, if we don't have a solution by tomorrow, then Bitcoin as an asset is at risk.
Which is a feat in itself versus what we've dealt with over the past few years.
Yes. I think it's worth recognizing that really the reason the quantum risk is at the forefront is because we've made a lot of progress on other things. So yeah.
Yeah, totally agree. Do we have time for another question or two? I think so. We'll run through these quickly, but fast forward 5 years. What single development most accelerates Bitcoin's adoption into global portfolios? I'm not going to give any leads on this one. On organic answers only.
Yeah, I think my opinion here is the fixed income markets. We've seen Saylor kind of pioneer this year with the preferred stocks that he's issued. There's trillions of dollars in money, pension funds, retirement funds, income funds that's sitting out there, and they've been sidelined and been unable to buy Bitcoin. I think that bid is definitely going to be there. And again, I think Saylor will continue to issue these. I don't know if they'll all work out, but there'll be other people that will come into the space and issue similar preferred. So I think that once that happens, there will be a large amount of capital that will flood the gates, and it will be probably the catalyst to the next cycle.
I would agree, actually. I think it's all about the larger institutions in the U.S. picking up this, small position, because if you just think of how exponential that would be in terms of an investment, but also a vote of confidence, and that vote of confidence would sort of trickle through the investment community. And then platform access, as somebody who traffics in public investments primarily, platform access is a big thing. So more and more to see these platforms, these big wirehouses picking up, Bitcoin as a viable asset class, I think that's going to change things. And wealth managers, heard from one earlier, are going to have to educate themselves, and it's great.
Definitely. Any thoughts from you, Hung?
Yeah, so I think it's worth thinking about last year, January, as Bitcoin's IPO moment. So when Bitcoin ETFs launched, finally you could buy Bitcoin in public markets, exchanges, brokerages, really everyone. And gold, an asset that has been around forever, had its IPO moment. GLD launched in 2003, and you would have thought that if people were waiting to buy gold in an ETF format, that they would have bought that immediately. And it was a record year, first year, $2 billion in inflows. But the thing that people miss about the GLD moment, it was the most historical kind of successful launch in history in ETFs, is that the following year, there were $3 billion in inflows. And in the following year, there was $5 billion in inflows. And then after that, it was $7 billion. The GLD had higher annual inflows for the first 7 years of its history. And so I think even this, I think people think of the kind of Bitcoin's public market moment as something that has come and passed, and we're thinking about kind of next catalysts. But I think the thing worth thinking about is that usually the public market opportunity takes about a decade to play out. And we're in the first innings of that. And so you can't buy Bitcoin ETFs in the largest banks and broker-dealers at the moment. We're talking about approvals happening in the coming months. But really, we've just seen the kind of the retail, I can buy it in Robinhood type of exposure, and Schwab and Fidelity. But the truly kind of institutional and professional investors and wealth managers are just at the beginning of the adoption curve. And I think we're about to see the actual floodgates kind of land in the coming years.
Absolutely. I think we're at time. We did not prepare for this question. No pressure if you do not want to answer this question. Of course, I'm going to ask you what your 2026 price target is.
I guess
on
that's
behalf
on
of
me.
all of you.
Yeah. I'm not going to pull a Tom Lee moment here. But you
Fair
can
enough.
see from the chart, listen, the trend is higher overall. That's a secular uptrend. I do think 2026 will be a bit more of a range-bound year. So we just went from a bullish long-term outlook, having been there for some time, to a neutral outlook, and that's simply because of that loss of momentum that we've seen. We had our long-term momentum gauges were on buy signals for more than 2.5 years until very recently. So that was meaningful to us. It doesn't mean we enter in any kind of crypto winter, but it does mean it'll be maybe more of a range-bound start to 2026. We cannot predict where Bitcoin will be, nor can anyone, really. But what we can do is try to keep those trends on our side. Right now, we actually have short-term oversold indications. So we even had our first buy signal on one of our models that we'd had since 22. So for now, we're looking for an up move, but that's an up move that might meet some resistance below the recent highs.
Thank you.
Yeah, I'll second a lot of what Katie said. I think Q1, I see a little bit of ranging, and then maybe by Q2 we get back up to the 120s. But again, arbitrary. We don't really know anything. We don't have the magic crystal ball here. We're all speculating.
I might be the most bullish on this panel.
Let's go.
I think people have expected the 4-year cycle, and I think and that 4-year cycle says that this year is an up year and next year is a down year. I think people kind of front-running that expectation has really created markets to pull forward, and this year might be a small down year. And I think next year we've saved up all this energy. We made so much progress in this administration and this year in terms of Bitcoin as an asset, and that hasn't really reflected in its price. And I think that energy has been stored up, and next year I would expect us to have a big up year, 200K. I don't know.
Sounds like a generational investment to me. Thank you all for your time. Thank our esteemed panelists here. Had a lot of fun.
Thank you.
Okay, we're going to get started again. We are well ahead of schedule. So if plenty of seats up here if anyone wants to come up and take a seat and have a listen, but we'll start with our next panel. It's Unlocking Bitcoin Treasury Company Opportunities. Our panel today includes Tyler Evans, he's CIO of UTXO, John Riggins, CEO of Moon Inc., based out in Hong Kong, and then Mason Ford, who is head of Bitcoin strategy at Mailuse in Brazil. Welcome to the stage. Thanks for joining, guys. So I think it's good to level set, right? So we're talking, this is Investor Day, we're talking about the investment case for Bitcoin, and then as a corollary, investment case for Bitcoin treasury companies. So maybe just to level set, what is a Bitcoin treasury company? I'm sure we're going to hear, the audience here is going to hear a lot about that over the next several days, but in your definition, how would you define a Bitcoin treasury company, and why does it make sense to have one? Maybe John, start with you.
Sure. Yeah, I think that's going to be something that everyone answers. But from my perspective, running a company in Hong Kong, a Bitcoin treasury company in that market, is a company with a long-term strategy to accumulate Bitcoin permanent capital for its balance sheet, alongside an operating business that hopefully is also generating some income in Bitcoin, and then using that Bitcoin as Bitcoin becomes a more important part of the capital markets all over the world in the long term, in different ways to generate income, to serve other companies in the market that can use that Bitcoin to be prepared for that world at the end of the day. So that's what we're working on in Hong Kong at Moon. It's all about accumulating Bitcoin.
Mason, you want to go next?
Yeah. I think there's two different types of Bitcoin treasury companies, and they're both trying to achieve the same goal, which is increased Bitcoin per share. The first would be a pure play Bitcoin treasury company, which is issuing debt on their Bitcoin. This is Strategy, this is Strive, this is MetaPlanet. They offer perpetual preferreds, and really their main offering is debt. And then there's companies who have a Bitcoin treasury company, right? So Bitcoin treasury company, and then companies who have a Bitcoin treasury company, and that's what That's what Meluse, the company that I'm with, we have an operating business that's profitable, and we are sweeping long-term capital into Bitcoin, and we are denominating our success in terms of Bitcoin.
I'm glad you went next, because I think that's a really important distinction. And ultimately, we can talk about like Bitcoin per share or Bitcoin balance sheet being like the measure of a Bitcoin treasury company. But I think what you touched on is kind of like the fundamental premise, which is very much a philosophical one. It's like having Bitcoin be your hurdle rate or your value capture. And if you think about the role of a company, it's to have a going concern that generates income that accretes to shareholders. And so if you take that and now apply it with a Bitcoin lens as Bitcoin as your monetary asset, it's the role of a company is to grow and accrete value, generate income, whether that's from selling financial products or running a more traditional operating business, a software business that generates value for your shareholders now in the form of Bitcoin. And today, Bitcoin treasury companies are primarily trying to grow the largest balance sheet of Bitcoin, which lets you sell more financial products around that. But I think eventually we'll see a future where companies are trying to pay dividends in Bitcoin or trying to actively generate more Bitcoin for their shareholders. And that's like the fundamental assumption of a Bitcoin treasury company and its value in a long-term hyper-Bitcoinized future.
Yeah, maybe to that point, Tyler, I mean, a lot has changed in the landscape since UTXO made an initial investment in MetaPlanet almost a year and a half ago now, right? It's just been a Cambrian explosion of this investment thesis. What are the appropriate financial metrics to look at and to evaluate these companies? You talk to kind of the beginning stages of this, right? People were talking a lot about Bitcoin per share, MNAV, premier discounts, months to cover. Obviously, a lot has evolved over the last 4 months, just to put it lightly. But what are the key metrics that investors should think about when they're evaluating these treasury companies?
Well, I think Bitcoin per share is a very important one. Ultimately, it's about it's about measuring a couple different factors, like how the company is accreting value in Bitcoin for its shareholders on a non-dilutive basis, which is like the Bitcoin per share metric, and then it's the measurements of like the velocity of that accretion, which translates into MNAV or translates into kind of the enterprise value premium. I do think like looking at that on an enterprise value basis for these companies is the best lens to apply, because there's so many different capital structures or debt structures, or if you got preferred equities outstanding, like there's a lot of ways to create leverage in the system. And so that's the kind of the key metrics we try to look at as investors, understanding the steady state of the company and then how it can amplify that with leverage, with issuing convertible debt or pref dividends against its Bitcoin to increase the momentum of that accumulation.
And I guess, John or Mason, what have you heard from investors that you've talked with at the company level of either just questions that are asked on a more common basis or just things that investors are looking for? Is there anything that really stands out?
Yeah, I think probably the most common question is, why are we investing in your company versus just buying spot Bitcoin? And I think Tyler touched on some of those reasons in the long term why an investor would do that. Of course, I always think it's good to have a bucket of Bitcoin, before you're starting to play in Bitcoin treasury company stocks if you're an individual investor. But there are large buckets of investors out there who can only play in regulated capital markets, especially in kind of the market that we're in. And so having that conversation about why Moon is the best way to get exposure to Bitcoin, how we're accumulating Bitcoin over the long term, those are kind of the most common conversations that we have.
Yeah, I think conversations about general strategy and general risk tolerance are very constructive and important to have. There's many different strategies you theoretically could do, and they have different risk-adjusted returns. For example, you could take a margin loan against your Bitcoin, but that comes with tremendous risk. So having conversations around what is our strategy to sustainably accumulate Bitcoin for the long term is really what we're focused on. And then, of course, why should we invest in a Bitcoin treasury company beyond Bitcoin? And my answer to that is, I think we're in a new world where people are using Bitcoin as their unit of account. I know that I am personally. I'm sure many of us are. And in that world, Bitcoin savings and then anything in which you are taking counterparty risk would then be an investment, right? And I truly think Bitcoin treasury companies or companies who are using Bitcoin as a unit of account are kind of at the forefront of this new world of investing, which is completely brand new, and it requires a fundamental mindset switch and a view of the world. Bitcoin is the hurdle rate, and that is what we can provide. And actually, being a small company with a, we have around 605 Bitcoin right now, and we have significant cash flow. And if you look at our valuation of those cash flows, we're valued pretty close to our Bitcoin, and we have a small amount of cash for our operating business. There's potentially tremendous Bitcoin yield within our company and many other companies who have operating businesses or are doing the debt strategy. So that's why, from my standpoint, an investor would potentially invest in a Bitcoin treasury company and pursue that form of investment.
I think you touched on really the key thing there, like the differentiation from just buying spot Bitcoin. Like if you buy a Bitcoin ETF, you actually have slightly less Bitcoin per share every year because of the management fees, the custody fees that are baked into that product. When you're investing in Melius or a Bitcoin treasury company, you're taking the bet on a company that's going to grow that Bitcoin per share over time, whether it's from operating cash flow or from their financial engineering products, debt issuance, et cetera. And so it's taking a bet on the future value of Bitcoin that company will be able to accumulate, and especially using all the different levers that a company has access to that a corporate can do that I can't do as an individual, such as issuing no recourse debt into public markets.
Yeah, exactly. And I think you're also, if you have a long enough time horizon, you're looking at the potential future optionality that a business with a significant amount of Bitcoin will have in the future in a world of AI, where I think Bitcoin is becoming increasingly important as a physical, a link to the physical world in the digital realm.
So we've established that Bitcoin per share is really the key metric, right? That's why you invest in a Bitcoin treasury company, because you, as a shareholder, want more Bitcoin tomorrow than you do today. How do companies, from this point forward, or it'd be great to, Mason, John, to hear your perspectives from your individual companies that you work with. How do we grow Bitcoin per share? Obviously, previous 12 months, a lot of these stocks are trading at a premium. You could hit the equity ATM, dilute, and you're accreting Bitcoin per share. Now, a lot of Bitcoin treasury companies, most are trading at a 1x MNAV, which is just the enterprise value of the company to its underlying Bitcoin holdings, or below a 1x MNAV. So I guess in this new paradigm environment, how do companies differentiate themselves and grow Bitcoin per share?
Yeah, so really just the one lever that you lose there, if you're trading at a 1x MNAV, is hitting that ATM consistently. You still have a ton of other levers that you can pull. In Hong Kong, specific to kind of the regulatory environment for the Hong Kong exchange, the ATM was never kind of the best way for us to do that anyway. And so for us, as we look to grow Bitcoin per share, it's about how we're fundraising, how we're hitting specifically kind of the debt markets in Hong Kong, which there's a lot of demand for, and is actually a good way to access capital from mainland China. And so doing that in a way that's long-term accretive to Bitcoin per share, but is also safe, and that you're not just taking margin on the Bitcoin stack that you have. You're operating within sort of an understood debt to equity structure that investors are comfortable with, and adding Bitcoin consistently that way. That's something we're focused on, along with having a Bitcoin business line that's adding Bitcoin to the company's treasury alongside other capital markets kind of strategies that we have.
Yeah, our main strategy right now is using our cash flow to, one, buy Bitcoin or buy our stock back at a discount. We also have a derivative strategy where we are selling puts on Bitcoin, but it's relatively minor. And I heard that you guys are doing that as well at Moon Inc. And I think that's a super interesting strategy. I think, I talked about Bitcoin Treasury Company and then a company holding a Bitcoin Treasury. I think we aspire to issue debt one day. I think we are very much a product of the environment in which we are living in, which is Brazil, which is a very high cost of capital environment, currently 15%. But you have to put that in relation to the real, which since 2020, the M2 growth has been at 20%, right? So 15% sounds high, but in real terms, you're probably negative 5%, right? But for your average investor or maybe your normie, 15% looks pretty lucrative if you're thinking in fiat terms, and maybe you don't understand how inflation really works. So I think it's just I think globally interest rates are going to come down. I think we have a lot of education to do, and we are in the meantime building our collateral base to hopefully one day issue debt.
Well, let's pull on that thread some more, because I think that really is the next phase going into next year is debt, right? You hear Michael Saylor talk about digital credit, which I'm sure he'll talk a lot about later today in a few hours on the stage. But what does digital credit look like for the space going into next year? Maybe Tyler, starting with you, obviously sitting in the UTXO seat, you see a lot of different structures, a lot of different ideas floated about. What's appealing? How do you think this all plays out going into next year?
Well, I think digital credit is very much going to be a narrative we hear a lot more about throughout 2026 in the year ahead. And now we've got, from one issuer in strategy kind of being the pioneer of these products to now three different issuers of digital credit products, 2 in the US, 1 in Japan, many more thinking about it. And ultimately it's about arbitraging the long-term cost of capital in these different currencies in fiat markets with the long-term returns of Bitcoin, and having a perpetual, non-liquidatable, long-duration product to be able to express that bet on a multi-decade timeline. And I think these products are very much in their infancy. We've seen a number of different iterations around convertibility in terms of the rates, in terms of the volatility profile targeted by these digital credit instruments. But ultimately, for these to be very successful, I think we need to grow the investor base and understanding, and really the confidence in the credit product. And if you look at S&P's credit rating of strategy, their analysis leaves out all the key pieces of why Bitcoin investors are attracted to strategy today. And I think that's just part of the learning curve for traditional investors to understand these products. But as they do, I think we'll see the cost of capital for the digital credit products come down significantly in rate terms, where you've got products paying north of 10, 12% today, and mirroring more kind of traditional SOFR overnight Fed funds lending rates, when you have the security of a massive over-collateralization with Bitcoin on these products. And that rate environment coming down will allow the companies to issue a lot more of this type of credit and create credit expansion that ultimately will drive more fiat flows into Bitcoin.
Yeah, in a fiat world, you want a negative you want negative working capital, right? You want to issue debt because you know that that debt in real terms is getting cheaper and cheaper. And especially with the Bitcoin strategy, short fiat, long Bitcoin has been historically the most successful strategy that you could possibly do, and I think it will continue to do that, especially in a world of massive disruption. And I really think that's what these Bitcoin-backed debt instruments represent. Is we are in a world of turbulence, of disruption, and a lot of fiat debt instruments rely on cash flows, either from sovereigns, companies, mortgages, etc. And as those are increasingly unstable, having Bitcoin-backed debt at a substantially higher yield, almost double and then some, is increasingly attractive. And I think as sentiment around Bitcoin, as it becomes a little bit more ingrained into the financial system, into the general zeitgeist, and kind of the 10 years of propaganda that we've had kind of washes away, Bitcoin will kind of be seen as just another asset, and it will become obvious to many institutions, many individuals. And I really view it as a bridge for Bitcoin adoption, right? All that money is coming into Bitcoin, but some people can't handle the short-term volatility, and I think these products are there to meet that demand, and it's the free market in action. There's a lot of criticism from Bitcoiners who are kind of mad that these debt instruments exist, but I just kind of view it as an inevitable transition period and serving the needs of people who maybe can't handle the volatility right now.
I think that's really the key piece, is what these products do is like present a flavor of Bitcoin exposure, but a different risk-reward volatility profile that makes Bitcoin as an asset class attractive to entirely new swaths of capital markets allocators who have a mandate or a risk profile or a liquidity volatility profile that doesn't match spot Bitcoin today, but that could match a convertible preferred product. And so it increases the available capital to flow into these Bitcoin-linked products over time.
I mean, let's take this a step deeper, right? Because I think when you think of traditional debt investors, in my former job, right, it was based on, the cost of capital is based on earnings, cash flows, forward-going concern of the company, where your credit rating is, right? Are you a CCC rated company? Are you a AA rated company? What is the appropriate cost of capital for Bitcoin treasury companies when the underlying asset doesn't produce cash flows and has a 50% historical vol? Like how should investors think about appropriately pricing either the risk of the treasury company or the cost of capital of the debt? I know that's a big question.
Yeah, it's a tough question, but it's also not. I think if you deeply understand Bitcoin and understand its fundamentals and understand the trajectory it is on, I fundamentally view Bitcoin as a risk-off asset that just hasn't been appreciated by the market as that. And as I said, I think that's slowly changing. What I would, instead of looking at Bitcoin specifically, I invite investors to look at everything else. Let's look at junk bonds. Let's look at corporate debt. Let's look at the S&P 500 issuers who aren't the Mag 7. What's happening with them? Let's look at mortgages. Is the ability of people to pay off their mortgages, is that increasing or decreasing? Car payments, etc. So I think the fundamental trade here is Bitcoin is going to increase in value at 30 to 50% over the next 10 to 20 years. And if you can get the cost of capital, or if you can get capital significantly below that, that's a great trade.
Yeah, no, good point. John, I guess from your perspective, where do you see Chinese markets developing within Bitcoin, and also, I guess, related to Bitcoin treasury companies, say over the next 3 to 5 years? I mean, obviously, it could be a very, very big unlock if mainland Chinese investors are able to access Bitcoin vis-a-vis a proxy like Moon Inc. or another option. I guess kind of how do you envision the long-term game as you're building out the Bitcoin ecosystem in China?
Yeah. Well, I think that's still the biggest untapped market that exists in the world when it comes to exposure to Bitcoin. And it's not for a lack of demand, it's just for a lack of options and kind of ability to facilitate flows into a proxy today. And so there are a number of interesting things working on that front. I think that a publicly traded company in Hong Kong is still the best and kind of fastest way for us to kind of back into that exposure. That's what we're focused on. But that demand is certainly there. And so kind of from our perspective, what we're doing is to kind of line up kind of investors who are starting to, mainland investors, helping them get a little bit of exposure with money they have offshore first, and then kind of preparing for that, what we see as an inevitable opening of all capital markets to not just Bitcoin, but treasury companies serving as that proxy for certain investors who need an equity to invest in or need some sort of debt structure to invest in versus spot Bitcoin. And so I think it's pretty clearly the biggest untapped market that exists, and I think it's something that we will continue to see develop and open up over the next cycle, over the next 4 years. So bullish on that happening, and the conversations that we're having in Hong Kong, I think are lead me to believe that the tides will shift in that direction.
That's fantastic. I know we only have a few minutes left here, but audience has probably noticed that we haven't talked about other types of digital asset treasury companies or altcoin. I guess we're all very biased here, but I guess why are Bitcoin treasury companies the signal, and why do you think they have the most long-term value to run the corporate playbook versus other digital assets?
Yeah, the lights dimmed just as you said that. That was a nice effect.
They're shutting us off.
No, I think as we underwrite these things, really it's Bitcoin that uniquely has a value proposition as a monetary asset that has these properties that have made that carry trade against fiat currencies for the last decade such a profitable one, and it's the asset class that truly has now institutional adoption in the form of the ETFs, the Wall Street big banks productizing it and selling it to their clients, and it has that structural bid as it transitions, like you were mentioning, Mason, from a risk-on to a risk-off asset that uniquely makes it suited as a foundational kind of unit of reserve to build a Bitcoin treasury strategy around long-term with its defined monetary properties, which is unique when you look across the whole crypto landscape.
Yeah, quickly, I would point to two things. One, it is filling that role of a digital monetary asset, digital capital, digital property. It's been picked by the market as that role, and I think picking anything else would be foolish. And then I would look at the actual decentralization of the asset, which is far superior than any other crypto. Lastly, I'd look towards proof of work, which is the fundamental driver of Bitcoin energy. There's real energy behind it, and I think that's often lost in the conversation of crypto broadly.
Yep. Well, we're up on our time here, but I want to leave one last question here. What does the Bitcoin treasury company landscape look like in the next 5 years? By 2030, how big is the TAM? How big is the market? How much Bitcoin do treasury companies own? Be great to get, maybe we just go down in line. Great to get your predictions.
Yeah, that's a big $1 trillion question there. I think the next 5 years, I guess I'll speak specifically for Asia. I think that we could see a Metaplanet-sized Bitcoin treasury company in kind of the greater China market. I think in the Korean market, I think that can be replicated, what's happened in Japan and some of these other places. And then overall, globally, I mean, the sky's kind of the limit here. 5 years from now is a long time. We'll see how much debasement really starts to happen once we get a new Fed chair in and some other dominoes that start to fall over the next year even.
For me, I think it's really two big themes we're watching. One is that on the digital credit side, I think in 5 years we have a digital credit product issued against almost every fiat currency in every scalable liquid capital market, whether that's from a company like Strategy issuing a bunch of products in different currencies, or whether that's a local company serving that need. But I think we have digital credit products against all different currency pairs. And the other thing is I think we see a lot more companies that are traditional operating businesses following Meli's footsteps and growing Bitcoin incrementally on their balance sheet. Like we've seen with Tesla, like we see with Block in the US, I think we see a lot more of the tech companies particularly embracing that as the best form of capital preservation.
Yeah, I think it's important to recognize that we're in year one of digital credit. At this time last year, there had been 0 preferreds issued, right? And now I think there's 6 in the market, 5 with or maybe 7, 5 with Strategy, 1 with Strive, and 1 with Metaplanet. 5 years from now, I expect digital, Bitcoin-backed credit to be a relatively more seasoned asset class and maybe start to get some real recognition from institutions. But I do think it will take 5 years of Bitcoin appreciation. And then, and 2 other things. I think general disruption from AI is a huge driver for companies to seek refuge in Bitcoin. And then also, like to quote Luke Roman, nuclear level printing, which I think we are pre-nuclear level printing, and I think 5 years from now we will be post. I think there will be many events of nuclear level printing, but at least in the most recent one or the one that's about to happen.
Yeah, I mean, the one thing I learned coming from the traditional finance side to Bitcoin is you have decades that move in years, and we've definitely seen that this year. And I think we're definitely going to see it over the next 5 years. I think there's going to be a lot of innovation, a lot more money printing, a lot more credit to all of your points. I mean, the fixed income market is a $300 trillion market. Bitcoin right now is what, 1.8 trillion in market cap just in and of itself? So we got a long way to go. But anyways, thank you all for your time. If we could give it up for our panelists here. Thanks, Lauren. Great. So we're going to pause for lunch, about 45 minutes. There's some coffee and other bites over there, but we'll get started around 12:45. Thank you.
make a really quick announcement. If you're hanging out here for the Bitcoin for Corporations Symposium, we are serving food just right back there. So if you're hungry, make your way over there, grab some food, and then yeah, we'll be back here in about half an hour.
Okay, we're going to get started here. Hope everyone had a great lunch. So we have a very special panel here, really hearing directly from the source, from the investors and allocators themselves. This panel is called How Investors Are Positioning in Bitcoin. And so we'll have Leisha Zhu from 76 Columbus moderating, Marcus Chin from Ares Holdings, a family office, Javier Pineda from Fund out in Spain, and we'll go ahead and get started. If you can join us. Thank you.
Good morning. Good morning. Thanks for coming to our panel. Just kick this panel start right away. So for the conversation for our panel this morning, and I'd like to get started as a round of introduction of our panelists here. So I will start. So my name is Leisha Zhu. I'm the principal for 76 Columbus Family Office. We are based in UAE, registered in ADGM, also have entity in New York as well. We primarily invest in alternative space with a good amount of exposure in the crypto space as well. So my background is in traditional finance. Used to spend many years in Wall Street with JP Morgan and along some other fintech firms in the United States. I moved here last year officially from New York. Marcus, please.
Hi everyone, I'm Marcus Chin. So I'm currently managing a single family office based in Dubai. So I also came from a TradFi background, did a bit of banking in the US, and then moved back to Singapore, managed a couple of family offices there, and then recently moved to Dubai last year. As you all know, that UAE is a very crypto-friendly country, and in our single-family office, we actually diversify our investments into both public and private markets.
Go ahead.
My name is Javier Pineda. I'm a crypto funds fund manager. I have more than 15 years of experience as trader. More than a decade developing automated trading systems, and more than 5 years managing crypto portfolies. In March 2022, I have the idea to create the first crypto hedge fund in Spain. And 2 years later, we launched this fund that is a Renta 4 crypto hedge fund. I have participated in different webinars hosted by CMT, Chartered Market Technicians. I hold the accreditation Certified Bitcoin Professional and Chartered Market Technician. I have participated also in the CMT Summit in Dubai this year in October. I have written a book, Investing Crypto with Confidence, that Palgrave Macmillan is right now editing and is going to publish the next month. My firm is Renta 4 Bank. It's a Spanish bank with presence in LATAM and in Spain. And it's pioneer in digital assets because we have our own team since 2021. And that's it. This is my resume.
Fantastic. So this is a really interesting and cozy panel in a way that I want to make this a little bit more interactive. If we have questions from the audience, please feel free. So we have family office, which is private allocators on the stage, and we also have professionals. I call this day-to-day trading in the crypto space. I will start with Marcus. You also came from trade background, right? Trading background. You're like very spot on the finance space. So quick question for your in terms of day-to-day, particularly for the context of this conference and for your family office, what's the current allocation in terms of the crypto industry in general, and a little bit more honing on the Bitcoin side, please?
Sure. So, just to begin, just to give some stats, among the family offices, over the last 5 years, especially after COVID, you have seen like a huge correlation with Bitcoin and the S&P 500. I think as of like September this year, the correlation of Bitcoin to the S&P 500 is about 85%. So because of this high correlation, this actually gives a lot of family offices a lot of confidence in Bitcoin as an investable asset. It's highly liquid, and a lot of family offices right now are actually getting a lot more exposure to Bitcoin via ETFs. So how I invest in a single family office is when I look at my public book, right? I have obviously a basket of equities, mostly centered around tech, US tech. And when we look at Bitcoin, we invest via ETFs. I think there's some advantages, investing in ETFs because in a family office, we actually do a lot of reporting. When it comes to like P&L, when it comes to drawdowns, and having ETFs in our portfolio, like a Bitcoin ETF, via like Grayscale or BlackRock, actually helps us to report our entire public book very easily. So there's no custody issues in that sense. We also don't have to encounter any counterparty risk, right? So we do direct trading with some of the banks, the brokers that we work with. So it's so easily accessible. And because of this accessibility, I believe a lot of family offices like myself are really increasing exposure to Bitcoin because, number one, of the high correlation, and number two, obviously we see Bitcoin as a long-term investable asset, right? We have seen over the last couple of months, even though when there was like a huge drawdown in equity markets, there were a lot of rumors going around like saying, oh, Bitcoin will dip back to its 2021 or 2021 lows of 30K. But we're actually seen Bitcoin, at the price of Bitcoin being quite resilient. So actually, so because of all these like factors, we still have a lot of confidence, investing in Bitcoin as a liquid asset.
Very good context around family offices in terms of exposure in the crypto and Bitcoin space. I will come back on later in terms of questions. Just I want you to think about there are many formality of exposure in Bitcoin or overall crypto. ETF you mentioned, which is really it's very favorable for the private family investments for sure. And then how about other formality, right? Well, now we're thinking about planning for the earning next year in terms of deployment from family office space. Think about it and we'll come back later. We go to, I call you Javier, but Javier, please.
It's okay.
So in the panel here, if I was say the expert, I think you're day-to-day, 24/7 in the crypto space. There's no sleep and no weekends. Can you please share a little bit about from this cycle, what's your view different? Like this cycle is different from the previous cycle?
Yes, in my point of view, this cycle is going to be different because we have these new two factors. The first one is the institutional investor. Because right now in these cycles we are seeing that we have low volatility, low drawdowns, and low returns than in other cycles. So the market is more mature, and this is more attractive and investable for institutional investors. So the main driver is no longer the retail. I think the main driver right now is institutional. So that's why it's very important to study the ETFs, Bitcoin ETFs flows. But this market maturity doesn't reduce the Bitcoin attractiveness. The Bitcoin Sharpe ratio is like the double of the Dow Jones and more than 300% of the S&P 500. So Bitcoin is still giving a good returns. And also the second key factor is that now the key factor of the cycle is not the halving. I think right now is more the U.S. interest rate curve and the Federal Reserve balance sheet. I think the halving, the interest, well, the impact of the halving in the cycle is less because the block reward that the miners receive when they generating a new block, this is going to be is less relevant because in each halving is reducing by half. So right now it's more than 95%. Of the supply, of the total supply is in circulating. And we have seen that in the last years, when Bitcoin has a bullish rallies, is because usually the US interest rate are low or the Fed balance sheet is in expansion. In my opinion, right now Bitcoin is a risk asset, but I think over the years it's going to be like a store of value asset. And the main reason is because they have a great support from governments like UAE and USA, and also for the strong institutional interest.
Very institution adoption seems like one of the top for this cycle. Yeah. I think go back to markets a little bit. You mentioned about ETF being very comfortable, relatively comfortable manner in terms of non-native crypto investors into the crypto space. This actually resonates with a lot of the families among our network in terms of what's the exposure, right? Traditionally, we use the 2%. If we can get these families across the 2%, that's a step forward. But I will say, I think right now probably 0 to 5%, right? How we can get those not day to day in the crypto space and get into over 5%, that's a very interesting matter. So this question goes to Marcus. You mentioned a different type of exposure, right? Direct, spot trading. Yeah, I do that whenever I see the up and downs. Or you can give to the traditional, you can give to the professional 24/7 Javier to have him to manage for us. So what's your view with your friends group in terms of looking into, like, let's plan for next year. What do you think, in your view, different type of exposure? What's your view on those, especially on our risk management? If for your family office, what do you think about more exposure would it be? ETF, through fund. Previous panel, they talk about treasury business, right? Treasury fund. That's also another matter. So, yeah, share your thoughts.
Yeah, I think I'm actually pretty opportunistic in the sense, like, I love buying dips. Okay, so if you still believe in mean reversion, Bitcoin, like equities, they could obviously, mean revert, but obviously mean revert based on many factors. One of them is actually Fed policy, right? So if you're still bullish on equities going towards next year, likewise, you should also be bullish in crypto. So so how I do it is I'll do sizing. So right now, our current allocation to Bitcoin is about 5% of our liquid portfolio. But if you're opportunistic in buying dips and you believe that Bitcoin can mean revert back to its all-time high, based on more Fed rate cuts, favorable conditions for crypto regulations, etc., then you would want to buy the dips right now in the market. So we always reserve like a 20% cash just to buy dips in both equities and Bitcoin. So right now, I'm actually thinking to increase the exposure from 5 to even 10% right now. And within the liquid crypto ETFs that we have, obviously Bitcoin will always be the largest. How I like to think of sizing is also based on market cap. So when I look at my equities portfolio, I look at obviously the top names like Nvidia, Tesla, right? So likewise, I size it based on the market cap, because in a family office we're not trying to make 40-50% a year, make a killing. Our goal and our objective in the family office is to have a consistent return in whatever investments that we do. So, so based on that risk reward, I would say, if you still believe in a correlation, if you still believe in favorable market conditions coming forward next year, then it's really worth buying, dips in Bitcoin and also, Ethereum and Solana. But Bitcoin will always be the biggest size, in my crypto allocation.
Perfect.
Yeah.
I think we have a new slogan, not 2%, but 5%. For Javier, you mentioned earlier about the attributes in terms of current cycle, very institutional adoption. So I guess you're running the fund day to day. So curious about what's your position in terms of your fund position to this cycle.
The first thing that I want to talk is that my fund is a crypto hedge fund. So that's why I invest in Bitcoin, but also in other altcoins, okay? So the first factor that I see when I'm going to do the allocation is the dominance. It's very important to see the relationship between the Bitcoin dominance with the price of Bitcoin and also with the altcoin's price. For example, if the Bitcoin dominance is going up and the price is going up, the altcoin's price usually is going down because you are at the bottom of the bear market. If, for example, the Bitcoin dominance is going up and the price is going down, then the altcoin's price is going down a lot. And this is why we are in the start of the bear market. And for example, in other cases, if the Bitcoin dominance is going down and the price of Bitcoin is going up, then the altcoin's price is going up a lot because you are in the start of the bull run. So this is a very important factor that I'm seeing. Also, the another factor I see, obviously, is the on-chain metrics, like the fear grid index or the short-term holder realized price. For example, this metric is very important because it's a strong support in bullish rallies, in bullish phases, and a strong resistance in bear markets. Also, I see the Bitcoin ETF flows because shows the interest of the institutional clients. For example, another factor that I see is the derivatives. Derivatives is like more than the 60 or 75% of the crypto total trading volume is from derivatives. So that's why I'm looking the liquidation map. The liquidation maps is the price zones of high liquidity, which show levels where the open future positions should close due to margin calls. So it's very important as support and resistance. And also you have to have clear the macro picture, like the global liquidity, M2, that has a direct relationship with the Bitcoin, and also the US interest rate and the US dollar, that these two factors have an inverse relationship. So looking at these factors, I do the allocation of Bitcoin and altcoins. And in my opinion, right now, from September 15, like the middle of September to now, I think we are like in a sideways phase, like in the life cycle, where from August 2020 to April 2021. And I think we are going to have a last bull run, a last bull phase. And the key trigger, I think, is going to be the US Fed rate cuts. When this is going to happen, then I think it's going to. So right now, I'm doing an allocation like Bitcoin and altcoins, and I think the altcoins is going to be in this bullish phase. Is going to be like a little bit higher than Bitcoin.
We have a few minutes left. So Marcus and I we're friends quite a long time, and we're swimming in the family office space, so we know a lot of those friends. So oftentimes we always get questions around, especially in the crypto space, come from traditional families' perspective, the risk and the volatility in the crypto space. Almost, I don't know how Marcus your stats, but for the friends around my circle, almost 80% of them have Bitcoin exposure, direct exposure. But then in the crypto world, it's like ocean of opportunities. But why there's a hesitation to be exposed more asset types has a lot to do with volatility and control or manage of those volatility and risk management. So I always ask all my friends, especially the ones doing this day to day, if you were thinking about from the private family office perspective, which amounting 10 trillion assets in 2025, which in the context, sovereign wealth funds are attributing 11 trillion. So it's not that far. Everybody's talk about sovereign wealth funds, but the private wealth is a really significant matter. But in terms of sophistication, understand the crypto and this market, it has a long way in terms of knowledge gap. So I really strong in terms of the education space and curious about one Marcus in this family office space, and Javier is expert on this space. If I were come to you, ask, I'm risk averse, but I wanted to get involved. Disclaimer, I understand there are no financial advisors involved, but what's your view and recommend me to be getting involved in the crypto space? And let's talk about what are the avenues around the Bitcoin among other crypto. It's more risk management. How you control the risk and recommend me to be involved?
In my opinion, the crypto assets is not a passing trend. Then if you are not invest in crypto and in Bitcoin in a global portfolio, then you are going to have a cost of opportunity. So in my book, I explain one 5-year scenario from May 2020 to May 2025, that if you add a 5% of in a global portfolio, 60-40, 60 equity, 40 fixed income, then the volatility is going to increase only 0.78%, and the returns is going to increase 3.13%. It's like 4 times more. So, and also I study the optimal allocation, and the optimal allocation looking the Sharpe ratio is about 6%. Obviously, then you have to see if the type of clients and everything. So, but I think you have to be, if you have a global portfolio, you have to be in Bitcoin. If you're not going in Bitcoin, you're going to have a cost of opportunity.
I think a lot of family offices like myself, even we hold crypto like Bitcoin as a long-term investable asset, but we're also opportunistic in investing in market-neutral, systematic crypto hedge funds. I mean, it's in the same way we also invest in market-neutral, equity, hedge funds. So, in a sense, we want to have this hedge fund, this pool of hedge funds, to obviously manage the volatility, and these hedge funds tend to, provide a pretty decent return of 10 to 15% a year, with high Sharpe, low drawdown. They're like making almost like 1-2% a month kind of strategy. Where they long futures, they short spot, in a market neutral way. So I think not just based on our bullish outlook, and also a generational shift among family offices. Now a lot of second and third gen, family members are actually stepping up to be more involved in investing their own money. I think the awareness is definitely there. I think a lot more family offices are more bullish and getting more into crypto, but also at the same time we are more opportunistic in managing our volatility via these market neutral hedge funds.
We have 2 minutes left. Do we have any questions from our audience? Make this more interactive. Yes? Maybe? Okay, then I will ask the last question for the audience, for the panelists. We're about to get into the Christmas time, right? The holidays coming up soon. So I'm not sure about the dry powder in terms of deployment towards the end of the year, but we're definitely scouting out for what's happening next year. So for our panelists, think about what are you more interested or excited to find out more information or insights for next year's plan in terms of deployment? In crypto, of course. Can be use cases, can be looking into different type of, say, like Marcus was saying, different type of the fund to be involved, learn more about market neutral, learn more about, Bitcoin treasury fund, learn more about some other asset types. So what's your thoughts on? What are you like eager to learn more?
I think when there's a period of like market volatility, a lot of investors will flood towards consistency. So I think consistency is something that I'm definitely very focused on right now. So consistency in terms of yields, right? I mean, as a family office, we invest in a lot of like private credit funds, and we look at the bond market right now. Rates are not really moving much. You're not really getting a lot of good yields on your both for investment grade and high yield bonds, right? So there are a lot of interesting crypto staking projects that I've seen so far that I'm going to take a chance on, because if you believe that crypto as a collateral is stable, then you can use a little bit of leverage and you can stake it for a better yield.
Ooh, I like that staking business. Okay.
Now, then, if you see that is the much volatility in crypto or in Bitcoin, then zoom out and see all the trend. That's the advice I will give.
Perfect. On that, thank you very much. Thanks for our panelists.
Thank you.
Thank you.
Okay, it's time for our last presentation for the day, our keynote address from the one and only Matt Hogan, who is the Chief Investment Officer of Bitwise Asset Management. And so he's going to walk through Bitcoin's long-term capital market assumptions. But I think when you think about today and over the last year of how choppy Bitcoin has been, it's always important to zoom out. And so Matt's going to give some great insights on that today. So without further ado, please welcome Matt Hogan.
Thanks, Lauren. Appreciate it. There we go. How's everybody doing? Good? All right, awesome. We're going to talk Bitcoin long-term capital market assumptions. Let's get our slides up here. Oh, went too fast. I thought I would start, actually, this is about Bitwise, but you all know about Bitwise at this point. I'm the Chief Investment Officer there. I've been there for 8 years. I come from an ETF background, so before Bitwise, I was the CEO of ETF.com, so if you have any ETF questions at the end, I'm happy to answer them. But I thought we would start, here's what we're going to cover, here, with what are long-term capital market assumptions. For those of you who are crypto native, long-term capital market assumptions are research reports that large Wall Street firms put out each year forecasting the 5 to 10 year returns of all major asset categories. JP Morgan puts them out, PIMCO puts them out, Vanguard puts them out. Everyone, I don't know what happened there, but they put them out as well. I think that was BlackRock. The core idea is this is how institutions allocate their portfolios. They look at these forecasts of long-term returns, and that's how they determine their strategic portfolios. How much stocks, bonds, private equity, venture capital, et cetera. And maybe the most important slide, the slide with the most alpha on my presentation today is this one, which is I've been at Bitwise since early 2018 talking to institutional investors, and the number of people who asked me for long-term capital market assumptions was 0, 0, 0, 0, 0, and then in 2024, 0, and last year, this year, 12 major institutions asked me for these. These are national account platforms with trillions of dollars of assets. These are financial advisor groups with thousands of advisors. I had 12 people independently ask me, are you going to put out a long-term capital markets assumption piece on Bitcoin? And when they ask, we deliver, so we did. This is what the findings are. We'll get to all the reasons for this. You can take pictures, I love it. This is what we've been telling these 12 institutions to expect, and I'm going to walk through how we get here. Now, capital market assumption pieces follow this familiar format. You have to introduce the big picture, and then you have to draw down to how that drives the returns of your asset. This is all basic to you, but I think maybe it's good during these grindy moments where Bitcoin has been going sideways for a year to peel back and think of some of the big picture elements that we should all incorporate into our long-term projections. So here's one. We have 3 core theses that drive this long-term view of Bitcoin. The first is that there's rising concern about the outlook for fiat currencies. That's not a radical statement in this room, but in Wall Street it's a bit more radical. We usually start with something like this. This is a slide. It's up only. Crypto should love this slide. But this is a slide of the US debt, right? It's incredible. Half of all US debt has accumulated in the last 10 years. Interest payments are almost $1 trillion a year. The ecosystem we're driving into with our long-term capital market assumptions is one where the debt is up and to the right and just going forward. And what do you do in this environment? Well, this is what Ray Dalio says. When countries have too much debt, what they do is they print their way out of it. He recommended 15% gold or Bitcoin. I was tweeting earlier today, Harvard is worried about this. They put on a debasement trade this year. They bought $500 million of Bitcoin. An interesting fact, they bought $250 million of gold. Really remarkable that Harvard 2-to-1'd Bitcoin versus gold as they put on their debasement trade. This is maybe another one of the alpha slides in this presentation. This is something crypto doesn't talk about a lot. This is the market cap of gold. This debasement trade has been going on for a long time. Earlier today we heard Hong from my company talking about the launch of gold ETFs in 2004. When gold ETFs launched, gold was a $2.5 trillion asset. When Bitcoin ETFs launched, Bitcoin was a $2 trillion asset. Gold's now $27 trillion, it's 10x'd. A lot of people ask me, what will it take for Bitcoin to 10x? All it takes is for Bitcoin to stay at the same proportion of the gold market it is today, about 8% of the gold market, and for the gold market to continue to grow the way it's been growing for the last 20 years. Right? Gold went from 2.5 to 25 just through the passage of time and the growth of this debasement trade. Bitcoin will do that and then some. A lot of people, when I talk to institutions, say, well, Bitcoin isn't gold, it's way too volatile. I love to show them this chart. This chart shows that rampant volatility, but of course, this is not a chart of Bitcoin, that's actually a chart of gold. We have this false assumption that gold is this perfect, even, easy hedge. It's not. It's been very volatile since we went off the gold standard in 1971 with huge pullbacks. In fact, in that first rip in the 1970s and then 80s, gold moved on average 3% or more a day every 4 or 5 days. It was hugely volatile. Our view at Bitwise, I don't need to convince this room, is that Bitcoin is better than gold for all these reasons. And so thesis 1 is long-term. We believe Bitcoin will be more valuable than gold. But our price target of 1.3 million by 2035 is not predicated on it getting all the way there. All right, let's talk about the other big thesis, second big driver, dollar dominance is shrinking. Right, these are just facts. This is a look at the US share of GDP and the US share of global foreign reserves. They are down only. So debt is up only, US share of global reserves is down only. The reason for this, or the primary driver, is that countries are rotating into non-currency-based investments. This is the flows by sovereigns into gold. If you wonder why gold has been ripping and is north of $4,000 on its way probably to $10,000, it's that central banks ramped up their purchases after the US seized Russia's assets in the wake of the Ukraine war, now buying 1,000 tons a year. And that's going to repeat this year as well. The growing number of countries are owning Bitcoin. We think this is up and to the right. We do consultations with a number of countries at Bitwise, and we are not the largest asset manager in the world. If we're doing them, others are doing them. So rising concern about the value of fiat currencies, rising interest from countries in the Bitcoin and non-currency based markets. What's the third thesis? We think the pro-crypto regulatory shift appears to be permanent. This is a US-based view, but here in the UAE, you can feel it as well in the organization of the regulatory structure, which appears to be clearer and more consistent. I love putting up this slide of our chairman of the SEC, who's announcing Project Crypto. It's hard to imagine that the chairman of the SEC is more bullish on crypto maybe than I am. He was on Fox Business News yesterday saying all US stocks will be tokenized in a couple of years. That's a $68 trillion market being tokenized. He's launching things called Project Crypto. It's just remarkable, the regulatory change. We've dropped all the lawsuits against every major crypto company. We have acts moving through Congress. It's a remarkable thing. So what's the macro setup? Before we get into the Bitcoin specific setup, we think there's rising concern about the outlook for fiat currencies. We think dollar dominance is shrinking, and we think the pro-regulatory landscape is moving in a positive direction that is being sort of put in amber. All right, so where does that lead us to Bitcoin projections? This is what people want to really see. First, we'll start with returns. The three things that institutions care about are returns, correlation, and volatility. And I want to tackle each one. Let's talk about returns. I'm the CIO of a $15 billion asset manager, so I use a lot of complex math. My view is that the secret to valuing Bitcoin is by looking at supply and demand. I know that's complex, but I have even more secret. Rising demand plus fixed supply equals higher prices. I find it hard that people argue with this. I think it's just fact. So here is our valuation model for Bitcoin that we've been sharing. I'll get out of the way since people are taking pictures. But there's one thing on here that I want to emphasize. What we've done here is we look at all the markets we think Bitcoin could address. Those are listed on the left. We look at the size of the markets, and then we take the historical CAGR of those markets and project them into the future. So you can see the size of the markets. Our base case, which I actually think is under-optimistic, that gets to 1.3 million by 2035, is based primarily on Bitcoin going from 9% as big as gold to 25% as big as gold. That's a really conservative assumption, right? If you think about Bitcoin's journey over the last 10 years, going from 0 to 9%, it's an infinite increase. If it only gets to a quarter as big as gold, you're talking about Bitcoin at $1.3 million. If it gets to as big as gold, you can multiply that by 4, and you're in the $7 million range. If you think it's going to be bigger than gold, you get into the $10 million range. It really doesn't take very extreme assumptions to get into millions of dollars of Bitcoin's value. The mistake I see people making all the time is assuming the gold market, which we proxy against, is fixed. In fact, it's been growing significantly over time. As it grows, the target for Bitcoin's market grows. And again, if we just get to 25% of the value, you're talking about $1 million Bitcoin. Our model, just to put it in context, is not really that optimistic. We added some additional models here. They all have different time horizons, 2028, 2033, etc. But what you'll see is that almost everyone coalesces around this north of $1 million. And the reason for that, again, is that the assumptions to get there are actually relatively modest. The store value market continues to grow, not faster, which I think it will, but you project it just continues to grow as it's been growing, and then Bitcoin gets incrementally more share, not huge amount, not matching gold. Again, we're trying to be conservative because we're talking to skeptical institutions, and you end up at 1.3 million. Again, I think that's really conservative. Let's talk about correlations. This is the other big one. In fact, often institutions are more interested in this than they are in returns. And I think the quality of information in this space is worse than in anywhere else in crypto. All right, first of all, everyone says Bitcoin's highly correlated to stocks. That's really just not true if you look at the data. If you look at, I think this is 30-day correlations over the last 10 years, its correlation to equity is about 0.2. For people who aren't familiar with correlations, the way you think of them is 0 to 0.5 is a low correlation. In other words, they don't move together. 0.5 to 0.75 is a medium correlation. 0.75 and above is a high correlation. So 0.21 is really low, right? It probably means that Bitcoin's price is more correlated with the price of like avocados than it is of stocks over these 10 years. It's a very low correlation. All right, what will it be in the future? Well, let's look at it historically. This is that chart every day. I think this is 90-day correlations. Yeah, 90-day rolling correlations since Bitcoin started trading in 2010. So no data mining here. This is every single piece of data. What you can see is there's basically never been a time when it's been above 0.5. That means there's never been a time where it's not low correlated to stocks on a 90-day rolling basis, except for a tiny window after COVID where it peaked into moderate correlation. That was when we responded to COVID with so much stimulus that the correlation of everything went up. Bitcoin went up too, but only to about 0.6, and it's come back down. It also has no correlation to bonds and commodities. Remember, institutions use multiple assets, so the correlation to stock is what we talk about in the media. Correlation to bonds is 0. Correlation to other commodities is very low. Why? There are two reasons. These are obvious. I don't know why people are surprised by that. One is Bitcoin is having a one-time asymmetric inflow. What do I mean by that? Institutions are going from 0 to not 0. And so that flow is all one-directional. Whereas stocks and bonds, you have flows in and out. So you have a one-time flow versus flows in and out. And the second is that Bitcoin is just driven by different things than stocks and bonds. It's driven by regulatory developments. It's driven by ETF launches. It's driven by fiat debasement. These are different things than what drives the price of Ford. So why does the media say it's highly correlated? They say it's highly correlated because of this. On days where the US equity market goes down, Bitcoin goes down too. That's just true. And so the reason you get this not that it's correlated story is on the days that the media writes that story are the days where the stock market goes down 3%. And sure enough, on those days, Bitcoin goes down too. But if you span out for a meaningful period, if you look a year hence, if you took every minus 2% day on the stock market and invested in Bitcoin, your one-year return would be over 200%. So it's just not long-term correlated. The correlation has increased since 2020. I think the reason for that is that fiat involvement and money printing became a bigger deal, but it's still pretty low. So where do we end up? We think the correlation will be higher than it's been over the past 10 years because we think central banks and fiat money is playing a bigger role driving all equities, but we still think they'll be low, about 0.36 versus stocks. All right, volatility, and then I'll sum this up and talk about where this all fits in portfolios. The volatility of Bitcoin has been going one way down. We've seen a lot of up-only charts. Volatility is a one-way down chart. This is 30-day rolling volatility since 2012. You can see it's just been falling down. So what will happen? This is a chart of gold, and I think it's really telling. This is a chart of gold's volatility. Everyone talks about gold like it's a 5,000-year-old asset. It's like a 55-year-old asset. You really can't talk about gold's price before the US went off the gold standard because it was just flat. So if we look roughly after we went off the gold standard, you can see that what happened is gold's volatility fell for about 20 years. Why did it fall for about 20 years? It fell because the world was skeptical of what gold would be, and it learned it had a place in the world as a store of value asset. And as the world digested it, its volatility fell and fell and fell. But then it sort of leveled off. Why did it level off? Because it didn't have any more risks to be removed from the market. I think crypto is doing something similar to that. We are removing huge risks from the Bitcoin market. We've removed regulatory risk, technical risk, adoption risk, liquidity risk. We have derivatives now. The volatility has been falling. We project that eventually it will actually level off. We still think it has a little bit further to fall, but we think eventually it will level off. So our prediction is that the volatility will continue to fall, but at about half the rate that it's fallen for the last 12 years. And that leads us to a vol of about 32.9. That statistic won't mean much now, but it will mean a lot in 2 more slides. Okay, so what does this sum up to? The way these institutions think about building portfolios is that they look at the long-term capital assumptions for all different asset classes. And so I've done that for you here. The way we did this is we took our long-term capital market assumptions for Bitcoin, because as far as I know, we're the only people who have put them out. And then we averaged the long-term capital market assumptions between JP Morgan, PIMCO, BlackRock, and Vanguard. We could have chosen other asset managers or other institutions, but once you get 4, you're close enough. This is what Wall Street thinks these different markets will return. And I would look at it closely. We think with our relatively conservative assumptions, remember our assumptions only are that Bitcoin will take 25% of the store of value market in the next decade, up from 9 today. We think Bitcoin will have a 28% return. That compares to the average Wall Street assumption of stocks at 6, the average Wall Street assumption of bonds at 5, and nothing else except for private equity getting into double digits. If you wonder why private equity is so popular on Wall Street right now, it is the only place that Wall Street is projecting double-digit returns, except for Bitcoin, I think, will triple those returns. You can look at the volatility, and to be sure, we project Bitcoin's volatility to be higher than these other asset classes. I think anyone who tells you that that's not true is probably lying to you, but we don't think it's going to be that much higher. In fact, look particularly at private equity. You're talking about 10% returns, 26% vol, Bitcoin's 28% turns, and just a little bit more vol. What this means, I think, is that Bitcoin, once people build these capital market assumptions into their approach to portfolio building, it's just an incredibly attractive asset. I'm going to share a concluding slide, then we have 5 minutes for questions. This is our long-term take. Look, we think Bitcoin still has a long way to run. The thing I'm most confident about Bitcoin is that its price is wrong. It's too small to really matter, and it needs to either collapse to 0 or go much higher. Our view is that it's going to go much higher. We think it's going to be the best performing asset in the world over the next 10 years, again with relatively conservative assumptions. We think its correlation will be low but higher than it's been. It is becoming part of the global economic world. It does have more ties to what's going on in the macro space, but still, its correlation will remain below that 0.5 line, which is where you start to get into moderate correlation. And we think the volatility will continue to decline, but still remain a little bit elevated versus other assets. But net, we think it'll be the best performing asset in the world. Now I want to go back to that slide that I said was the real alpha of this presentation. Those 12 institutional platforms that asked for this. Those platforms you're now seeing approve Bitcoin and Bitcoin ETFs for their people to hold. You've seen Morgan Stanley do it. You've seen Bank of America do it. You've seen Wells Fargo do it. You've seen UBS studying it. You're starting to see endowments allocate. They're smaller advisory platforms. Those are all the people who asked for this analysis. I suspect next year you're going to see many Wall Street firms putting out their own long-term capital market assumptions. And the thing about it is, when you break it down carefully, and you look at returns, and you look at correlation, and you look at volatility, and you use conservative assumptions, and then you compare that to what Wall Street expects for stocks, bonds, private equity, private credit, Bitcoin just looks better. You don't need Yahoo crazy assumptions. If I took the average price target of this room in 2035, it'd be 10 times higher than mine. You don't need that for it to look extremely attractive to crypto, extremely attractive to institutional investors. So I suspect we're going to see a lot of inflows from these groups over the next few years, and I hope that was helpful. If anyone, thank you. If anyone has a question, we probably have time for 1 or 2 questions. Yeah, a question right there. Great. The question was from the companies that I mentioned. Is there anyone from MENA? It's kind of why I'm here. We're on a fact-finding mission. So Bitwise primarily in the U.S. and Europe right now, but we're extremely excited about what's happening here on the ground. And I suspect we're going to be spending a lot of time here over the next few years. And so I'm really excited to find out. I wish I had an answer for you. But I'm really excited to find out.
Thank you.
Yeah, great. Question right here.
Hi, my name is Igor from Bitcoin Hub. I have a question from holders. Holders want to hold and have a risks of the Bitcoin only. there is any opportunity how to get yield while you are holding and not really moving Bitcoin or having any other risk of DPEG or rug pull or whatever.
Yeah, how do you get yield without risk on your Bitcoin? It's a big topic. People come to us at Bitwise all the time. What we see are sort of two approaches, two primary approaches. So the first, which Bitwise does a lot of, people come and they want to do option overlay strategies on their Bitcoin. I think there are ways to do that, even in a regulated format that avoids rug pulls and other things. You're, of course, forfeiting some of the upside in exchange for income, but doing it in a tax-efficient manner, I think that's very exciting. If you need very little income, we definitely see people trying to generate that from a lending perspective. But I think this yield on Bitcoin market is extremely exciting, extremely fast-growing market. But those are the two that we see. Yeah, one more question right behind you, and then we'll wrap.
Hey, Matt, thanks for your presentation. We saw Ray Dalio in an interview say that he doesn't think Bitcoin will get more nation-state adoption or endowments, et cetera, because quantum. So you mentioned the 12 institutions on your slide today. Have you gotten quantum questions from the institutions referenced?
Yes, yeah, great question. Absolutely. Actually, at the institutional level, one of the first questions that you get from those institutions after you get past 101 is the quantum question. I do think Bitcoin has a great answer to it. You know, I remember what Hong said online. We see this train coming. We know that it's a risk. It needs to be solved. It may be true that it can slow down adoption because it is one of the concerns that is raised to us. I think there are good ways to approach it and to handle it, though. Thank you all so much. I really appreciate it. Great questions.
Thank you, thank you, thank you.
Thanks, man.
Thank you, Matt. That was a masterclass. Well, that wraps up our Investor Day portion of the symposium. Thank you all for listening in. My name is Lauren Asmus. I lead our investor relations for UTXO Management. Myself and the other members of the team will be here all week for the conference. Happy to answer any questions of you. Same thing with Bitwise. Thank you to our partners at Bitwise for co-sponsoring this event. There are several representatives here that can also talk about what they're working on. And thank you again to George and the BFC team for letting us do this pop-up. And with that, I'll hand it back to George. Thank you.
We are cruising now. Room is filling up. How's everybody feeling? Yeah? All right. I like that energy. Can we give it up one more time for UTXO and Bitwise for hosting the Investor Day? Thank you guys so much. Really, really appreciate your support and being a part of this. We are going to keep things rolling now. Bitcoin is at 92K, by the way. So great job, everybody. We did it. We are so back. All right. Next panel. Beyond hodling, we talk a lot about where does the yield come from. Well, this next panel is gonna tell us. They're gonna teach us Bitcoin yield strategies. And here to introduce our next panel is our moderator, Teresa Morrison.
Is this one on? Yes. Oh, do you guys want to? Yeah, you can sit with your picture. Ben, start. You can sit. That's fine. Okay. Is this one working? Yeah, you can sit behind your picture. Yeah. Thanks, you guys, for joining us today. We're going to start focusing on what real operating Bitcoin yield is, what's durable, where it comes from, and how corporations should evaluate participation. Joining me is Dave Lund, who is CEO of FlowRate, a lightning routing infrastructure company. Then we have Ben Workman from Strive, the first publicly traded asset management Bitcoin treasury company. And last but not least, we have Gabriel Caragiorgio from XBTO. For those of you who don't know, XBTO is a 2015 pioneer in all things digital assets. Good trading. So let's get started, gentlemen. Let's get some education and audience out here. Cool. So to level set the field and kind of give us some positioning, let's start with you, Ben, right? And when institutions earn Bitcoin yield, where does the return come from? Oh, sorry. I actually went a little bit too far. I'm like, that doesn't level set the field. All right. So give us an understanding of what some of your actual strategies are, some of the things you've seen, some of the strategies that yield strategies that you're considering that are actionable and being developed in the market.
Yeah, from the Bitcoin treasury perspective, I think we look at yield a little differently. And a lot of times when people are thinking about yield, they're thinking about taking the Bitcoin itself, putting the Bitcoin at risk, and then generating a yield off of that. When we think about yield, we're really thinking of exposure that our common equity has to Bitcoin. And because we're denominating that in Bitcoin for our common equity holders, Bitcoin per share is the metric you'll commonly hear talked about, our focus on every activity we take is this going to increase the exposure our common shares are holding or not? And we do it differently because it's not necessarily always going to be derivative strategies or liquidity provider strategies. We're doing something we think is really big, which is we're going in and we're trying to transform the capital markets. And we're trying to onboard the capital from the traditional finance system into the Bitcoin network. And so the ways you're seeing that done when you're a publicly traded corporation that can securitize around a balance sheet is you're seeing people issuing debt or issuing preferred equity products, and that's the way that we're getting our amplified exposure to Bitcoin because we strip out the risk, we strip out the volatility in those products, and then for our common stockholders, they get the excess risk and volatility and thus the excess returns that they're getting from that amplified Bitcoin exposure. So you'll see this evolve over time. I view us as really being in a digital gold rush at the moment. It's why you've seen Bitcoin treasury companies not wanting to put the Bitcoin at risk. You're building the foundation for the future. You're building the asset base that you can capitalize on over time. And I don't even think for the treasury companies we know what this looks like in 10 years. I think it could look very differently, but we know having the most of the hardest asset on earth is a good first approach. But when you do think about generating yield and putting Bitcoin at risk, when you actually hear that conversation kick off, it tends to happen during times of stress in the market. So for a company like ours, where we issue a perpetual preferred equity, we have a dividend obligation out there, people think, what tools do you have at your disposal? Because you're holding a significant Bitcoin position, how could you generate cash if you needed to? And the typical answer around that comes into the derivatives market. That's a very understood, it's cash secured puts. It could be covered calls with the right volatility profile out there. But we look at the capital markets as the real opportunity, and for the treasury companies to generate yield for our shareholders, for our common stock shareholders, we're going to continue to try to penetrate into those markets and get as much of that excess capital as we can.
Just to add on that point, and Ben was mentioning the word risk quite a few times, and that's actually one of the main things about Bitcoin holders. The fact that they do not want to put the Bitcoin at risk. Capital preservation is at the very, very top of the agenda. So, and actually it was one of the questions from the audience before, how can I generate yield? And I think there are three discrete strategies. The first one is where you are lending your BTC, but then you are running a big counterparty risk, and unfortunately, we have had in the past quite a few case studies where things went wrong. Secondly, you can do what we call basis arbitrage. You can do a lot of things between arbitrage, different exchanges, basis risk, and all the stuff. And then there is the approach where effectively you can generate yield by selling optionality, the derivatives trades. And under that, I would say that there are two different categories as well. So there are people out there who are selling optionality in the form of a covered call. But my argument for that, against that actually, would be that you are selling optionality on an asset that it is asymmetric by nature and you are giving up the upside. Why would you want to do that? Or the other thing that you can do is that you can sell optionality by selling a put option. What that allows you also to do is not only generate yield, but also to accumulate coins during a market dip. And this is the approach that we follow for our BTC yield strategy at XBTO. So in the grand scheme of things, we are net sellers of optionality, but in the form of a put option, because on top of the yield generation, we want also to accumulate coins when the market is dropping. Now, in principle, that sounds like a very simple strategy. I can assure you that it is not as simple as it sounds, because if you are going to set your strikes not in a wise manner, then you are running a quite big risk of running a negative mark-to-market. Eventually, the market, we think it's going to recover because we are long-term holders. So we believe that in the long run, it's going to appreciate again. But you're going to have very uncomfortable discussions with your investors if you are running a few months on the negative. So to summarize, I think there are a lot of different ways of doing it. What we need to realize is that yield is not a free lunch. You need to understand what is the exposure you want to have, what is the risk you want to take, and then you need to decide what is the right strategy for you to match your risk-return profile. But there are options out there for people who never want to sell their BTC to accumulate and generate yield on Bitcoin.
Yeah, I was going to say, Dave, you've got a very different. We've got market structure.
Yep.
We've got traditional financial instruments that are being used and wrapped around Bitcoin. And then Dave here does a purely Bitcoin native strategy that doesn't actually leave Bitcoin. So enlighten us a little bit about that.
I completely agree. Yield is not a free lunch, right? So we come from a different angle, and there will be different yield strategies. What we offer is essentially a platform and an onboarding platform for treasuries to start working on the Lightning Network. And what that means is essentially, operating a node. But the question is, what is the value that you as a treasury can offer that any individual Bitcoiner could not, for example? And the emerging market that we're seeing is liquidity leasing, actually. So the real-world equivalent for this would be that you have a railroad, and back in the day, we transported gold on this railroad, but the railroad wasn't made out of gold, right? In this case, the railroad itself is made out of the gold, which is the Bitcoin. We all know Bitcoin is better than gold, but that's the comparison. So there's quite an interesting dilemma here because we have been taught this whole, HODL strategy, which is great. But then the interesting situation we have here is that the Lightning Network is screaming for reliable, scalable, inbound liquidity. And we don't have enough time to explain the Lightning Network here, but essentially the problem, if we talk the structural problem with the system today is that it works, it's routing billions of dollars in volume, but in order to scale to the institutional merchant level where a company that wants to receive Bitcoin payments on Lightning, today they actually have to be an ISP, kind of. So they have this baby, that's their Lightning node, they have to really nurture it and take care of it. But what treasuries can offer is this reliable institutional inbound liquidity. And so what we do is we advise treasuries on the security because you're trading, so this is non-custodial, zero counterparty risk, free yield, but you're introducing cybersecurity risk and operational risk to that. And that's what we advise on. And you can never get as good as cold storage, but you can get very, very close. And the situation, what I'm selling here is essentially, if you are a treasury today and you want to become the tier 1 ISP of the future of money, you should probably start working today. Because if you look at how the internet evolved, you had a few major ISP tier 1 players that started early and they got a very big reward in the end. So that's kind of the short story of what we do. So we act as a bridge between the technical lightning people and the treasury people.
So on that bridge, and that takes you from Bitcoin Lightning, we're going to run back into the capital markets because they are actually beginning to converge in the technology that we're seeing running on Bitcoin rails. Having a corporate and a asset management hedge fund working in traditional finance and then bridging it over back into Bitcoin, we have some different economic values that get created in some of those yield strategies. You touched on some of them in the Lightning side, and you touched on some of the risk factors to pay attention to. So I'd like to have a little better understanding from Gabriel, who has the hedge fund. This is where you're working with derivatives or calls and put options. From an economic point of view, who would a corporate treasury, whether they're a Bitcoin treasury company or not, but a corporate treasury running a Bitcoin portfolio, who would be their counterparties? What is the economic substance on that other side? And then also, and I'm going to ask you to speed talk, what are some of the 1 or 2 top risks that a corporate should look out for when they begin to evaluate implementing a strategy?
No, that's a very, very good question. And actually, I would argue that the fundamentals are exactly the same as they are in traditional finance, but amplified in the world of crypto. What I mean by that is effectively, we need to realize that for the yield, someone is paying for a service. To generate the yield, there is a service that someone is paying for. So what we need to understand is who is paying for it, why they are paying for it, and what kind of risk they and we are willing to take. So, for example, when we are trading derivatives to generate yield, who is it that we are facing? In our case, we are going to be trading on Deribit, so we will be running the risk of the counterparty of Deribit, but we feel quite comfortable with that case. And the reason for that is because we know that there is a very robust marginalization of what is going on the Deribit side. And obviously, because you are selling puts, actually you do not have that risk. Yeah? You have already pocketed the premium, which is one of the other great things versus the calls. But when you are lending, then things change quite a lot. If you are lending on a centralized exchange, you have very concentrated, centralized exposure. And again, I'm not going to talk about what has happened in the past. So I think what we always need to keep in mind is, as I was saying before, it is not free lunch. You need to be very, very clear and have great transparency of who is involved and if you are happy with the type of risk that you are facing and if you are getting rewarded for the risk that you are taking. But essentially it's the same things. It's exchange, it's this kind of stuff. One other thing that obviously we have also seen in the past few months as well, and we should not discount it, is also the liquidity risk that you may be facing, especially in the case of options. So the liquidity pool risk, it's another one of the things that we should be accounting for when it comes to the economics, and it should be priced properly as well.
From our perspective, we look at risk in our model in a very methodical way. Right? I think there's a perception out there for corporations that are putting Bitcoin on the balance sheet, particularly the ones that are using that balance sheet to securitize around it. There's this notion out there of this excess leverage that's keeping these things running hot. And the reality is these are very under-levered. So for instance, the shift that you're seeing right now from the convertible bond market and into the perpetual equity market, there's some very distinct benefits to that. One is you don't have that maturity risk, that timing risk that comes up. If you're a corporation that's putting that debt on your balance sheet, now you're giving investors something that they need to look at out into the future. They've got a 4-year, a 5-year. At some point, that capital comes due, and there's a risk that it may not be able to be equitized. And so as we've evolved in this space, you've started to see the vehicle that is coming to the forefront as the perpetual preferred equities. Because there you're receiving the initial capital. That capital does not have a repayment, right? You do not have to give that lump sum capital back. But what you're effectively doing is putting on a carry trade, right? So you're borrowing money that you're able to go and buy Bitcoin with, and you're running a perpetual carry trade, long Bitcoin, short the dollar. And that's a risk that, as a corporation, we're willing to underwrite. We're underwriting the long-term success of Bitcoin as a corporation in that model. And it's something that we feel comfortable underwriting, and our shareholders feel comfortable taking that risk with us. So we have to be very structured in how we approach risk and how we communicate risk to the market, because I think it's very misunderstood.
I pointed and I was like, I want to jump in. This is like, what I do when we're at a round table, not at a panel. So, but I do want to take up on that point, because there is a difference between lever and leveraged. And a levered play or a levered Bitcoin treasury company is not the same thing as a leveraged Bitcoin company or a leveraged company. So they're very, very important. Levered is more like Atlas, using a very long lever to raise the world. And leverage is something where you're putting your own assets at risk. So they sound very similar, but they mean very different things. And I want to take that back to Ben, because I'm not sure the perpetual preferreds are fully understood or clearly and distinctly understood. And as a new capital market instrument, particularly in traditional financial markets, which is something that has rolled over from the DeFi era experiments and moved into capital markets with the perpetual preferreds, with Bitcoin treasury companies. It's really important, I believe, to dive into that a little bit more, because that is ultimately where some of the investment yield comes from. Operating yield comes from different places. It could be the Lightning Network on a routing payment for flow, or it could be a risk management through a hedge fund with Gabriel, where you generate some yield off of some of the calls and put plays while you're also protecting your downside. So if we can just spend a little bit of time explaining, explaining perpetual preferreds so that people can understand them as levered, not leveraged.
Yeah, and I think that's why you're starting to see a separation in the terms that we're using as well. So Strategy really pioneered calling the perpetual preferred amplification and not leverage, because there is that misunderstanding of what leverage truly means. It's more tied to debt. And the perpetual preferreds are equity instruments, they're not debt instruments. And so what you get when you're able to launch one of these perpetual preferred equities is you get to get into a market that's become very large. Yield is a very desired property for a security. Now, when you have an asset like Bitcoin that's at a compound annual growth rate of well above 50, and even in our models, when you're looking at it conservatively, we think at a 30% compound annual growth rate, what you're doing for those equity holders is you're chopping off the volatility and you're chopping off the risk, because you're putting them senior in your capital structure, and then you're giving them an attractive yield. And the yield in that compound annual growth rate above the dividend payment that you make, that's the excess value that gets returned to your common shareholders. And that compounds over time as it's retained. So it's a very powerful tool, but you just have to make sure that as a corporation, you're structuring yourself and you're managing your risk in such a way that you can provide security to these more traditional investors that are looking for yield instruments. Right? These are credit investors a lot of the time. Sometimes it might be multi-strat funds, right? There's a lot of different types of investment strategies that find these vehicles attractive. So being able to communicate your approach to risk and actually how low the risk is because you actually have the assets to back it. Whereas for a traditional bond, you're banking on future cash flows to be able to pay those. We hold the assets on the balance sheet already. So you can start to model that risk profile out very differently than the traditional financial instruments people are used to.
So not everybody runs a public company, but the strategies that we've heard today, which are market strategies, using some hedging and risk management, and then using native Bitcoin payment for flow structure, these actually are also tools that you can take back into your private companies and work with bankers. I know, don't shoot me. I'm a reformed banker. You can actually work with hedge funds. You can have strategy consultants to help you identify how to manage some of the risks in your business, not only Bitcoin risk and foreign exchange risk, but also other operational risks. And then, of course, we can use natural rails of Bitcoin to generate yield off of your stack. So I think we've got some pretty interesting different ways to do that. And I hope you'll all learn, dig a little bit more, do a little bit more research, and try to take it back into your own business. Thank you for your time. Thank you, gentlemen.
Just about at the halfway mark, and we are having a fireside chat between Simon Gerovich and Michael Saylor here in just a little bit. So we're excited for that. Just wanted to share a little bit about what we do. So if you are just showing up, this is the Bitcoin for Corporations Symposium. My name is George McHale. I'm the Managing Director of Bitcoin for Corporations. Oh, thank you. I got some fans in the crowd. Let's go. What's up, Jimmy? How are you doing? So we started Bitcoin for Corporations a little bit over a year ago. BTC Inc. and Strategy partnered with the mission to accelerate corporate Bitcoin adoption. Since that time, we have had about 40 members join our network from 16 continents. So this is, again, very much a global movement that is taking place. And we're excited to be a part of it. And we're very grateful for the support of all of our members who make symposiums like this possible. This is our 4th symposium of the year. We try to do at least 4 a year. Next year, in the United States, it is a midterm election year. So we are focusing on advocacy. We're focusing on getting our members in the room with politicians and policymakers. We're planning a 5th symposium in Washington, D.C. So hope to see you all there, and hope you're able to join us. With that, we're going to take a very, very quick break. And Saylor and Simon will be up in about 5 minutes. We'll let people trickle in. He's just finishing up a session in the deep. So hang tight. We'll be back in about 5 minutes or so. All right. We are going to keep things rolling. So, a little over a month or so ago, I had the opportunity to visit Michael Saylor at his home. We sat down for a lengthy interview. If you haven't checked it out yet, it is on YouTube, and I would definitely encourage you to do that. We also captured the interview in the latest issue of Bitcoin Magazine print, and I want to, before we do the fireside, I want to present Michael Saylor with a gift of a framed copy. So please help me welcome to the stage Michael Saylor. Sorry. All right, let's keep things rolling here. We got a fireside chat for you. Please welcome to the stage as well, Simon Gerovich. There we go. All right, I think this is.
Good afternoon, everyone. It's an honor and privilege to share the stage with you, Mike. It's the first time I think we're doing this together.
Yes, it is.
I hope it's the first of many times. I think I wanted to really start and thank and acknowledge you for the inspiration that you've had on Metaplanet and really on so many other Bitcoin treasury companies out there. Wouldn't be possible without your leadership. I'm reminded of a conversation that we had at the beginning of the year, ahead of our shareholder meeting. And you said that our companies are cheerful revolutionaries in the capital markets. And I think now that rings louder than ever, particularly as we are looking to embark on our own journey for perpetual preferreds following Stretch and Strike for the Japanese market. And I think at that time you said that traditional equities are valued based on the capital that they hope to have in the future, future cash flows, where we now have an opportunity really to be valued based on the capital that we have, digital capital that outperforms the cost of capital. And so we're on this mission together. It's inspiring to see you do all that you do in the US and beyond, and we hope to have an opportunity to do the same in Japan.
Thank you. Thank you. So Simon and I have something in common. We're the two largest Bitcoin treasury companies in the world. So our company pursued a strategy of accumulating digital capital. Bitcoin is digital capital. And what do you do when you have capital? You issue credit against it. And we started issuing credit. And Simon's company has accumulated the largest amount of digital capital in Japan. And they're the largest digital treasury company after us. And they're also now starting to issue credit against it. So I guess, Simon, I think the most interesting thing for the audience would be if you describe Metaplanet, but primarily describe the balance sheet of Metaplanet and describe the capital markets in Japan, like the credit markets in Japan. What's the state of bank credit, treasury credit, corporate credit, junk bond credit in Japan, mortgage credit in Japan? And then talk about your latest credit instrument you just did and your plans in the future, because I think that'll be interesting to people here.
So the Japanese capital markets are relatively sleepy when it comes to anything like a perpetual preferred. Yields are incredibly low. Japanese investors virtually have no options. Money market funds are finally returned to the market recently, and people are incredibly excited about 50 basis points. And so the opportunity we have is really to connect the Bitcoin world with one of the largest pools of savings in the world. There's $7 trillion of cash sitting on personal bank accounts, bank balance sheets earning nothing, and corporates have another 4 or 5 trillion. And so it's a ton of capital there that has been, I suppose, accustomed to deflation for a long time. It's okay to keep cash in a bank account because next year you're still able to buy goods and services for the same price. But that is now beginning to change.
So Simon, if I'm a Japanese family and I put my money in the bank, so what kind of yield do I get?
0.
You get 0. Did they ever go and invest in foreign markets, like in US dollar markets, to try to get 5 or 6% or something? What's the thinking in Japan about, do I leave the Japanese currency to chase after yield, or do I just sit on 0? And by the way, can I buy corporate bonds? Are there any ETFs in Japan, corporate bond ETFs or junk bond ETFs or mortgage-backed ETFs that pay more than 0? And what are those like?
The highest yielding products now are effectively REITs, so you can buy those. A real estate investment trust, the REITs. If you're a sophisticated Japanese investor through your broker, you're able to access foreign markets, but it's relatively kind of few and far between. People just like to invest in local companies, and the main function of that is because the disclosures are in Japanese, and so
culturally. And then they're probably afraid to take currency risk too, right? Because that could really hurt you.
Yeah, I think there's definitely an element of that. And so there is an opportunity really for us to transform that market, to offer something which is different to what
So
what
does
is
that mean that
available
a typical retail investor or a treasurer in a corporation in Japan is pretty much settled for 0?
Yes.
0.
Yes, they're accustomed to 0. I think
Okay.
they're now desperately looking for yield. And so being able to offer an instrument that pays them 10 times better than the money market rate is something that will definitely resonate very well.
Tell us what you're planning and what you're thinking.
Sure. And so we announced a couple of weeks ago our version of Strike, which we're calling Mercury. It's a perpetual preferred. It pays 4.9% in yen and has convertibility into equity. We think right now it's probably one of the cheapest call options on Bitcoin out there. And in the meantime, you get paid a nice 4.9%, which may not seem as attractive in the global context. But when you're competing against bank deposits in Japan that are earning nothing, or money market funds that are paying 50 basis points, this is 10 times higher than that, and also has the convertibility into equity. I think the real product market fit is Stretch. And I wish, Mike, you had launched that only a month earlier, because then we would have done a shelf registration for that sooner. We have a shareholder meeting coming up at the end of this month, and that's when we will be doing a shelf for our version of Stretch.
And what are you going to call it?
We're calling it Mars, the Metaplanet Adjustable Rate Securities.
So I wish I had the name Mars. I think that's really cool. MicroStrategy Adjustable Rate Security. So if I had done it earlier but not changed the name, we could have stolen Mars, but probably it's better that you have Mars.
We are leaning into the planetary theme, so there are quite a few other planets that you could take first.
Our ambition will stretch all the way to Mars.
Indeed.
Okay, so tell us about the preferred stock market in Japan and the regulatory issues and how deep is it or not deep and what you're thinking and what you've learned along the way.
If I share too much with you here, are you going to try to do the same in Japan?
No.
You've heard it here.
Not in the next 12 months. I'll give you a 12-month head start.
Well, I certainly think that if we do the hard work of educating the regulator and get our preferreds launched, it will be easier for you to come to the market. Hopefully you can welcome us to the US at some point as well.
Absolutely.
So currently there are only 4 listed prefs in Japan. Incredibly sleepy market. It's a massive capital market, and why is there only 4 listed prefs is a big surprise. There has been one other company, ANA, the airline, that has announced their own pref. They'll be the 5th, but our goal is to be the 6th and the 7th with Mercury and Mars. It's an incredibly exciting time, really, for us to be that bridge between all that cash sitting there and the Bitcoin market. We have shareholder meetings that we convene probably more regularly than we otherwise would. We really want our shareholders to buy into to the pivot that we made from last year. We've had 5 shareholder meetings since April. And each of our shareholder meetings are literally like rock concerts. There are 4,000 people in attendance. And a typical Japanese shareholder meeting, no one attends. It's what we call a kabuki theater. There's 5 or 6 people that show up, no questions are asked, management doesn't want to answer any questions, and before you know it, all the resolutions have passed. But we really want to embrace the fact that we're onboarding Bitcoiners into Japan. We now have 212,000 unique Japanese individual shareholders, and these are people that didn't know about Bitcoin before they discovered Metaplanet. And so we feel we have this really important goal, a higher calling to bring the love of Bitcoin to Japan. And again, it's thanks to you, Mike, for all that you've done. It makes it very easy for us in Japan to be able to point to strategy and say, this is what a large, successful company in the U.S. has managed to do in the U.S., and Japan wants to be an American ally and do the same in Japan.
A funny aside, before we discovered Bitcoin, we had a shareholder meeting and we had one shareholder show up. One. So if you're wondering how far we've all come. The big innovation of digital credit is putting together a number of innovations. The first innovation is use digital capital, Bitcoin, to back it. The second innovation is you put it in a preferred equity instrument that's perpetual. The third is you take it public. And the fourth is you put a shelf registration on it so you can continuously sell it. And if you do all 4 of those things, then you've created this perpetual liquid digital credit instrument that is 2 to 4 times better than traditional credit. And you can sell it without the credit risk. In the US, we've got pretty well-defined regulatory paths to do shelf registrations. Our company, by the way, we were writing in the preferreds, and there were already thousands of preferred stocks because banks issue preferreds. And so there was a much bigger preferred stock market when we launched. Although the reputation in the industry was very sleepy, and they were like stodgy. And I don't think anybody had ever put, it was almost never heard of that you put a shelf registration on a preferred stock. So we were combining an equity idea with a preferred equity idea. And as I've gone to other parts of the world, I've noticed there are some regulators where they'll say you can sell the preferred stock, but you can't implement the shelf registration until a year or 2 years after the preferred is trading. And that would cripple the adjustable rate security. So it's very tricky. You've come up with pretty creative ways to actually implement continuous selling in Japan. You want to describe how you do that and how you think about it? And then also, what is your time frame to launch Mars? I think that's interesting.
And so we were looking for a way to execute an ATM in Japan after Strategy was doing that successfully in the US, and we sadly discovered that there was no ATM structure in Japan. And so we came across a fundraising mechanism that a lot of small and medium-sized companies in Japan avail of, which is effectively a moving strike warrant. And so that's how we've raised most of our equity kind of so far over the past 18 months. And that is something that you can theoretically do on a pref as well. And so we would be looking to do a moving strike warrant on our perpetual preferred. We just announced a pre-IPO of our version of Strike. So our Mercury, we've now issued. The goal is to get that listed in Japan early next year. I'd like to give you an exact date, but as you know, with the regulator, there are a lot of steps that one needs to jump through. But I feel quite confident that we can tick all those boxes and get the instrument listed in due course. As I said, the best product market fit is Mars. That's something that we'd like to do kind of closely thereafter. It is something that I think the Japanese market would really, really like, having a high yield bank account, something they can purchase in their securities account, and have something that has a stable price that pays a yield that is far higher than they're used to seeing.
So ultimately, the appeal is if you can put together digital capital with a preferred, make it publicly traded, find a way to feed liquidity in the market, adjust the dividend rate variably, and then manage the shelf registration to provide liquidity but trim the volatility. If you put all those things together, you can create this magical digital credit instrument. Mars would be the third. You know, Strive created SATA, the second, and Stretch was the first. My impression is, there'll be over time a dozen or a few dozen treasury companies that'll create this kind of credit, and it'll be good for the market because the more people offering it, the more enthusiastic the credit investors will be. How are you going to market your credit instruments in Japan? And do you have any thoughts about will you issue credit instruments in the U.S. or anywhere else? What's your idea there?
I think the Japanese market is, it's one of the largest markets in the world. We would like to be, the player in the Japanese capital market. That's our primary focus at this point. Maybe there's an opportunity for us to expand in Asia. But I do, and maybe this is an unpopular opinion, but I don't think there is a need for that many Bitcoin treasury companies and that many issuers of digital credit. The most important thing is having a substantial balance sheet of Bitcoin. And you now have more than 3% of the global supply. Our goal is to get to 1%. Still, quite the way to go from here. But we've said we want to get to 210,000 by 2027. It is an important thing that we're all doing here. It's
So your focus is going to be to provide digital credit in JPY, in yen?
That's correct.
And dominate that market. And if we ever want to provide bank accounts that pay 6% or 5% or 7% in yen, you're going to need that digital credit instrument to do it. And that it's like marketing, working with regulators, building the capital base, getting the instrument listed on the exchange, getting it liquid. And that you have to be laser-like focused on that, which I applaud. So I asked you a lot of questions, Simon. Do you have any questions for me?
So I'm one of your followers on your X account, and I see over the past 3-4 days, you somehow have managed to be in pretty much every country in the region, taking a nice selfie with a beautiful backdrop. Can you share with us a bit about who you're meeting, the types of conversations you're having?
I think that this entire region is much more pro-digital assets and pro-digital transformation than most other parts of the world. The two things about the Middle East that stick out, they like technology and they like money. And so if you believe in digital transformation and digital technology, and if you're interested in money, then the digital transformation of money and digital transformation of capital markets and equity and digital banking ought to be very interesting. So I've been meeting with, I've been obviously meeting with all the sovereign wealth funds. I've been meeting with, 50, 100 different investors, hedge funds, family office investors that are interested. I've been meeting with banks and people that own banks or run banks. I've been meeting with fund managers that offer financial products. I've been meeting with regulators in every jurisdiction. And I think, and my message, by the way, is very, very straightforward. My message is we now have digital capital. Bitcoin is digital capital, is digital gold. On top of digital capital, we have a new asset class called digital credit. Digital credit strips the volatility from the capital and provides yield, income. So the simple idea is If you have a 5-year-old kid, you can give them $1 million worth of land in Manhattan, that's capital, and tell them wait 30 years and then maybe they'll be rich, but there are no cash flows. Or you can give them a credit instrument that pays them $10,000 a month forever, starting now. And so most people want the credit instrument. They don't want the capital instrument, even if the capital appreciates at 30% a year, and even if the credit only pays 10%, that's okay. They'd rather have 10% non-volatile than 30% volatile with no cash flows. A treasury company like ours, like Metaplanet, like Strategy, exists to convert capital into credit. Once you understand that, then you have 3 ideas: big, bigger, and biggest. The big idea is you take your sovereign wealth or your wealth and you buy digital capital if you don't trust anybody. You buy digital credit if you think Bitcoin is a real thing, but it's too volatile for you. You're just going to get 2 to 4 times as much as traditional credit. And then you get the first 10% of the return risk-free. Just buy the credit. And then if you believe in the idea of digital credit and you want amplified Bitcoin and amplified exposure, you buy the treasury company. You buy the Metaplanet, you buy the Strategy, you buy the equity, and you strap on for the rocket ride. It's going to be very volatile, and you're going for the next $1 trillion stock. And so if you want that, you buy the equity. Otherwise, you buy the capital or you buy the credit. So that's the big idea. The bigger idea, there's a bigger idea, which is you have a bank, and so have the big Emirates Bank, First Bank of Abu Dhabi, Bank of Bahrain, the Kuwait Bank. Have the bank custody Bitcoin, custody. Everybody talks about self-custody for the bank in the country. Buy Bitcoin, have your bank custody the Bitcoin, and then start to offer credit networks on top of the Bitcoin. And if your bank offers people SOFR plus 50 basis point loans on Bitcoin, then there are $2 trillion of digital capital going to 20 trillion, and you will attract 5 or 10% of it, and you can attract $1 trillion or a few $1 trillion to your bank in your country, because right now most big conventional regulated banks don't handle Bitcoin. They don't extend credit on it. So integrate digital capital into your banking system. That's the bigger idea, because then you're going to have big Bitcoin holders wire $27 billion of Bitcoin to your bank overnight. They're all going to come to you. And then I end with the biggest idea. The biggest idea, instead of getting 10% of $2 trillion, why don't you look at the traditional credit market, which is $200 trillion? Look at bank credit in Japan that gives nothing. Look at credit in Europe, gives nothing. Look at Swiss credit, gives nothing. Look at the money markets in the euro that pay 150 basis points, or the money markets in the US that pay 400 basis points, or the corporate bond market, which wouldn't exist if people weren't so disgusted with their bank account. The only reason you buy a corporate bond or a junk bond or private credit or mortgage-backed security is because your bank account doesn't pay you 6% or 8%. And so the biggest idea is create high-powered digital money. You might have heard that phrase, high-powered digital money. It was used by Satoshi. He said the future is corporations holding Bitcoin to create high-powered digital money. The way to create high-powered digital money is take digital credit, whether it's Mars or SATA or Stretch, and create a fund which is 80% credit, 20% currency, lay a 10% reserve buffer on top, strip away all the volatility, take it to vol of 0, and offer someone You don't have to offer them 10% dividend and stretch. Offer them 8% dividend in a bank account. Do it with a regulated bank, endorsed by the bank regulator. And now I just wire my money to the bank of whatever, the bank of Dubai, the bank of Abu Dhabi, the bank of Bahrain, the bank of Kuwait. I wire you my billions of dollars or tens of billions of dollars, and you pay me 8% interest every day, zero vol, in a regulated bank, powered by digital credit, which is in turn powered by a treasury company with 5x as much digital capital, over-collateralized. So if you offer digital bank accounts and digital money accounts, then you could presumably attract $20 trillion or $50 trillion. Why wouldn't everybody with all the money in Europe or Africa or South America or Asia or Japan or Australia or Canada or the US just send all their money to your country? And your nation will be the digital banking capital of the world. Your bank will be the biggest bank in the world. Your customers will be delighted. And you can decide if you want to keep 50 basis points or 100 basis points or 200 basis points. You can even adjust the risk and the yield and the liquidity by increasing the currency from 20 to 30 or 40, or you can play with the buffer. But you know, if the banks in Japan are offering 0 and you offer 400 basis points, and if the banks in Europe offer 0 and you offer 500 basis points in euros, and if the banks in the US offer, they're going to be offering 300 basis points in a money market or 200. Offer 100 to 300 basis points more. And what I would say is, what is the perfect product? It's not the iPhone. You need to be awake and be able to see and hold the iPhone. The perfect product is a bank account with 0 volatility that pays you 400 basis points more than the risk-free rate in your favorite currency. And if you're a financial engineer, the Sharpe ratio is the return minus the risk-free return divided by the volatility. And when the volatility goes to 0, the Sharpe ratio goes to infinity. If you want the lightsaber of money, the laser beam of money, the nuclear fusion reactor of money, it's going to be a digital bank account. And the innovation's going to be digital capital, digital credit, a digital fund plugged into a digital account blessed by a regulator. I don't have a country. It's above my pay grade. I don't have a bank. But you have a bank. The people I'm talking to have banks, and they have countries, and they have regulations. So I'm not saying they're going to do it. It's really a free-for-all. The question is, who wants to be the Switzerland of the 21st century and attract all the money in the world? And the answer is going to be whoever appreciates money the most, wants the money the most, that understands technology the best, that is willing to take a courageous stance of conviction with a degree of clarity. That is the opportunity. And that's all the conversations have been extraordinarily energetic, enthusiastic, and I couldn't be more excited. I think it will happen somewhere in this region. We'll see where.
Well, it's wonderful to be front row of innovation as we see a transformation in the capital markets. I think our time may be up, but it's been a pleasure sitting alongside with you, and look forward to doing a lot more together.
I'm delighted to be on the journey with MetaPlanet, with Strive, with all of the Bitcoiners and all the Bitcoin treasury companies and everybody that supports the space. Everybody buying our stock, everybody shorting our stock, everybody buying the credit, everybody arbitraging the credit. We love you all. Thank you for your interest.
Thank you very much.
All right. How are we feeling? That was a lot of fun, right? Can we give it up one more time for Michael Saylor and Simon Gerovich? Thank you guys for being here. Amazing conversation. All right, we're going to keep things rolling. I'm going to stay up here for this next one. We are talking about Bitcoin being included in indexes. How many people have heard of MSCI? Anyone? Yeah, it's a fun new topic in the Bitcoin treasury world that we are going to unpack. So I would like to welcome my next panel up to the stage here. Please give it up for Dylan LeClair, Tyler Evans, and Alexander Lizette. Can always count on the MetaPlanet team bringing the energy. Gentlemen, how are we doing?
Hello.
Thank you for being here. So we got a fun topic. First, super quick round. Everyone knows who you guys are. Introductions, who you are, what you do. Tyler, start with you.
Tyler Evans. I'm one of the co-founders of BTC Inc., and I'm the Chief Investment Officer of Nakamoto and UTXO Management.
Hey, my name is Dylan LeClair. I'm the head of Bitcoin strategy at MetaPlanet. Happy to be here.
Hello everyone, I'm Alexandre Lézé. I'm board director of Bitcoin strategy at Capital B, Europe's first and largest Bitcoin treasury company.
Amazing. Thank you guys so much for joining this conversation. So this is kind of a serious thing that's happening. It's kind of flying under the radar. Got a little bit of attention, MSCI specifically. But I want to first take a step back and talk about just the implications of Bitcoin treasury companies being included in indexes. Maybe Tyler, start with you. Can you share a little bit about what it means even for the average shareholder that a stock like Naka is included in an index?
Well, index investing is become such a critical part, especially of the U.S. Economy, where you have, I think, over half of funds that are invested in equities that are typically like retirement accounts, pensions of American citizens. Invested through passive indexing, where they're in products, in ETFs, and strategies that are designed to track these indices that give investors like broad-based exposure to all American companies. And so, as the markets evolved in the U.S., it's very much shifted from actively managed, where I'm picking individually what stocks, if I want to own Meta or Alphabet in my portfolio, into pure index investing for my 401k, my IRA, where now I'm just getting broad-based exposure of all American companies, and the majority of funds flowing into the system are designed that way. And so for Bitcoin companies, why that's super impactful is because getting added to one of these indices for any company drives those passive flows, where now the index has to buy the stock to represent it in the basket of all American, all global, all small cap companies. And it creates a layer of kind of secondary passive demand for the equity.
Dylan, anything to add?
No, I think Tyler sort of summed it up well. Passive is such a huge part of the global, outside of Bitcoin or outside of treasury companies, the world has gone from, very much the investment landscape has gone from very much active, predominantly, or mutual fund based, to very much passive, index based. And so, I think that's why there's been a lot of discussion about this recently. As there's the real discussion is the talking point is whether an index has the kind of right to arbitrarily kind of put their foot down and say, this should or shouldn't represent, the market composite or represent the market.
And one more thing I'll add about kind of the importance of indexes is that they also serve as the benchmark for asset managers and fund managers. And so, you're judged as a hedge fund on your relative performance against that index of companies, whether you beat it or underperform it. And so whether or not a company is in the index means it's part of the benchmark that every investor is trying to meet or exceed out there.
George, maybe it would be helpful if you just could define, or give some background as to what the argument or what the, what MSCI kind of laid forth as to, why they're even, putting stuff up for
yeah.
Amazing
segue. That's exactly where I wanted to go next. I think, we're a little over a year into sort of this wave of Bitcoin treasury companies coming onto the scene, and the old sort of first they laugh at you, then they ignore you, then they fight you is kind of where we are now. And MSCI, one of the largest providers of indices, has basically come out with a proposal that suggests if you hold more than 50% of your assets in Bitcoin, that you be excluded from major indexes. That's kind of the TLDR. There's more to it than that. And so maybe, Alexandre, you can kind of share with us your thoughts on, oh, and by the way, they named 39 or 38 companies specifically in their preliminary list of companies that would be impacted by this. Out of those companies, 8 of them are Bitcoin for Corporations members. All 3 represented up here, Nakamoto, Metaplanet, and Capital B were named in that action. And so they've provided a window until December 31st for public comments to basically push back on this or offer opinions as to why this should or shouldn't happen. Just today, Bitcoin for Corporations launched its response in an effort to make some noise about this. And so if you go to our microsite for this, msci.bitcoinforcorporations.com, you can actually read it, add your name to this effort to help drive awareness to this. But Alexander, going to you, sorry to keep you waiting, the suspense. Why do you think we are at this sort of then they fight you phase where it feels like this is an arbitrary kind of erroneous proposal seemingly out of nowhere? What's your take?
Well, the reality is that this is a good example of the transition phase that we are witnessing within institutions. It is making some frictions along the way because the Bitcoin treasury companies are not fitting within all of the classification from a traditional perspective. And so, in fact, it's quite positive because it shows that the traditional institutions are really starting to pay attention to it. In fact, out of the 38 companies they mentioned, they made a specific release naming Metaplanet and Capital B specifically. And I was like, okay, maybe they watch our keynotes or something because they are noticing the reality of a focus on maximizing Bitcoin per share over time and how this is a Bitcoin treasury operation and that this is not a fund activity. It has nothing to do with a fund. If an investor is willing to sell shares, I don't have to sell the Bitcoin. The share price moves around, but the Bitcoin stays within the company. And second, the company has a discretionary strategy, and strategy has proven that very clearly. Strategy is able to call one day and raise $1 billion, $2 billion in any type of financial instrument without asking any type of mandate from its sets of investors. And then when you look really at what is happening is the MSCI is really looking at a lot of the companies that compose the index that are now acquiring new types of assets it has never seen. And so it is quite natural to say, look, I don't know what to do about it. I propose this very bad rule, and the industry, you tell me what to do. And so maybe we have a bad scenario in which we will lose a bit of time in the adoption, and we will have to wait for consensus to form on the topic. But I think Strive comment on the topic has been very good. It was to say, look, MSCI, even if you want to do something about this and you have investors that are concerned about having dodge companies within the traditional passive portfolios, it is not about putting a hard rule of 50%. It is about providing filters accessible to your clients in a way that is providing freedom to the investor base without adding a type of segregation that would be discriminating different companies. And there are so many contradictions and so many even implications in terms of fees within the MSCI fund application of the rule that in reality it's quite probable that the solution will be different than what's been proposed, which is not practical.
Yeah, absolutely.
George,
yeah, go ahead, jump
I'm
in.
gonna put you on the spot here.
Yeah, please.
Do you know what MSCI stands for?
Morgan Stanley something something.
Capital International.
Ah, I knew it.
So there's an irony here, and we first saw we raised we had a public offering of common stock in September, and shortly after it was the largest equity deal in Japan this year. We raised $1.4 billion in just a stock deal, no warrants, no convertibles, no debt, just straight common stock. And after this, there was a comment from the MSCI, and shortly after there was this proposed rule change.
So this is your fault.
So maybe we raised too much money.
Yeah.
But one of the ironies of this all was in this process, Morgan Stanley Capital International, which was founded by in tandem Capital Group and Morgan Stanley. This process of us raising the most equity by far in Japan in a primary offering this year was underwritten by Morgan Stanley, and our largest investor in Metaplanet is Capital Group. And so, I think the sort of the argument from the stance of MSCI is that these companies act like closed-end trusts or investment trusts, or these aren't acting like operating companies. But the irony of this is we spent 6 weeks going through an underwriting process as a listed company and working with the capital markets division of investment banks that work with listed equities, and then talking with investors that invest in, not trusts, not closed-ended funds, listed companies. And so I think there's something to be said about index are representing kind of the market, right? That's what they're supposed to represent. And so as we're embarking upon our mission and our operation, we're talking with investors who are putting up billions of dollars of capital to invest in an equity. And so I think there's always going to be people with differing views, and companies or committees that have varying kind of thoughts on things. But in our view, the capital markets are speaking loudly and clearly. People are investing tens of billions of dollars in Michael Saylor and strategy, not to be a trust, but to be an operating company. And operating companies have flexibility. They can issue stock, they can buy back stock. So Metaplanet, we've issued $3 billion of equity. We also have the authorization to buy $500 million of stock back, right? A trust can't do that. And so I think there's a lot of kind of nitpicky things that you can say, well, this rule or this thing or this clause, but the reality is, what Bitcoin treasury companies are embarking upon, it's a much wider mandate than just buy the Bitcoin and sit on it. It's actually, the whole capital market operation is very, very sophisticated. There's a lot of layers to this, and it takes an operating company with a lot of sophistication and expertise to execute upon it.
Yeah,
I think that's spot on, Dylan. And I think I agree. There's a lot of flaws with the individual proposal, but what really rubs me the wrong way about it is the job of an index is it's supposed to provide broad-based exposure capture to the innovation happening in companies in that geography and that small cap range. And so to arbitrarily exclude a company like Metaplanet, which to toot their horn a little bit, best performing equity in Japan that is doing all sorts of innovative things at the forefront of kind of the digital economy, from an index like that, it's unfair to investors because you're excluding one of the most innovative kind of parts of the economy. And then, to your other point, Dylan, each of these markets is already a highly regulated market. There are securities regulators and there's exchanges, which all of us work with individually, that provide the regulatory oversight, that provide the investor protections, that underwrite the business models, that approve your share issuance. There's securities regulators that have already been put in place to provide those investor protections. And so I see MSCI kind of trying to put their thumb on innovation here and trying to take over the job of the SEC or the Tokyo Exchange and become their own non-accountable, non-governmental regulator, arbitrarily excluding capital flows from one of the fastest growing parts of the digital economy.
That's a really good point. I hadn't really considered that what they're trying to do is kind of scope creep for what they're responsible for, and a little bit out of their lane. So I think how we engage with this conversation. I mean, we've seen Strive put out a great letter, as you mentioned. There's been some noise, some traction that's starting to happen. We're obviously putting out our own action as well. How should sort of the average investor think about this, or the average Bitcoiner? I mean, we know Bitcoin's going to be fine, right? Bitcoin doesn't need indexes or anything like that. If anything, it could be a temporary setback for corporate adoption. But hypothetically, let's say December 31st rolls around. They're giving it another 15 days after that. So January 15th is going to be the decision date in terms of whether or not this is going to be implemented. Average investor wakes up January 16th, and this has gone through. What are the implications for your shareholders?
To be honest, and who knows, but I think a lot of it is priced in. We saw 2 weeks ago with Bitcoin and strategy and the strategy preferred instruments and all of the smaller Bitcoin treasury companies, and there was a lot of weakness baked in, and people were kind of looking around like, what's the headline? What's the news? Why is it crashing? People were asking me, well, Dylan, why is Bitcoin crashing? And that's sort of kind of an old adage in our world. It's like, well, more sellers than buyers. But I think you sort of see, like, we saw this on the other side, right? When strategy got included in the NASDAQ, the QQQ, and it was, well, it's not priced in. It's none of these things are never priced in. And the reality is, I think the market is full of people that are trying to weigh out this information. And so I think, if the status quo is maintained and this goes through, then I don't think much changes. If in terms of like an immediate reaction, or what does the market do overnight? If this flips, I think it's very much a positive, as people got kind of max bearish and priced in kind of the worst case scenario. There was a lot of misinterpretation too. People were saying, the NASDAQ said this. Well, that's not the NASDAQ, it's MSCI, right? And so there's a lot of nuance missed. There was a lot of fear mongering. Their strategy is going to get delisted. Like it was a bunch of nonsense. And so I think a lot of people were kind of running around with their hair on fire. The reality is that we're all of us, the industry is engaging in an active dialogue with the MSCI, and we're going to argue our case from a meritocratic standpoint. It's not defensive. It's, hey, this is a new industry. This is a new asset class. We think it'd be probably pretty foolish to voluntarily, banish yourself from what we think is going to be the next, the best performing thing, right? And so, I think that's what the investment community broadly would say. And ultimately, you talk to the biggest capital allocators in the world, the guys that are cutting hundreds of millions of dollars of checks to invest in strategy or to invest in a perpetual preferred instrument, and they want Bitcoin exposure. And so for their benchmarks to say, yeah, actually we're going to voluntarily exclude ourselves from that, I think is a bit misguided. And I think ultimately, that view will kind of come around.
Yeah, I think that if you are new to Bitcoin and you have started with Bitcoin treasury companies, then you need to know that you need to be ready for hostility. And that is really a very small part of hostility that you can see from what Bitcoin has gone through over the years. And it was attacks after attacks and choke point 2.0 and everything else. So I guess that this is just one friction within the adoption of Bitcoin treasury companies. You have to realize that a Bitcoin treasury company called Strategy is coming into the market and saying, look, this is an alternative to monetary funds at 10%, and all of your monetary funds at 3% are worthless. This is quite a competition for the traditional financial industry. And by the way, I don't even mean competition in terms of the issuers of those products, but competition in terms of the asset managers that are competing within their benchmark. And if you stay within your 3 to 5% range, then you will completely lose against the one that is getting the 10%. It was the same thing with the convertible notes of Strategy. It was the best performing converts of all of the industry, and Strategy became the largest issuer of them. So that creates waves of adoption, and this is a small friction that could just take some level of inflows into the Bitcoin treasury company. But a Bitcoin treasury company is like water, like you have a stock, and if the stock is not put in an index from MSCI, it goes into an over index. And by the way, I saw that in fact the international companies might get more inflows as a result of this ban, because some asset managers could end up redirecting funds to over indices. So in fact, what you are seeing is the capacity of a Bitcoin treasury company to access different markets at different periods and benefit from passive inflows when they come, but not depend on it. And if you are an investor in a Bitcoin treasury company, these kind of things just tell you how early you are and how much upside potential you have, because really what will happen when all of the gates are open and Bitcoin treasury company stocks are everywhere, well, it will have much more upside than now.
Yeah, and so as we wrap up here, I think this is such an important topic that we do need to kind of increase the urgency around. Dylan kind of presented us with I think what is the bullish case for what could happen. It's priced in, and people are already anticipating this. I tend to agree, but there is obviously the possibility that that's not the case. And so I do want to stress the fact that this is something that's happening right now in our industry that everybody in this room can take action on. It's first they laugh at you, then they ignore you, then they fight you, but then, anyone know the last part of that? Yes, that's right, then you win. So we definitely want to win. And so as we kind of go to final thoughts here, I want to hear, what would your encouragement be to C-suite executives who are in this room at these companies, average shareholders, Bitcoiners? What action should they be taking tomorrow when they leave here?
Well, shout out to Bitcoin for Corporations, has done a great job organizing the industry here. But I think ultimately, these indices are most accountable to the investors who allocate based on them. And so as much as we can make noise and argue our case about why it's capricious and unfair and ill-defined, it's like the big capital allocators, so the capital groups whose name is on the index, are the ones who've got the most sway here.
Yeah, I'd say the same thing, and ultimately money talks, and so it's going to be investors making their voice and dollars heard, and that's for investors and who have 401ks or retirements, or there's probably a lot of people here in the room that have MSCI exposure without knowing what MSCI even is, right? So in that sense, maybe going to Bitcoin for Corporations and helping spread that petition or the, not petition, but the letter, open letter, and kind of letting your voice be heard.
Final thoughts, Alexander.
Well, probably the types of things that you can look with passive indices that manage funds for you can tell you something about maybe managing your funds yourself and doing direct investment.
There you go. Give it up for the panel. Thank you guys for joining. Really appreciate the conversation. Give it up one more time for our panel. Thank you, guys. We are going to keep things rolling. The stage is just about ready. I know we are at the part of the day where lunch is starting to settle in. The energy still feels pretty high in here. Can't complain about that. Thank you all for being here. Our next panel is a conversation about treasury execution, talking about OTCs and exchanges. Please help me welcome to the stage the Director of Business Development for Bitcoin for Corporations, my partner in crime, Alan Helm.
Thank you, George. Very excited to have this conversation today. And I'm joined by two great custodians that are coming up on stage here, OVEX and BitGo. I'll let these gentlemen introduce themselves, but we are going to do a little bit of a retroactive analysis just on the state of Bitcoin treasury companies over the course of the last 12 months, because the landscape has definitely changed quite a bit. But joined here by Nick and Johnny. Gentlemen, please introduce yourselves, say a little bit about your company and what you guys do.
Yeah, thanks for having me. My name's Nick Coombs. I'm the Managing Director of BitGo MENA.
BitGo itself is one of the world's largest crypto digital asset infrastructure providers. We've been in the business for 12 years. At its core, we're a regulated custodian for digital assets, but over time we've added some ancillary services that allows all of our customers to either store, stake, trade, and settle using BitGo's regulated infrastructure.
Awesome. I'm Johnny Avadia, the founder and CEO of OVAX. OVAX, at the core, what we do is we're the largest fiat to crypto market maker in Africa. We offer custodial wallet and banking payment services around that. But again, yeah, our core business is institutional market making in Africa, specifically on fiat currencies to crypto.
Amazing. Thank you, gentlemen. So to kick things off here, like I mentioned earlier, I really want to start with just a little bit of a retroactive analysis, how you guys have seen the market evolve. I mean, not even just in the last 12 months. I mean, from the custodial side, the client profile has shifted quite a bit. So I guess maybe, Nick, let's start with you, right? Coming from TradFi, getting into Bitcoin and crypto, how has that, clientele profile evolved?
Yeah, I guess I've been at BitGo for close to 4 years now, originally based out of our London office. Over time, I mean, from a European perspective, the vast majority of customers we were speaking to were hedge funds looking for a regulated digital asset sort of custodian. Over the last 18 months, we've seen a proliferation of more traditional institutional companies coming to the space, mainly on the back of clearer regulatory guidelines. Obviously, the Trump administration's come in, greatly helped that picture. And obviously, in the last 6 months, the digital asset treasury companies, what we're here to talk about, have come into the picture in a major way.
Johnny, I'd like to get your perspective as well. How have things evolved on your guys' side?
Yeah, it's been super exciting since the Trump administration has come in and created the regulatory clarity that the market needed. I think someone earlier was mentioning the end of Operation Choke Point, which has been a huge kind of boost for crypto. And the regulations with the Genius Act, we're seeing a lot of very big remittance companies, traditional banking companies, traditional corporate players who previously weren't willing to transact in crypto, even though in Africa it's significantly better. If you need to do $1 million payment or a $10 million payment, crypto is sometimes your only option. In Nigeria, for example, if you want to go to the bank and do a $10 million payment, they're going to tell you they don't have the liquidity, and if somehow you're lucky enough to get it, it's going to be about 5 to 10% fees. If you're doing that in Bitcoin or crypto, or stable coins, so Bitcoin and stable coins, it's about 0.1%. We can execute $10 million in Nigeria today in an instant, and it's just significantly better. So since the regulations have come out, we're seeing real institutions start to adopt it and make use of it when they wouldn't before, even though it's so much better.
I mean, I'll just sort of make a comment on that. The stable coins have become the killer use case, right? The actual tangible use case that drives adoption. Africa is a great example, but we're seeing that throughout the MENA region as well. So the GCC, where you've got restrictions on currencies. Turkey's a good example, where they are converting a lot of their local currency into USDT. And the transaction volumes are reflective of that. Currently the 4th largest market in the world based on crypto volumes.
Yeah, I think that brings up a really good point, is that there, for a number of years has been just a lot of stranded capital. And with the rules and regulations that have brought more clarity into the space, it gave rise to a lot of these DATs that came about in the last 12 months, right? But we're far past the era where you could just raise, a $500 million pipe round and be all good, and then you can start accumulating Bitcoin. Now we're starting to look more so at the fundamentals. Who is the executive team on these boards, and then what kind of custodial stack do they have? Who are the partners that they're working with on a jurisdiction-to-jurisdiction basis? With a lot of the attention now coming on how this execution is playing up, what are kind of the key ideals for a mature, treasury stack here? What are the things that a Bitcoin treasury company needs to look at when selecting a custodian?
Yes, buddy. Look, I think it starts with custody. If you're a serious treasury company, you're wanting to secure those assets in the most secure way possible, And that really stems down to choosing a regulated custodian with a long track history of securing assets in the space. The second aspect is, does that custodial solution plug into any other types of products? I'll use BitGo, and I'm very conscious I'm not allowed to shill BitGo too much here. But we've built a regulated infrastructure stack that allows customers to store those assets securely in a regulated wallet, but also deploy those assets into trading functionality, whether it's OTC or E-Trade, which is a trading aggregator built into the cold wallet infrastructure. And that is all secured within this regulated, insured product. On top of that, there's some yield generation strategies that are also in play, such as staking, which we see, which has become actually a huge part of our business, and also financing. Can you do that all within one ecosystem? At BitGo, you can. There's a lot of there's a few other competitors out there that are offering that type of tech stack. And I hate to use this word, but I use it a lot. A one-stop shop. Somewhere where a treasury company can go to and service all of their requirements in one regulated place.
Yep. Yeah, I think that's a solid answer. Pretty much it starts at custody, then execution, and then now some of the more interesting things that that the companies are doing, like Saylor and Simon were speaking about. I think that's becoming more and more important. Things like the Mars product that they were speaking about, or the Stretch product. Without those, I think these companies are going to struggle, and they need to evolve and kind of offer these additional products. But ultimately, it starts with custody, then execution, and then some clever financial engineering that these guys are starting to do.
Yeah, you guys bring up a good point here. I mean, now with the rise of these digital credit markets, capital markets, the ETFs that came online earlier this year, the ETPs, if you're a corporate treasurer, heck, even just a public company, and you want Bitcoin exposure, there's a pretty big menu now of things to look at besides just the traditional crypto assets. So
custodian. It's also a hedge, I guess, in a way, a hedge against the traditional financial ecosystem. If something goes wrong, if their bank accounts are frozen or stuck or slow, if in Africa and emerging markets, it's a huge problem, the volatility of the local currency. So again, you also want to make sure that that you have access to that Bitcoin. It's all good and well to have Bitcoin and have the price go up, but when you actually need it, you can't access it. That's not very useful. So my bias would definitely be towards holding spot Bitcoin.
Again, I'm going to go down the shill BitGo route. Look, I'd agree. I'd totally agree on that comment. Self-custody, sort of executing through OTC desks or sort of E-Trade functionality. And when you look at ETFs, they're obviously very attractive to the large institutional players that have regulatory blockers on investing in the physical BTC itself. They can't actually play in that arena, so ETFs are the natural option for them. Outside of that, though, there is an opportunity cost to investing in an ETF, right? You're not holding the underlying asset. You are missing out on yield opportunities by holding it and other areas of generating revenue.
So, Johnny, you mentioned here, a minimum kind of getting to the bare $1 million. So let's just say, mid-cap company, maybe you're looking at allocating $50 million, and they want to be perceived as a serious treasury company. Can we talk about the importance of diversification across various custodians, and why that is an important, maybe on a jurisdictional basis, but then also using different providers, and how you guys collaborate with one another, because you guys do work with one another quite a bit.
Yeah, sure. So I'll start with the second question. And so we offer custodial services now more and more to remittance companies across Africa. It's a big product. And our custodial business is built on top of Fireblocks currently. We have worked with BitGo in the past, and BitGo is a great custody solution. I think we could work together with BitGo on OTC and liquidity for their clients and plugging in there, and we'd love to do more of that with you guys. And to answer the first question, kind of the diversification, I would suggest going with one custodian. I don't think that it's necessary to diversify your custodians per se, depending on obviously your regulatory requirements. I think you want one strong custodian. You want to have your disaster recovery set up, your backup set up, and you want to make sure that the thing's set up incredibly well. But you don't want to have to do that across 3 or 4 different custodians. It's very expensive. It's a lot of overhead. It's very difficult. So, and one with the proper backups, that's really what you're trying to do. Make sure your backups are in place, make sure your access control is kind of ironclad. And again, if you're a treasury company, it's not like you're accessing the Bitcoin on a day-to-day basis, not even weekly, monthly, maybe quarterly at most. So it's pretty easy to lock it up, leave it safely, and I would go kind of one custodian and make sure you do the absolute best job of securing that.
Yeah, it's just interesting hearing it from Jonathan's side of the fence, right? So he was, essentially underlying client of BitGo. I think what happened, and maybe in the past, unlike TradFi, where you see a lot of custodians offering the exact same service, it's quite rare in crypto to see every custodian offering the exact same service. In recent times, it's become more commoditized, for sure, but each of them have slightly different nuances and USPs, if you like. What BitGo does, and I'll just use this as an example, not shilling, is we really go down the sort of regulatory route. We secure licenses. We run 7 different license entities globally. And we've really focused on having a localized approach, having people on the ground, having an entity in the region to service local customers, because each of them has slightly different requirements. On the second point, OTC, look, we'd love to collaborate. I think where we've struggled is having that localized banking rails, for example, in Africa, which is really difficult to secure, and banking's still a real pressure point for our industry. And we also offer things like off-exchange settlement, where we actually can plug in and integrate directly with brokerages that allows our customers to securely store their assets in these regulated insured wallets, but deploy those assets into an external exchange for trading purposes.
So I want to shift conversation here as I'm looking at the time here real quick, and I want to focus a little bit maybe locally here in the MENA region. Nick, I know you're based here. We're in a region that has a ton of capital. They're always looking to deploy it, but the advancement of DATs in this region has been a little bit close. So I want to hear a little bit firsthand from your experience maybe why that is, and what the landscape might look like 4 to 5 years down the line, and how will some of these companies accelerate in that time?
Yeah, good question. Yeah, so look, I've been here for close to 2 years. BitGo itself has set up a regulated entity in Dubai under VARA. We have seen and have had conversations with multiple DATs or potential DATs. We're seeing movements from companies that haven't been involved in crypto before, and whether someone on the board or the owner has been orange-pilled at some time, which is almost certain the case. They're looking to sort of build a sort of a Bitcoin treasury, but to be frank, it's slower to adopt than other regions. Certainly when you compare it to the US and somewhat Europe in a small aspect. But what I see moving forward is there's certainly a lot of capital here. There's certainly a lot of people that are extremely interested in Bitcoin itself. I mean, you just have to look around here and the attendee. I came to the first conference here last year. It's grown significantly since then. And the regulatory clarity is here. We've got a couple of fantastic regulators, ADGM, VARA, heavily focused on crypto. The government is supporting the industry. They're attracting companies. So I think it's just a matter of time before we see a lot of these DATs being domiciled here and started.
Jonathan, would like to get your take on this as well.
Yeah, sure. I think a big reason is that a lot of the capital here is controlled by a few kind of funds and generally government institutions. Those entities are very active, doing a lot in the space, a lot in the mining space, and they are kind of doing a lot, but they're doing something slightly different. I don't think there's a huge amount of retail capital that is looking for access, or looking for access through a vehicle like a DAT. I think that's probably a big reason for it. It's where your capital is tightly controlled at the kind of top level, and there's huge amounts of capital, and it is certainly being deployed into crypto, as you can see here, but through different means, something more direct, more hands-on. They have a lot more control over the capital, less mandates. A lot of these DATs are mandate-driven. Why do people invest in a DAT? Or why were people investing in Grayscale, for example? It was a horrible product, locked Bitcoin, huge premium. They had to do it. They had no choice. Whereas sovereign wealth fund in the UAE, for example, wouldn't do that, right? They would go there, buy the spot Bitcoin, have the control, they'd be able to add yield or do other things on it. So I think that's probably a big reason for it as well.
Now, Nick, you mentioned this earlier, that typically when you're interacting with the client, it's a CEO that's been orange-pilled already. But just because the CEO is orange-pilled doesn't mean that the rest of the C-suite is. So what are some objections that you typically have to deal with? What advice can you give?
Yeah, you're completely correct. Normally the message comes down from the top, and then it doesn't fully trickle down to the people that we actually speak to. Look, I think risk controls and just getting a good understanding of the space. A lot of these guys are really smart. They're used to, taking a step back, look at traditional treasury management. Diversification is the name of the game in many cases. Bitcoin's not like that. It's all in, right? You've got to have that strong conviction and follow through. And not only do you need the strong conviction, but you need to have the risk processes in place, the risk matrix, management, and be willing to manage the process during these 30% plus drawdowns that we see in the market on a fairly regular basis.
Jonathan, same question back to you.
Yeah, sure. So kind of similar, I don't have much to add on what Nick said, but I would say spot on.
So the last thing I want to get into here, right, with the last bit of time that we have, when it comes to liquidity and being able to access, spot BTC, you mentioned that, it's best to be in-house with, maybe one provider. But there is the jurisdictional arbitrage side of things. So how would you recommend that people diversify and spread risk out and be able to access the best, spot price Bitcoin?
Yeah, there's huge arbitrage, especially in the markets we operate in. In Africa and emerging markets, crypto always trades at a premium, guaranteed every market you go to. And that's because it's a superior form of money. It's significantly better than local money. It's significantly better than any form of access you get to dollars or hard currency in these emerging markets. Every single country, emerging market that we operate in has a premium, and Bitcoin doesn't trade at the same price in any of these markets. I would say that you have to kind of consider that cost when entering the asset. And once you're in the asset, no matter where you bought it, where you came from, you're in Bitcoin or you're in, let's say, a stable coin, and you're in the same thing no matter where you came from. So I don't think you have any means to avoid that. I think that the entry price is the entry price, and that's simply the real value of your local fiat currency. It's the central bank might say it's worth X, but in reality it's worth X minus 10% in many cases. I don't think you can't avoid that. You have to simply pay it. It's the price you got to pay to get out of, frankly, a fiat shitcoin into a hard currency.
Spot on.
So we got 45 seconds here left for any CFO, CEOs in the crowd. Last bit piece of advice that you could give them. Jonathan, let's start with you and then Nick.
Yeah, buy Bitcoin.
Speak to BitGo.
Good one. Well, gentlemen, that's all the time we have. It's an absolute pleasure to chat with you guys today. And of course, please come up and say hello. Thank you.
close to the end here, sadly, but we do have 3 more exciting panels talking about Bitcoin corporate adoption. So here to introduce our next panel, Engineering the Institutional Bitcoin Economy, host of the Stephan Livera podcast. Please give it up for Stephan Livera.
All right, thank you for joining us. So let's get our panelists up. We will just let's do it in the order. So we'll go. You'll take that one. So our panelists today are Kyle Wall from Dominari Securities, Gary Kruglicek, sorry about that, Ifinio, and Gurpreet Oberoi from Kraken. So I had a couple ideas that I thought we would share, but let's just start super quick. Can we just get an intro on each of you? Who are you? What are you doing in Bitcoin?
Hi, I'm Kyle Wool. I'm the president of Dominari Holdings, CEO of Dominari Securities. We're a full-service broker-dealer. We were the company that was one of the founders of American Bitcoin. I was a gentleman who did Justin Sun's debt, and we've financed a lot of Bitcoin companies, including we financed Prenetics right here with Danny over here a few weeks ago. We put $44 million in.
My name is Gary Kruglicek. I run the Bitcoin strategy at Ifinio. Ifinio is the first German Bitcoin treasury company listed on the Hamburg Stock Exchange in Germany.
Hi guys, my name is Gurpreet Oberoi. I run the institutional business at Kraken. I ran my own fund before and spent 10 years on Wall Street.
Excellent. So, elephant in the room. The sector is down right now. Obviously, is it a lull? I'm curious to get your thoughts on how that, whatever we're calling this lull, bear market, or whatever, how is that impacting fundraising for Bitcoin treasuries? Whoever said, yeah.
Yeah, so in my opinion, it's difficult to raise money into a company that's trading below net asset value. And the first thing you have to do as an investor and say, why is the company trading below net asset value? And I think a lot of it has to do with people bought shells or vehicles and they didn't really understand what they were buying. And they need to look at what the underlying business was that they bought. Does it have a burn? What is the debt? And I think a lot of it, if you can find the right company that doesn't have a high burn, it doesn't have a lot of debt, and if it's trading at 30 or 40% below the net asset value of the Bitcoin, it's probably a buy. So I think it's an opportunity to go out and do some bottom fishing, but know what you're actually looking at.
Yeah, I would agree. I think we're in deep value territory with a number of those companies, especially that run a healthy operating business. Our company has been, working in the alternative lending space for the past 12 years, 8,000 SME customers diversified all over the country. But yeah, I think many investors don't look really beyond the headline and don't do real analysis. But I think with more thought leadership, more education, more presence at events like this, and using marketing and social media tools, I think we can generate a shift in understanding what makes a good treasury company, or how do you compare a good from a bad publicly listed company, like with any stock, and the same goes for treasury pubcos.
Yeah, and we're a service provider, so we service everybody, but my take is this, right? Like in any industry, there's going to be winners and losers. I think the concept the Bitcoin guys made of NAV doesn't really make it's a made-up concept, right? I mean, a stock is demand and supply. I mean, stock price goes up on demand, right? There's no demand for the stock; it'll trade below NAV. I think right now, the winners are sort of identified. You look at the top 5 treasury companies, the trading volume, and I think when the market recovers, I think those are the ones to bet on to really have a good alpha in the next bull run.
I see. So, yeah, it's a good point there. Let's talk a little bit about that because, as we said, MNAV is a particular metric that we use when we're talking. It's one thing to analyze, but perhaps if that company has an operational business, it's a bit more complicated now because now you've got to disaggregate the operational component of it from the pure play aspect of it. Do you guys have any comments on that?
Yeah, I do. As one of the original founders of American Bitcoin, I think those are the companies people should be looking for. how are they accumulating Bitcoin? Is it just by running an ATM to buy it like a DAT, or are they actually able to pull other levers to go out there and mine Bitcoin at a very unique price point? So you can go ahead and actually have revenue and earnings and not just be a company that's out there running the DAT and running the ATM. And I think that separates American Bitcoin from a lot of these other companies that are just a DAT. They actually have revenue and earnings.
That's interesting. I mean, personally, I'm curious to hear your views. I actually think both models can work, but maybe if it's a pure play, then maybe it really is important that it has a low burn, like you said. But what do you guys think? Let's survey the opinion on the panel. Do you think it must have an operational business, or can a pure play work?
I would say it has to have an operational business for sure. There are also legal and regulatory requirements in certain jurisdictions that if you just take an empty shell, put in some Bitcoin into that, you might be considered, basically a fund rather than a proper company, and that might get you into trouble being delisted or any other potential stock exchange requirements that you don't really fulfill. So I think it's a must-have, and also maybe one point in regards to MNAV, probably around this conference alone, if you ask 5 people how they define MNAV, you'll get 6 answers, 6 different answers. So I think, we need to do better. Maybe we need to come up with better metrics, but clearly MNAV is not really a very good way, not a very single way to assess a treasury company.
I think both models can work. Again, you buy a stock based on future earnings. So if you buy a treasury company with an operating business which has good future earnings, it's a good buy, right? If you buy a shitty operating company, that's a bad buy, right? So really, it's a very case-by-case basis. But I always say for the treasury companies, yes, Strategy, BitMine, a few others will exist, and will get bigger and bigger in the next cycle.
Now, another very hot topic is yield. Now, the other thing that comes to mind when people think of yield is obviously the Celsiuses and BlockFis of the world. And I'm curious to get your thoughts there on whether treasury companies should be seeking out this yield, and also, do you think it should be an on-chain form of yield, or should it be more like TradFi, derivatives, finance, this kind of yield? What are your thoughts on yield there?
Yeah, I think yield is a very interesting topic, right? Because you can go buy IBIT, BlackRock's ETF in Bitcoin, and you can write covered calls on it, and you can do stuff like that. But if you really believe in the underlying Bitcoin itself, and you believe Bitcoin's going to go higher, and you continue to sell covered calls, it's probably going to get taken away from you.
You're giving off the upside, right?
Yeah, so I think if you're really buying this for yield, there are other ways to do it, and you maybe look at... I personally wouldn't be sitting there looking for the yield. I'm very long Bitcoin. I think Bitcoin's going to go higher over time. If you want to play around and trade options all day long, maybe this isn't the right investment for you.
Yeah, I would probably second that. Bitcoin in itself doesn't generate a yield as we know, at least not a staking type of yield. Having said that, I think with the market evolving and becoming hopefully a bit more mature, there are more and more interesting ways to generate that yield. I think MetaPlanet has been pioneering ways, be it covered calls or other derivatives, that could potentially enhance your strategy and generate some return. But I think we're still in the first inning or in the early days to see what's really going to happen. I can definitely see a future where a number of big Bitcoin holders, I'm not necessarily going to go as far as say every Bitcoin treasury company, but bigger, let's call it more corporate holders of Bitcoin, will start lending out that Bitcoin eventually. But that's kind of the thesis in a hyper-Bitcoinized world where the supply will be met with huge demand for Bitcoin liquidity.
I mean, Bitcoin has robust, capital markets. So I think, like any business, like gold, oil, right? I mean, there's risk of loss, right? So if you're going to acquire a yield strategy, you better find a asset manager you trust who can underwrite the risk. And the yield comes. There's no free yield, right? There's chances you can lose money also. So if you're going to position your strategy, underwrite the manager, underwrite the risk, and make sure you can still make a loss if that happens.
Yeah, I think that's a fair comment, and it's probably also fair to say it's not an all or nothing thing, right? That, let's say, Metaplanet, I think it's only a small fraction that they're doing this play, not the whole stack, and so maybe that's where it goes as well. That people will take fractions of it, and understanding the risk. Maybe another interesting one that's like Bitcoin, let's say, more native is like this kind of lightning yield concept, but admittedly, the whole Lightning Network publicly has only, 5,000 BTC in there. So, I mean, there are treasury companies who have more than that just in their own stack. So, and but it seems to be growing. So, any comment on the Lightning yield? Is it relevant yet or not really, but maybe it could become relevant? What do you guys think?
I mean, for me personally, it's not something that I'm really focused on. If I was looking at yield, I'd probably be looking at more like a BNB or something like that burns its own token and how they stake it. For Bitcoin itself, I would rather myself, and I'll defer to these gentlemen because it's not something I focus on, but I'm more long Bitcoin for the long term as an inflationary hedge. I see gold up 60%, silver up 92%, Bitcoin flat. To me, that's an opportunity to buy Bitcoin.
Yeah, I think, as you said, the Lightning Network is still in its early days when it comes to generating additional income for people that want to utilize their Bitcoin for that. But I've seen more and more discussions around people saying, hey, you want to experiment, and maybe it's not a bad idea to put one Bitcoin into it to see how it goes and see what kind of level of security and upside can be offered. Because as a publicly listed entity, you want to be better safe than sorry. So, anything that has something to do with additional counterparty risk or any technical attack vectors, you want to be extremely careful.
Yeah, I mean, I don't really have a view. I think just underwrite the risk of it. I don't think it's that dominant yet, so it's not something at scale today.
Fair enough. I mean, it is sort of small relative to the sizes here. Let's talk a little bit about institutional adoption and what do institutional clients need that, let's say, retail people don't. Like, what are some things that that are particular for institutional large clients?
I think that's a great question, right? And you see with the MSCI and the indexes going on right now, institutions all have different investment theses, but most of them have to have a certain market cap and they have to have a certain liquidity. So a lot of the DATs that are out there don't have enough liquidity for the institutions to buy them, and the market cap's not big enough. So institutions themselves, I think they're going to buy the native token. They're going to buy Bitcoin itself, right? And I think the retail investor, they may play around in the DATs, but I think a lot of institutions really can't build a huge position because of the lack of liquidity and the market capitalization.
Yeah, fair point. Anything else to add, guys?
Yeah, I would agree. Liquidity both for the underlying asset, the stock, and Bitcoin itself. And I think there are certain tax and regulatory questions that many institutionals haven't spent enough time answering or digging deep enough into that. So many parties we've spoken to, they didn't even know that they can have legally certain exposure to either us or Bitcoin itself in a corporate or institutional setting. So it just shows how early we are that institutions and corporates in Europe, in my case, still don't understand fully what it means to be exposed to Bitcoin, and actually it's way more straightforward than maybe it was 3, 4, 5 years ago. Also, thanks to MiCA and other pro-Bitcoin regulation.
Yeah, I think as Kyle mentioned, things to increase liquidity. I think a cost of capital for Bitcoin, Ethereum, different benchmarks like you have in traditional financial products. So I think as they become more, you'll see more adoption in derivatives further growing and other capital market activities. So I think what traditional financial products like gold, oil, and metals have, as the same frameworks go into crypto, I think you'll have more adoption in institutional investors.
So you see it as like a parallel to the commodity world, let's say. So we've got a little bit more time. So I guess just one other question that comes to my mind is getting shareholders and investors aligned, right? So I guess that's probably another important concept. If you're running a treasury company, you obviously want liquidity, as you've mentioned, in your equity, but you might also have, let's say you have debt, and those debt investors are they aligned with you? And even the shareholders, like having alignment there. So can you comment a bit on what does that look like? How do you achieve this alignment in a way that's beneficial?
I think a lot of it has to start with who's the CEO of the strategy, right? I think Tom Lee has done a tremendous job of going out there and evangelizing his story. And I think that's why if you look at his particular debt, has tremendous amount of volume, is traded very, very well. I think a lot of these companies, a lot of these debts have CEOs who've come in here that have never really run a publicly traded company before. They don't really know all the intricacies. And now you're talking about debt. You're starting to see some people that want to go ahead and raise debt. And they're going to do it in a variety of different ways. Obviously, Michael Saylor pioneered this. He's way ahead of everybody else on that. I think people will continue to try to do it, but I'm not sure if all these CEOs are really ready to run the debt portion of a publicly traded company yet.
Yeah, I agree. I think many more Bitcoiners need a couple of marketing lessons or PR lessons. And I think we have some great idols or icons in the industry, starting with Michael Saylor, that definitely played the marketing or PR book very well and executed very well on that. And I think everyone shouldn't just copy the actual financial strategy, but also the marketing strategy, the marketing playbook. And I think with that, we'll have way more positive sentiment and also more positive attention.
Yeah, I echo with Kyle. I think a strong CEO, strong communication, and showing results, right? I think what BitMine does is they say they're going to execute on simple strategy, they execute it, show monthly data, and keep showing progress, right? It gives investors confidence that there's progress going in the company. So I think a combination of all pieces Kyle mentioned.
Interesting. So I guess maybe another question might be how replicable is it? Because maybe there's only so much attention to go around, and so it's kind of like your ability to capture attention, to your point around, Gary, around marketing, and I guess to your point as well, around having a visionary leader who gets invited onto not just podcasts, but onto news shows. And the kind of person who will get that invite, I guess, how easy is it to find someone like that?
Well, 100%, and that's true for every industry across Wall Street. Steve Jobs was Steve Jobs because he was the great evangelizer. He had Guy Kawasaki out there evangelizing the message of Apple, making people believe they needed Apple in their life, right? You've had companies that are great companies that the message could never get out there, the stock never traded, it never had volume. So how important is it to have a leader that can go out and tell your message? I mean, it's probably the most important, if not second most important, because you do have to have a good product as well. Apple also had a pretty good product.
Like the front man in the band, you need like a real strong lead who can attract attention, capital, and volume.
Yeah, and I think we have some amazing people in the industry that now call themselves also head of Bitcoin strategy, whatever. And what I noticed before, I thought to myself, is that a position I wanna be called is too many people become too technical and are maybe too nerdy. Like we love it because we get it and we understand. We kind of speak the same language. But outside those four walls, most people wouldn't even understand 9% of what we're talking about. So I think the Steve Jobs type of characters that can explain the concept of MNAV and preferred shares in comparison to a high yield bond in simple terms to, let's say, your average financial investor, if that's who you target, of course. Then I think we'll get to that moment where people understand, okay, wow, there's a new financial paradigm shift potentially, where new instruments that can compete with your savings account, etc., are actually not that difficult to understand. But yeah, we definitely need to do, we have more homework that needs to be done.
So we've only got a couple minutes left, but I guess last thoughts, or if you have any thoughts on what is the next evolution? Is there a treasury company 3.0? Is it, what are some of the upcoming trends to watch out for, or something that's not so well known now, but you think it's going to be a big trend?
I think, again, it's going to be these companies that add a different component to them like revenue and earnings. Like if you look at two of the companies, a little self-serving because I brought both of these companies public, but if you look at Tron with Justin Sun, bigger than life personality. You look at American Bitcoin, you have Donald and Eric Trump, right? So when you get those names out there, and if you are going to put in something that has revenue and earnings or something different where they're going to start to bring in some of that native yield from the token itself and actually pay out a dividend, I think if you have a mouthpiece to get that message across, you could get some real volume, you could get a market cap, and then maybe bring the institutions in to tie up the conversation.
Fully agree. Yeah. So I think potentially we'll have more rock stars running those companies. I don't know if I would call it Treasury 3.0. I think co-alignment with politics, the current zeitgeist. I think Saylor mentioned that without corporate Bitcoin players, including exchanges, we wouldn't probably have the ETF. So I think it's up to us, to the corporate players in that industry, to also educate local markets, local regulators, local politicians, lobbyists, groups, etc. And I think that's what I would want to see in more upcoming players, that they don't just talk like the Bitcoin language, but can also talk the language that needs to be spoken with politicians, etc.
Yeah, I think the next year, one thing we see already is volatility. I think it's just the companies that can navigate volatility through different capital market activities, different marketing, different branding. We'll see. They'll define the winners and losers, in my opinion. Who basically is pays for either a Bitcoin going to 200K or a Bitcoin going to 50K, and who can benefit in both scenarios.
Fantastic. Well, I think that's all we have time for. So everybody, please put your hands together for Kyle, Gary, and Gurpreet. Thank you.
All right, give a round of applause for Stefan, Kyle, and Gary and Gurpreet for that last panel. We are nearing the end of the day here at the Bitcoin for Corporations Symposium. Up next, we have Translating Bitcoin for Legacy Corporates, moderated by the one and only Sam Callahan. We'll let Sam and team come up here on stage. Sam.
Hello. Hello, everybody. All right, I'm sitting here. Let's welcome to the stage, we got Leonard Lopin. He is the Chief Technology Officer at Byte Federal. And we got Sean Bill. He's at Bitcoin Standard Treasury Company. And we got King Oi. Is he here? Is King here? Maybe I'll put this here. All right, guys. All right, so let's kick this off. Why should a corporation consider adding Bitcoin to the balance sheet today? Not wait even a single day. Why is there a sense of urgency of why they should add Bitcoin to their balance sheet? Let's start with you.
I think there are quite a number of reasons for a legacy business to invest. So as a background, our own company started in the US about 10 years ago. In the crypto space, fundraising is extremely difficult, depending, of course, what you do, but it's not easy from a banking and VC perspective. And the Bitcoin strategy that basically our company grew up with allowed us to self-fund. So I think just from one perspective, it might help legacy companies, even if they are cash flow positive, to build up a buffer, a security buffer for when they are getting in trouble, when it's difficult. It's like an in-house credit line, just from that basic perspective.
So I think it's it's kind of, we've all heard it's kind of cliche, but the dollar devaluation, the purchasing power issues that are out there. I think for corporations that can get exposure to Bitcoin, this is going to be a process that takes a long time. So get some on the balance sheet, as Anthony Pompliano likes to say, get off zero, right? Get it in there. Get your boards used to looking at it. Obviously, it's a volatile asset class. I thought Matt Hogan's charts earlier today showing kind of the volatility, the historical volatility of gold was really representative of that, yeah, Bitcoin's volatile, but it's actually not out of context. I mean, if you look at it compared to other assets, it's kind of following a similar path. And so I think that if you can get your exposure now, while Bitcoin is still relatively cheap, you're going to look very smart in the future. And then I think we're going to see Bitcoin fused into capital markets much more aggressively down the road here. We're already seeing kind of the dominoes falling with the major TradFi institutional players that are now saying, yes, you can have Bitcoin on the balance sheet. Yes, you can have Bitcoin in your portfolio. We actually pushed this in 2019. It was the first U.S. pension fund to buy Bitcoin in 2021. And now we're having that validation that came first with BlackRock, then Morgan Stanley, then Merrill Lynch, and it just keeps on, the dominoes keep on following.
Yeah, just to piggyback on that, I think about how really up into the pandemic, really since the late 80s, there's this trend of like decapitalizing business, right? You just kind of give the money back to the shareholders, via dividends, you can do share buybacks. And what it created was, a lot of growth and focus on like quarter-to-quarter growth, but it made it less resilient. And I think after the pandemic, there was a lot of wake-up calls in terms of corporate treasury management, and you saw the cash positions in public companies just kind of explode. But then there was this problem, and that's inflation, right? Debasement. And so they start to think about what assets to allocate to, and there's different rules around holding securities, and then suddenly you're landing what actually outperforms monetary inflation. And really what it comes down to is there's not that many options, and then Bitcoin is obviously one of them. But you were kind of talking earlier, and there's actually, AI is the talk of the town, and that could be another topic of why there's a sense of urgency of why companies should acquire Bitcoin. And so why don't you go into a little bit, because I found it interesting.
Yeah, let me add one extra thing. I think a lot of people here are big fans of the Bitcoin Standard, the book, and you could make a case that companies are really, if they are capitalist companies, they want to be owning capital, true capital. And so the idea of keeping hard money on your balance sheet, I think, makes a lot of sense if you really truly believe in capitalism. And Bitcoin has proven this over time, over the last 10, 12 years, for companies that did accumulate Bitcoin over time. It's a benefit to actually hold hard money. The other aspect of AI that we mentioned earlier in our own discussion here was that I truly believe that, and a lot of people probably agree, we'll see very soon an autonomous AI economy where the AI themselves make decisions, economic decisions, and their native currency is not fiat. Their native currency is digital and is probably Bitcoin. They will use maybe other cryptocurrencies to interact with each other, but I believe they will accumulate Bitcoin. And if your company has Bitcoin and on and off ramp, it probably allows you to interact and future-proof your own business.
It looks like we got King coming up here. But Sean, okay, so a company decides to acquire Bitcoin. You said get off zero. They can hold that and that's okay. It's a debasement hedge. They're protecting and preserving their wealth over the long periods of time. But there's also a way to do it actively. And you talked about this at the Bitcoin Treasury Company, that you guys are being active with your treasury strategy. Can you just break down the passive versus active and what that actually means?
Yeah, so I think, so when you step back and you look at it, you don't see corporates holding gold, right? You do see them holding Bitcoin, though. And part of that is, if you think about gold as a bearer asset, it's very difficult to get a yield on it, et cetera. It's the same with Bitcoin in the sense that it is not easy to get yield or to generate a return on it. But we're seeing that market develop now. We're seeing the options, strategies on the covered calls and puts. We're seeing the basis trading. We're seeing various different alpha strategies. I think that I could tell you that BSTR, we were working on a couple of skunkwork projects that I think will unlock yield at a much bigger scale than anything we've seen so far. We have to prove it out before we talk about it publicly, but we are working on it in the background. So I think that, what is your objective when you hold a treasury? Well, you are looking for a return on the asset. So this is a critical component for Bitcoin. Now, I think 1.0, is let the Bitcoin do the talking for you. 2.0 is, hey, our Bitcoin is an asset and is fully forward deployed and earning a return. And that's where we're kind of getting into now. I think that's kind of the next generation, and that's what's happening. And to your point about payments, I think that Bitcoin has tremendous utility here with the Lightning Network and what have you. You can't move small fractional payments online through the credit cards or the wires or the ACH or whatever. You can do it on Bitcoin or on layer 2 technologies like Lightning, and you can do it instantly, and you can do it for like fractions of a cent. So I think that's a huge unlock, and I think that's going to be another really interesting, thing that will buttress your case in terms of AI and payments.
King, welcome to the stage. How are you?
Good. It's good to see you guys. Apologies for being late.
Oh, no worries. No worries at all. So you guys have a treasury company in Amsterdam, if I'm correct. So like in Europe, you guys are building it. And you also have a conference. And so we're talking about, translating the Bitcoin message to legacy corporations. And so what kind of, unique challenges do you face in Europe? And then how do you use your conference to help push that message?
Sure. I think, as I've heard before here on the panel, is the interesting thing now is in this new phase we're in, we're all going to have differentiated business models. And every Bitcoin treasury is going to do it sort of slightly different from the others. And some very different. And for us, indeed, the conference is an important component. Building the ecosystem, educating, bringing community together. Last month was a great high energy event. That was the core. That was what we're starting with, and we're strategically building out different businesses within the Bitcoin ecosystem, including, for instance, Bitcoin Netherlands Magazine as one of them. So for us, that's important. I think if you think about Europe broader. Obviously, the interesting MSCI discussion that's happening is that it's kind of become clear that having an operating business or some sort of business around it, as opposed to just holding Bitcoin, is becoming more and more important. And similar to what you're hearing here, we're actually also building out a variety of initiatives on our side to do that.
Yeah, it's an interesting point because at Orange BTC we have an education company, but we kind of can use that to push our mission to accelerate Bitcoin adoption, kind of taking that education infrastructure and then building Bitcoin curriculum and courses and educational resources. But do you guys think there's an advantage to having an operating company that does kind of work into the Bitcoin ecosystem? You can kind of utilize that, or do you think it's beneficial to have a kind of diversified operating business that isn't tied to the Bitcoin, isn't tied to the Bitcoin treasury? And how do you think about that? Yep. Either one.
So personally, I think it's the better model if you do have an operating business that brings income in, because a lot of the legacy companies, if we think about legacy companies, they will be smaller, potentially businesses and cash flow positive. If they start just accumulating, stacking sats basically on a corporate level, I think that's a good way for a lot of them to start. So and probably the education that you and others have been provided, it's maybe enough at this point for them to convince the owners of the business to start somewhere.
Yeah, so the Bitcoin Standard Treasury Company is really focused on building the Berkshire Hathaway of Bitcoin. So we are looking at it as we want to build a financial juggernaut that is basically a financial fortress and really do Berkshire 2.0. And that means, if you look at Berkshire Hathaway, which has, a rail company, has coal, has, power utilities, they're kind of vertically integrated across the traditional economy. We want to do that within the Bitcoin economy. So we want to have, not only an actively managed treasury, but also wholly owned subsidiaries within the Bitcoin ecosystem, where that could, down the road, that could be future payments companies, futures exchanges, all kinds of different things. And the idea being that we want to, we believe that you want to be fully on the Bitcoin standard, so we want to be generating return in Bitcoin. Our mission is to increase Bitcoin per share. Where we raised about roughly $5 billion, 30,000 Bitcoin on the balance sheet, another 1.5 billion in fiat that will be converting into Bitcoin. And we think that 17 years in is still super early. You're in a great position here to become kind of like a financial fortress of the future to really catalyze and fuse Bitcoin into the financial markets.
Yeah, I would say, just add to that, I think the really cool thing about Bitcoin treasuries is that it's a way for Bitcoin to be utilized, right? I mean, holding Bitcoin is great individually in wallets and everything, but it's sort of sitting there. And it's very important as digital gold, as a value accumulator, but it still stays passive. And what Bitcoin treasuries do, holding these on their balance sheet, is then they're able to utilize it and bring it part of the financial system. If you think about a traditional system, right, you have the first layer that we're thinking about is indeed building the infrastructure around it. And some of it is non-financial, some is financial. And then if you think about what Strategy is doing with all the different digital credit bonds, right, they're issuing, that's sort of a whole new market that's being opened. And after that, with a whole range of different yield maturities, different type of instruments, there's actual arbitrage that can be done on it. So you're really creating the whole swaps market actually in a way. So we want to be part of that in our own way, and especially from the European side.
I think there's one really interesting thing there about the arbitrage, because if you think about Bitcoin today, I was just at the Milken conference Thursday and Friday, and if you look at kind of the development of the high yield market and the inefficiency there, and how it was not well understood and how it was not efficiently priced, and you were getting paid an extra 600 to 800 basis points over an extra 300 basis points of risk. I feel like that's where we are with Bitcoin. You have the Bitcoin treasuries that are paying 10% yields. It's because the markets don't understand the technology and what's happening. That won't last forever. I think it's basically like Bitcoin is kind of like in that same period as like the late 70s, early 80s of high yield debt, and eventually they'll be well understood, and those fees will come down. I think actually Bitcoin should trade inside of treasuries, right? It's probably ultimately a better asset, but obviously very mispriced right now.
Yeah, I actually recently read Predator's Ball.
Classic.
Yeah, and so I saw so many similarities between the growth of that market and then looking at like the Bitcoin-backed securities market, the digital credit market that Michael Saylor has pioneered. Does the Bitcoin Standard Treasury Company, I mean, you guys have your own preferred, so obviously you're kind of going that route as well. So that's part of the Berkshire the mission that you guys are going, right?
Yes. So first off, anybody in the audience that hasn't read Predator's Ball, go get Predator's Ball. It's an entertaining read, and it will also give you a great roadmap for how the high yield market evolved. And I think we're seeing a lot of these similarities with what's happening with Bitcoin credit. And then you can go get Glenn Yago's book on junk bonds, which will really give you the deep dive. Yeah. But yes, so Bitcoin Standard Treasury Company, we have a convertible bond that was a 1% coupon up, I think it was 30 or 35 on the conversion. We have the preferred equity, which was a 7% coupon that was priced at a discount. And then we did $350 million on that deal in the U.S. We did 500 plus on the convert. And then we have about 400 in common equity. So we want to have we want to have access to the full capital stack. And so when we're looking at, what we're going to do next, we're actually exploring the idea of issuing debt and preferreds in Switzerland, in Japan, other markets. We want to be a global player on that space. And then in terms of why come to Bitcoin Standard Treasury, if you're a portfolio company, well, part of that is the access to cheap capital. So if you are a private Bitcoin company and you're paying, somewhere between 7 to 12% or 7 to 14% to borrow money, you come over to Bitcoin Standard Treasury Company, and our cost of capital is 1% on converts, 7 on preferreds.
Yeah.
Very much cheaper capital, access to cheaper capital.
Yeah, I've thought about this in like like the Cantillon effect. That's Bitcoiners are getting closer to the money printer, especially large corporations can get better terms on the debt. It's basically they're taking it and they're turning around and buying an asset that's appreciating at 30% a year. But let's talk about some of the challenges, because if you're a legacy CFO and you recommend this, you buy some Bitcoin, and then Bitcoin tanks 30%, and then you got to go to the board. How would you justify your decision to a board, that you made the right decision even though Bitcoin's down 30% since you bought it?
Well, my problem is I can't answer the question. We were all Bitcoiners who founded the company, so we knew what we were getting into.
Nice.
But there's one interesting thing you just mentioned. Yeah, in a world run by central banks, you want to be as close to the printing press as possible. And ideally, also at the same time, as close to hard money as possible. So I think the Michael Saylor strategy makes a lot of sense. It's like a pincer attack. So for us, Bitcoin was the silent investor that we otherwise would not have had. And it allowed us to scale the company. We did like 100 million over the last 3 years every year, returning revenue and bootstrapped from zero. So it's the hard money itself has some kind of almost magnetic effect that it attracts more sound and hard money. And I think you can't go wrong as a legacy company if you start somewhere with Bitcoin.
I'd say the most important thing is really having an aligned shareholder base, right? Whether you're in the private stage, which we're currently still in, we're waiting for our listing to be approved, or public. So for instance, in my round, we did buy Bitcoin with it. We have 1,111 Bitcoin. And obviously Bitcoin is down since when we closed our round, but no one has ever called, oh, we're down 20%, right? So it's very important to have the right investors who have the long-term vision. But also as a public company, it's the same, right? You need to go through the ups and downs together, and hopefully it's more ups and downs. But very important to have the board aligned, shareholders aligned, and management team.
Yeah, I would just echo what King said. I mean, I think if you look at the Berkshire Hathaway and the investor base and the lack of turnover in that investor base, I think something like 90% of the shareholders have owned the stock more than 5 years. I think if you can have an alignment with the investors, that's the magic ingredient.
I think that's like a function of like transparency, education, investor relations, which is something that Saylor kind of set the bar, but down the entire industry is very, very transparent. In terms of what we're doing, in terms of capital raising, which I think is really important to get that alignment. And so let's talk about, like, maybe start with you, King. It's just, at what point does not having a Bitcoin treasury become a competitive disadvantage? And maybe we're already there, but we're looking at corporate adoption. We're at the tip of the iceberg. I mean, we're talking about hundreds of companies. There's thousands and thousands of companies that all suffer from the same problem. That haven't woken up to this yet. And so at what point does not having a Bitcoin strategy become a competitive disadvantage? And we'll maybe go down the road.
Yeah, sure. If you think about the classic adoption curve, right? We're at roughly 3% adoption now, so still very, very early, as we always say, on Bitcoin adoption. If you think about internet adoption or social media, it took sort of almost 20 years, I guess, to get from maybe 10 to go from 3 to 100%. I think everything we've seen in our space just goes incredibly fast, right? The development, the fact that having new asset class worth almost 2 trillion, only 17 years old is insane if you think about it. So having said that, I think I would count on this increasing very rapidly from here on. We've started, in the last few years, really increasing with Bitcoin treasuries, and for that spillover to go from, hey, I'm a normal company, normally I would put my cash in treasury bonds or something else, a money market product. I'm going to do it with Bitcoin and move forward. I would give it a couple of years for that to really start increasing.
Yeah, I also think it'll be a few years out before it's a problem not to have Bitcoin exposure. When we've seen a couple of folks bring these shareholder votes for Microsoft and others, and you're really not getting the adoption yet. You're not getting the pushback yet from shareholders on it. So maybe that might come from an activist investor, right, at some point, and maybe that would be kind of the canary in the coal mine for when it's going to start to become a problem not to have exposure to Bitcoin.
So I personally, I think by next year, and towards the end of next year. And I think what's happening in the digital realm with software engineering, with the advent of AI, I think the next step is autonomous AI. I really truly believe that. And autonomous AI will be economically active right away. And the more hard assets you have, digital assets you have, and in particular set up your business in a way that AI can transact and interact with your business, whatever legacy business it is, the more you would benefit. And I think that curve is going to be extremely fast, probably faster than what we saw with the adoption of Bitcoin in general. And I think if you were early in that, you will benefit in a compounded fashion.
Yeah, I love to paraphrase safety. Like, you can't protect yourself from another corporation holding a harder asset than you. And I think it's already a huge competitive advantage because they're all holding melting ice cubes. All right, so I appreciate every one of you guys. I think the beauty of this is that we all drive demand for the underlying, and we all help each other's business actually through that way. So appreciate everyone that you're building in each of your jurisdictions, and it's a pleasure to talk with you today. So thank you.
Thank you.
All right, thank you guys so much. Great conversation. Give it up one more time for our panel. All right, we are at the final panel of the day. So please help me welcome to the stage our panelists, Dylan LeClair, Tracy Hoyas Lopez, and our good friend Rohan. We get the, there we go. Irani, that's right, I knew it. Rohan and I are just getting to know each other. He's building a phenomenal product called BitcoinQuant.com. If you have not checked it out, I would definitely encourage you to do that. Well, guys, we're at the final stage here, home stretch. Thanks for sticking around. We are talking about scarcity and the implications of corporations continuing to buy Bitcoin, continuing to buy more Bitcoin than is being mined. And this is going to be a bullish, quick panel. Get people out of here with some hopium. Dylan, I want to start with you. What are you seeing on the ground in terms of accumulation versus price action? I know it's the million-dollar question. I know we can't, predict what happens next, but we've seen obviously a pullback in the treasury market. We've seen stocks being hit. What's kind of your read overall on where we're at?
Yeah, well, I think the treasury companies were, probably the biggest, driver of demand over the last year. My thoughts on it are sort of that, and I've seen other people sort of say this, that the treasury companies are sort of like volatility shock absorbers for the Bitcoin market. And so, you saw Bitcoin just, 20, 30% from the highs, but a lot of the treasury companies are much more than that. And the sort of the valuations relative to the Bitcoin holdings, MNAVs, are sort of that oscillator of demand in a way. And so, my thoughts on it are sort of that the MNAVs are sort of like what we saw with like futures funding rates, or like kind of the previous markets cycles, like premium or discount to NAV. That's sort of a driver in and of itself, right? And so there's sort of a reflexive component where the market's strong, the corporation's stock price is strong, and it's driving further Bitcoin accumulation. So I think when the market is conversely cooled off, a lot of that demand is tapered, and so that's where the biggest companies, a company like Strategy, having the ability to continue to accumulate regardless of the appetite for common stock or where that valuation is trading. That's a big differentiator. But from what we're seeing on the ground, there's still a lot of enthusiasm from the asset managers, the investors. It's really interesting to read and scroll on Twitter and see some guy or some person or some anonymous guy say, well, Bitcoin's this or Bitcoin's that, and then you go talk with a guy that has the ability to cut $100 million check, And it's a completely different narrative. It's like, no, dude, this is nothing but a thing. I watched, Amazon stock pull back 40% 12 times in my career. It's nothing but a thing, right? And so Bitcoin's 85,000, 90,000. Nothing's changed. The price is a lot cheaper. Instead of chasing it at the highs, people are actually really excited to be able to, begin to work an entry. And when you manage $100 billion, you can't just ape 100% of it like me or you could with our paycheck. It's a different game. So in that sense, the pullback is something that I think is a positive.
Yeah, absolutely. It's funny to compare the sentiment on Twitter, which is easy to mistake for reality, and then you hear stories like that. It kind of changes your perspective. Tracy, we've heard the analogy of what's happening right now be described as a digital gold rush. In the real gold rush, when people were flocking because they knew that this substance was valuable and they wanted to extract as much of it from the ground, you didn't have kind of the real-time, here's what the price is of gold. You can just pull up on your phone. That's a big difference between the digital gold rush and now.
That would have been crazy.
It would have been crazy. It would have changed the dynamics quite a bit. We forget that we have that I guess gift that can be a curse a little bit. But nothing has changed. The fundamentals of Bitcoin obviously are the same. And here we are at 92,000, and sentiment is not great.
But that's just because we're in a spoiled industry, and also people are crazy.
Right.
Like, Bitcoin started at 0, and it's now at 90,000. Earlier in the year, it was 120, 125. Okay, Bitcoin isn't crashing if it's at 91,000, right? If y'all remember the bear market of 2022, when Bitcoin went to 17,000 and the miners had to sit down and consider whether or not they were going to turn out the mining operation because it wasn't profitable at that point, that's cause for concern.
Yeah.
Bitcoin at $91,000 from 0 is not really a cause for concern.
Right.
But it's the same sentiment. So I was just doing a panel on the Falcon stage with Paul Manafort, and we were talking about Trump's year in review and the promises, right? Everything promises made, promises kept. And when you look at it, when you go to the sentiment on Twitter, as Dylan was saying, a lot of the sentiment is like, oh, the SBR, they haven't bought Bitcoin yet. It's never going to happen. It hasn't even been a year.
Right.
And for the first time, I think part of what we're seeing in this cycle is that we don't know what we're seeing because we're in such a very unique position. This is the first time in our industry that we're, at least in the United States, that we're dealing with an administration that is actually being helpful to our industry by coming up with appropriate regulatory frameworks, by installing this world into the financial system. We're no longer the outsiders. We're becoming the rails of the future, right? So how is Bitcoin crashing when we have the friendliest administration we've ever had, and the rails are being built into what we've seen up until now, right? Traditional finance, traditional banking. This is we just don't know how to react to it because for the first time ever, we're not in absolute and complete chaos.
Yeah. So it sounds like what you're saying is like, just chill. Everyone just chill. Everyone just calm down.
Just chill.
It's going to take a minute. We are transforming the entire financial system of the globe. So that'll take some time. Rohan, I want to go to you. When you go to bitcoinquant.com, one of the first things that you see is the fear and greed index, and it's as far to the left on the fear side as I've seen it. And then that's what drives. That's what's driving sentiment, or what's like describing sentiment. But you also have a lot of really detailed metrics that a lot of people aren't paying attention to. What would you say stands out the most to you as you're going through these deep analysis of what's happening in the treasury space and Bitcoin, and what would you kind of provide from your perspective for a little bit of hopium?
Yeah, 100%. It's very interesting, right? When you zoom out, fear and greed is at the lows of the lows. It's 15, 20, and the price is at 90,000. If you told someone a few years back that the deep, deep bear market, when everyone is scared of Bitcoin, it's going to be at $90,000, that would have sounded crazy, right? And I mean, on this note of the digital gold rush, if we just zoom out for a sec, like the thesis is There's about 60 million millionaires around the world. If every one of them went to their financial advisor tomorrow and said, hey, I want a Bitcoin, that's just not possible, right? And that doesn't even include all of the structural demand coming from these treasury companies, from sovereign wealth funds, and from nation states. Like, that just shows how early we are, and there's going to be this gold rush that's going to continue.
Definitely. I mean, I don't know if you guys know this, but there's only 21 million of these things, right? And that is, I mean, that's the stat. It's like if every millionaire wanted to get one, there's not enough to go around. Dylan, what's your perspective on the supply shock, the incoming supply shock? I mean, we talk about this kind of in broad terms. There's been rumors of like, oh, there's only 100 Bitcoin left on Coinbase or whatever. Maybe describe some of the mechanics that people aren't aware of when you see these big institutional buys like Strategy. When you talk about OTC desks, Tracy, I want to get your perspective on this as well. A lot of people, just think they're logging into their Coinbase account and smash buying Bitcoin. It doesn't really work that way. A lot of it's happening off books. But can you kind of provide some perspective or education around how that part works?
Yeah, well, I think one of the things that's a bit misunderstood, right? Like the biggest sellers, right? For the past year, it's not ETFs, it's not treasury companies, it's not governments, it's old holders of Bitcoin. And so it's like, who's selling? It's the DATs or it's the, whoever, fake, it's the ETF holders or it's BlackRock or it's JP
miners,
Morgan.
you hear a lot?
I'm sorry?
Miners, you sometimes hear?
Miners aren't even really the biggest, they're a small factor relative to the flow. And so, who's selling? It's the people that bought Bitcoin for, $6 on the Silk Road or who mined Bitcoin for free in 2011, that are taking 10% or 20% off the table. And so it's like you see the ETFs buy billions of dollars, in a week. Well, there's been billions of dollars of sell pressure a day for, 2 years. And so, conversely, the price has gone up or is flat through that. So for every seller, there's a buyer. And we know, we could sit here in this room and identify, a few $1 billion of demand. Strategy and Metaplanet and BlackRock and whoever else. Well, where's the delta? Where's the other, tens of billions of dollars of buy pressure? And so ultimately, that someone's on the other side, and I think whoever that is, or they are plural, has deep pockets. And so this sort of chop, some analysts call it chop solidation. I think ultimately this is what is really, really healthy. If we just had a blow off top, then we'd have a long, nasty 3-year bear market that characterized Bitcoin for 10 years. But maybe this is sort of a new normal where we chop sideways for 6 to 9 months before repricing 50% higher. And since January of 24, we've done that like 3 times, right? So I think that's sort of our mental model. What was your other question? I didn't even answer it.
No, it's all good. We're talking about OTC desks and how the mechanics work. And maybe I'll throw it to Tracy on this. Is maybe just help us understand. A lot of people don't understand how OTC desks work, or when an institutional buyer is making a purchase. Maybe from Kraken's perspective, you can share a little bit about the mechanics of that.
Well, one, I do think that Dylan smash buys Bitcoin all the time. I mean, the OTC desk is so an OTC for over the counter. It's really cool when you think about it in a non-American way, and I'll explain what I mean for a second. The way that it works at Kraken is you put in your order, you buy your OTC, you use a Kraken Prime, you use a Kraken Pro, you go in, you make your buy, right? You can do that in the computer, or you can do that through like the Telegram groups. Put in your order, and our team executes that order for you.
Just buy Bitcoin through Telegram. That's the thing. A lot of people don't know that.
A Telegram group gets, and this is also done for a lot of like people that aren't as sophisticated. So like, like when you go into the platform, not everybody knows like how to go about the trades necessarily. And so pretty much every exchange runs the OTC desk a lot through a Telegram group. Now, the coolest thing that I saw, and I saw this in Hong Kong, and this isn't really cool, but it's just like really interesting. There's this whole building, which used to be for a lot of nefarious and illegal activity, got rebranded, and it's where all the OTC desks are, and you walk into the building, and it's actually desks, and each exchange has a desk there, and you go in with cash, and they give you your digital asset.
Wow.
And I thought it was wild because I thought everywhere was just like, okay, well, you plug into your platform, whether it's, Kraken, as it should be, or, any of the other exchanges. But then there's this place where you go and there is a literal desk and you give them money and they give you digital assets in exchange for that. And I thought that was pretty wild. But anyways, that is just like not the most conducive place. I don't recommend you do that just for safety reasons. You never want to be walking out of like the OTC desk building and be like, yeah, I'm filled with digital cash here. Like.
If I could just add one thing on the OTC desk, I see a lot on Twitter, there's someone has an on-chain analytics company or dashboard, and they say there's X Bitcoin on OTC desks, and we're going to run out, or the reality is, and I can't speak for all OTC desks, and they run their own inventory, but like if we say, hey, we have 100 million, we want to buy Bitcoin over the next 5 hours, the Bitcoin's being bought on an exchange in an order book.
Right.
They're just executing it. Whether it's with an average, a TWAP, a time-weighted average price, or just, over the course of a day. It's not like some guy has a pot of Bitcoin that he's holding just for Metaplanet or Strategy to buy.
Dylan
and if
is
it
lying.
runs out,
He's holding a pot of Bitcoin, just so you know.
Yeah, it's so ultimately, OTC desks are buying and affecting the market the same way anybody else is, right? It's just a way for you kind of smooth out the order.
Right. So the current system basically is designed to limit or prevent the supply shock, the incoming supply shock, right? To mitigate it so that it's not this immediate. Is that right? Or am I doing?
Well, there's always going to be supply of Bitcoin. If there's no supply left, there won't be a price, right?
Right.
So, no, I think ultimately it's going to be not a supply shock, it's going to be a demand shock, right? And that demand shock's probably from a huge amount of supply of fiat.
But let me just say this. So we're talking about, so there's obviously an accumulation of Bitcoin being done by institutional organizations. And of course, like the whales, the people that have been holding Bitcoin for a long time, they're dumping it because, they wanted to make money at the end of the day. But I think that one of the most important things is there will always be a market for Bitcoin because there will always be buyers and sellers, right? Like the price is just a different thing. Now, what I think it's more interesting is as this framework that we're seeing being implemented around the world, in the United States, market structure coming up, then you have like here in the UAE, you've got VARA in Dubai, you've got ESCA over in Abu Dhabi at the federal level. The way that I see it, right, in Satoshi's white paper, Bitcoin is a peer-to-peer cash system. And one of the issues that we've had is, up until this point, has been institutional involvement in Bitcoin. I think, and I can be wrong, and I'm happy if I'm wrong, but I think that the more the institutions get involved and the more people that get involved in Bitcoin, the more we bring to the reality this peer-to-peer cash system, because that means that we're implementing frameworks and rails for Bitcoin to be moving back and forwards, and we are the people that have been keeping Bitcoin away from us, or the people that have been trying to get us debanked so that we can't exchange in this space, right? Well, they're now becoming a part of this space. So it's just bringing it all in together.
Yeah, no, that makes sense. Rohan, I want to kind of shift gears a little bit as we get ready to wrap up and hear from you. MNAV, hot topic in our space. You evaluate a lot of the treasury companies. Do you think that this MNAV metric is kind of overblown? Do you think it's an accurate representation of a company's value, or how would you describe it?
I think it's still a new space, even though this has been going on for now a year or several years, pioneered by Strategy. I think MNAV has become one of the most commonly used metrics because people always say, well, why should I buy a Bitcoin treasury company when I can just buy Bitcoin instead, right? And so people look at MNAV as a way to justify at what price or would it actually make sense and what kind of Bitcoin yield and increase in Bitcoin per share could justify company at its current price, right? And so I think it's still a valid metric, and we'll have to see how that evolves over time.
Definitely. Any thoughts from you two? MNAV?
I think. Listen, I have so many thoughts on this, and I don't think that the MNAV is an accurate representation of the value of an entity. You have these entities. Okay, listen, if your point of being a Bitcoin treasury company is just acquiring Bitcoin and sitting on it, then that's just like one thing. Okay, great. Then you probably deserve to be acquired. You probably deserve to be an acquisition target. But if you are a treasury company that's actually using that Bitcoin, the way that Saylor uses it, right? There's financial tools attached to it, by the way, which is what I believe a Bitcoin treasury company is. It's not just sitting on it, it's giving utility to the Bitcoin that you have, right? If you're a company that's a treasury company that's doing either financial tools, or you're becoming slowly and growing in a services company, like, the market is just not seeing this thing because I think, I can be wrong, and Kyle is here, so Kyle can yell at me afterwards, but the market is just seeing this as just people that are putting magic internet money in their company with the expectation that it'll magically rise, without understanding why these companies are using Bitcoin, why they're invested in it, what they can do with that Bitcoin, and then how as a company they're growing.
Yeah, no, that makes a lot of sense. Dylan, I'll give you the last word here.
Yeah, no, I think it's a useful metric. It's, use it in isolation. It doesn't mean anything. A static snapshot of valuation doesn't really tell me much. But sort of a time series, or that in tandem with a bunch of other data points is useful. I mean, I think from MetaPlanet's standpoint, we're not going to issue equity at an MNAV, a common stock, with MNAVs at 1 or below, right? Below 1, we might, depending on where it is, we could even buy back our stock, right? And so I think from the standpoint of an issuer, that could really impact, depending on where that valuation is trading, we may be very active in the capital market. Like over the summer, we were buying $100 million of Bitcoin a week for 12 straight weeks, right? And now the past month, we haven't been as active, right? And that's sort of subject to the market. So, investors can think how they want, but for the issuer, I think it's something that we look at very closely, and we evaluate, our decisions on that basis.
Amazing. Well, thank you guys for this conversation. I really appreciate you joining. Give it up for the panel one more time.
Buy Bitcoin.
Buy Bitcoin.
On Kraken.
We're going to take a quick photo. Don't leave yet, Dylan. One quick photo. Ooh. All right, we are at the end here. Thank you guys so much for joining us. Again, this is the Bitcoin for Corporations Symposium. If I have not met you, I would love a chance to say hello. Our team is here also, and if you're a Bitcoin treasury company, if you're a vendor in the space that provides products or services to treasury companies, we would love to meet you, get you involved in the network. Thanks so much for being here. I hope you enjoy the rest of the conference.